On that sector hanging over these markets. Will they be August 1st? Will they be much further out into the future? And will they really be 200%? Compass is in focus for us. This is a catering business based in the UK. They've upgraded their guidance this morning, Guy.
Absolutely. The European earnings story is really going to gain a little bit of traction as we work our way through this week. Today, there's a few things that you need to fold in, as Anna's been saying. Still a bit of macro that we need to factor in as well. So let's look at this market open. Time for the opening trade. Let's give you some numbers, give you an idea of what is going on. The FTSE 100 delivering a breezy, what am I looking at? 0.1%, if I'm being optimistic to the downside. Pessimistic maybe is the right word. There you go. The IBEX is down by 0.2%. We are, as we talked about just a moment ago, maybe pricing in at the latter end, the last few hours of the US session, where we did see a little bit of a fade stateside, but it's not significant. We're down by 0.2%. And again, I've only been back for a couple of days, but we're still in this kind of world where you're not getting big moves, where volatility is still very depressed. VIX is at 16. On a daily basis, you're getting kind of relatively small moves. We saw a big move in the bond market yesterday in Europe, but again, not much movement in stocks. They're kind of oscillating a little bit, but not by very much. So let's talk about where we are getting some action. Maybe we do see some in the sector story. Lizzie, what do you got?
Well, we've got more than 3/4 of sectors across the continent in negative territory this morning. So at the bottom of the basket, you've got chemicals, tech, energy, banks not far behind. In the green, you've got basic resources up 0.9%, travel and leisure up 0.2%. These are not big moves, it has to be said, across the entire basket. But when you look at some of these individual names that we were flagging earlier, Akzo Nobel was one with earnings out this morning. The Dutch paint maker, of course, the Dulux maker, it had cut its profit forecast, and those shares down 3.7%. You talk, Hannah, about Sanofi, the French pharmaceutical company, of course, with a bit of M&A. Those shares pretty flat to the upside at this point. Julius Baer came out with results as well, beating on inflows in the first half. Those shares actually up 2.4%. And Lindt, bit of chocolate, let's throw that in. So boosting its organic sales forecast for the full year. But the share is actually down 3.1% at this point.
Yeah, that's an interesting one, isn't it? Those Lindt shares down, despite the fact that they upgraded their guidance. Compass, maybe the market was looking for more. Compass Group is up by 0.4%. They upgraded their guidance, but so it's outperforming, but not by a huge amount. I'm interested that Basic Resources is doing quite so well on a day where the direction of travel is downwards. We seem to be a little more risk off. Yesterday, we saw real stunning outperformance by Basic Resource stocks, really substantially in session yesterday, and I wonder if we're seeing a bit of a continuation of that. Miners were up by 2.9% in session yesterday, and we do see iron ore prices are a little firmer through the Asia session, so maybe that has something to do with it. But as you say, Lizzie, just a handful of sectors to the upside. But it's interesting, you've got the utilities and healthcare going higher, but also Basic Resources and travel and leisure. It's a complicated market this morning.
I think there is some interest in the stock story here. So in a world where actually most stocks are doing nothing, relatively low vol, you're not getting an awful lot of movement. You are getting some movement on the back of earnings. So maybe earnings does provide something of a catalyst. Alfa Laval out with numbers this morning. Its stock is down by 4.5%. Akzo is down by 4%. Lindt Sprungli is down by 3.5%. So these are the names that are under pressure this morning as a result of earnings, and they do in some ways dominate. Akzo Nobel down by 4.25%. These are the names that are dominating the downside. So earnings are producing a little bit of kind of volatility. There is some of the stocks there are bouncing around a little bit. Again, on the upside, it's Julius Baer, the biggest percentage gainer on the stock 600, up by 2.7%. So some of these names are rising. Norsk Hydro definitely bouncing around a lot this morning. So you are getting earnings are producing some volatility.
Yeah, we've got stopped trading on Lint, I think, because of that volatility. So it was down quite a lot, then bounced, and now down again, and then stopped. It seems like the market taking its time to digest.
But that does make you wonder about the rest of the earnings season. Does the rest of the earnings season generate more volatility? In a world where we're trading with kind of a VIX of 16, where there's no vol kind of in the market, where markets are rising by kind of less than a percent on a daily basis.
The past months, we haven't seen those moves over 1%, have we, on the stock 6 on the S&P?
Yeah. Precisely. So maybe as we come out, as we get into earnings, actually the amplitude increases.
So this is the thing that gets people excited.
I'm looking for things that break us out of this kind of low vol environment, or maybe it is the macro, but maybe it's not. Maybe it is actually what we learned from the single stocks, what they're telling us about inflation and tariffs and pricing power and the consumer. All of that is kind of useful information as to how actually in reality all of these kind of big macro moves are sort of feeding down into the market properly.
Well, let's bring in Hugh Gimber. He's with us around the table, global market strategist at JP Morgan Asset Management, of course. Morning, Hugh. When you're looking at these earnings coming through from different companies, euphemistically referring to tariffs and the uncertainty, for example, that they're navigating, what do you make of what you've heard so far? And is there a point later in the year maybe when you actually expect tariffs to manifest more visibly, both in earnings and in the macro data?
Well, first of all, thanks for having me. Let me split that into two. I think what we've seen from earnings season so far on a backward-looking basis is a set of pretty decent results that has underwhelmed the market. And I think it tells you a lot about expectations coming into this earnings season. The narrative has been expectations are pretty low. Of course, we're going to see beats, but ultimately that's not going to tell us a huge amount about where we're going forward. I think more broadly, the situation we're in is where tariffs are going from the hypothetical to the tangible. And so for much of this summer, it's been very easy for investors to dismiss tariff risk and say, well, where is it in any of the data? Where is it in GDP? Where is it in inflation? And over the past week or so, we've seen the first signs. US inflation last week, really interesting. If it wasn't for a big move in used car prices, I think we would have been talking a lot more about some of the tariff-related pass-through. And so that's where we're spending all of our energy on this earnings season, trying to gauge where the hit from tariffs is going to come through, which, to be clear, it will. We do not believe you can see this magnitude of a change in US trade policy without corporates and consumers feeling some of the pinch.
So does that lack of volatility that Anna's been talking about, the S&P not moving more than 1% up or down in a day, surprise you when you've got that tariff uncertainty, when you've got the threats to the Fed chair as well out there?
So I think the key anchor point here is the solid state of corporate fundamentals that was coming into this shock. So that, for me, removes some of the big downside risks. I think it explains why investors have been willing to look at weakness in the market and say this is now an entry point, because I know actually balance sheets are in good shape, and some of those big left tail risks for the economy that were on the table in April have now been taken off. So we can understand the willingness of investors to look through some of this noise, but it's where people are just dismissing the idea that this is actually going to be a meaningful issue where I get really uncomfortable. Because for corporates so far, why would you make a big call about where we're going to head? You look at the last quarter's earnings season, they either said nothing or they said, we'll give you 4 or 5 different scenarios and you can choose your own adventure within it. Yeah. That can only go for so long.
So what breaks and when this mentality of it's all good? That's what I hear. If a dip's coming, great, fantastic. I love the idea of a dip coming because I can buy. Not a dip's coming because actually there are reasons for that dip to be there.
I think it's the economy, ultimately coming back to the state of the labour market, because one of the key points of corporate resilience is their ability to pass through the pressure that they're under to the consumer. That, I think, is still the main assumption, that margins are starting at such a strong level that corporates are going to just repeat what they've done for the last 3 or 4 years, see the squeeze on input prices and hand that all to the consumer, which today is feasible. If we're in a situation 6 months down the line where the labour market is clearly weakening more quickly, consumers are starting to come under pressure, that's where they're going to start pushing back against some of those price increases. And so there is a muddle-through scenario here, which I think is the base case. Corporates and consumers share out some of this hit, that US trade policy becomes gradually more moderate over time as markets play that critical role in guiding things to a more reasonable place. But the labour market, I think, would be the main challenge to that story.
Okay, so the labour market is the place that we start to look to for further detail of how this plays out. how are you playing things, or how are you thinking about August 1st then, Hugh? And because this is the big, from a European perspective, this is the big unknown right now, is what kind of deal Europe will get. Europe, we know, is working on options if there is no deal, and what the retaliation might look like. I mean, the start of August could go very differently, couldn't it? In a quiet market, we know weird things happen in quiet markets when many people are not at their desks. And
we saw that time of year.
Yeah, absolutely. We certainly saw that last summer, didn't we?
We did. Hopes for a quiet summer, touch wood. But I mean, August the 1st, we have payrolls as well on that afternoon. Don't forget, we're going to get sort of a confluence of information on that day. From the European perspective, the bottom line is that US exports are too important for them to be able to give up. And I think that is crystal clear when you look at how Europe is thinking of retaliating. It's all political. It's Harley Davidsons, it's Levi Jeans, it's Jack Daniels whiskey. When you think about that from a European perspective, that means that tariff escalation is a much bigger deal for growth than it is for inflation. So that, I think, gives the European Commission some cover, because they know they can push some of these political levers in the knowledge that if we see further tariffs escalating, you have the ECB as the backstop. That's where Europe is in a very different position today, where they can afford to cut in the face of tariff escalation in the way that the Federal Reserve can't.
Okay, can I ask about the ECB then, with that in mind? I mean, do you think the tariff issue for Europe then, there's deflation involved there? Even though, I mean, is that just in the short term? Because if you step back and think that this deglobalization might be catching, then that sounds like it could be inflationary more into the medium term. But you focus on maybe the short-term deflation dynamics.
In the short term, yes. We think the hit to growth would overwhelm any of the inflation pressure. Think about China in this as well. China-US trade frictions building. The option for China, therefore, is to move more goods to Europe, lower tariffs, and therefore lower prices again for the Eurozone. So in the short run, we absolutely think that for Christine Lagarde, this should be a growth issue, not an inflation issue, and therefore there's room for the ECB to cut further if trade tensions escalate again over the summer. More medium term, of course, we're in a world where inflation is not necessarily going to be higher on average, but it's going to be more volatile. And all of this economic nationalism that we're seeing is leading you to a world where supply-side shocks are going to become more frequent. For investors, I think the key implication there is that you can no longer rely on negative stock-bond correlations consistently. You need to be thinking through all of these shocks about protection against the growth slowdown, but then also protection against the inflation spike.
So what do I do in all of this? I'm sitting here, I've got a little bit of FOMO, markets are doing relatively well, I'm hearing all the risks that you're talking about, I know they're coming, probably, I don't quite know how they're going to hit, it's going to be really uneven, it's going to be really difficult to deduce exactly what's going on. What do I do? Am I still long stocks? Am I still longer European stocks, rest of the world, than I am the United States, despite the fact the US has outperformed over the last kind of 2 or 3 months quite significantly? What am I doing here in terms of just managing a portfolio, given the universe of risks that seem to be orbiting around me at the moment?
So let me give you 3 things on that. First, I think credit is well positioned, because what I'm talking about in terms of the growth slowdown is an entrenchment of capex. Corporates starting with strong balance sheets and deciding to put off future spending.
You're talking about IG, or are you talking about high yield?
I think both are pretty well.
High yield has done really well recently.
It has, but for good reasons, because balance sheets are in good shape. Yes, spreads are tight, but when you think about the all-in yields, you have some room to absorb rising spreads before you're going to see that coming through in negative returns. So yes, I think you will see excess returns from credit, both in IG and high yield, because corporates fundamentally are in decent shape. That will be point number 1. Point number 2, we think there's more room for DM ex-US to outperform the US going forward. That's primarily a capital flow argument, that investors are still looking at the US as a market which is very hard to turn down. Just think about all of the pushback we're now seeing against this European rotation. Big picture, the growth differential between the US and Europe is set to narrow, and that is a big deal for the European earnings story over time. More room for Europe to outperform. And then third, think about currency exposure much more carefully. That means either you diversify your regional equity bucket further, or you need to think about currency hedging, because in Q2, for me, the big story was the dollar continuing to depreciate at a time where other US assets were recovering.
Great to see you. Thanks for stopping by to see us. Really appreciate it. Always. Thank you very much, Hugh. Hugh Gimber, Global Market Strategist, joining us from JP Morgan Asset Management. Core 6 looks like this morning. Remember, we get SAP later on tonight. I think it's out at circa 9 p.m. this evening. So keep an eye on what happens with the tech stocks here in Europe. But the European earnings season really kind of gathers a little bit of momentum Tuesday into Wednesday into Thursday. LVMH, names like that coming out a little later on this week. LVMH, a little softness this morning, but actually broadly quite a bit of softness this morning. Novo is actually rising a little bit. But elsewhere, even Nestle, safe area, sells a bit of chocolate. It's down by 0.3%. Talking of all of this, let's fold in the latest earnings that we're getting. Chloe Melle's here with more.
Good morning, guys. So let's start with a big share move from Lindt this morning. It is down more than 6%. It did raise its organic revenue forecast for the year, but that might have not been enough to really impress the market. So it's really down. That follows a rally in the shares over the last few months. Moving on, we have got some news over from AkzoNobel over in the Netherlands, and it is down 4%. It cuts its profit forecast. Said that it was due to tariff uncertainty and currency headwinds. So we've got a big share move down there, 4%. Now moving on to Compass. So Compass did quite well this morning. It is up it was up 4.5%. It has raised its organic revenue forecast and also made a big acquisition. So that seems to be driving up the stock this morning. And then finally, let's end on some semiconductor movement this morning. So Infineon and SG Micro are both down more than 2% this morning. Their peer over in the US, another semiconductor company, NXP, provided a forecast that kind of disappointed the market a little bit, and there's a read across there with the European chip stocks that are down this morning.
Chloe, thank you very much. Chloe Melle with the latest on some of those stocks on the move. Yeah, weakness coming through in Switzerland then with Lindt, Sprüngli and Givaudan all on the back foot. We'll certainly keep an eye on that. We will move on to other earnings stories as well this morning. Coming up, European earnings in focus. Norsk Hydro reporting strong second quarter results. We'll break down the results on this programme as companies continue to navigate trade policy uncertainty. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Let's call it 19 minutes into the equity market trade. This is the picture you're looking at around Europe, fairly flat. Earnings, actually, I think is probably the more dominant theme that we are watching this morning when it comes to the single stock story. And there's plenty of actually really interesting narratives out there. Let's talk about Norsk Hydro, the aluminium producer out of the Nordics. Some really interesting commentary, I think, coming through from the company. The stock is up actually on the back of the beat, but there's you just kind of read through the statement. It's fascinating. Under the current political environment they talk about, the investments will focus on flexibility, risk mitigation, and responsiveness to a changing economic and policy conditions. Quite a lot of flexibility here in terms of kind of what they're saying, i.e. we don't know what the policy environment is going to look like. Clearly, this is a company that's going to be impacted potentially by tariffs. Long-term growth remains key, but we're shifting to operational efficiency, cost control, maintaining optionality. Jonas Ekblom in Stockholm covers this story for us. Look, the company's out with a decent set of numbers, top-line beat, the market kind of likes it, but they are talking about a lot of uncertainty over the near term in terms of what the business is going to be delivering. Just talk us through what they've said to the market this morning and why we're getting this positive response.
Yeah, for sure. No, like Norsk Hydro, like very much similar to other Nordic industrials, they're talking a lot about the tariffs and geopolitical uncertainties and how it's impacting them. And really, it's a lot of them, it's signaling a wait-and-see approach still. Like a lot of companies talk about the 10% tariffs on Europe, and most of that has already been mitigated and handled by the companies. And again, like it's very much a wait-and-see because things change by the day.
As you say, they're handling it. Is that why the stock is up? Is it because there's a confidence that they are handling or will handle the tariff impact well?
Yeah, good reminder on the next. Yeah, exactly. I think we've seen some like earning strength across the board when it comes to how companies are handling the tariff impact. A lot of Nordic currencies have strengthened quite significantly against the US dollar, and that's seen as a more tricky proposition.
Okay, Jonas Ekblom, we thank you so much for that analysis. And we're actually going to be speaking to the CEO of Norsk Hydro following the company's earnings today. That exclusive interview with our very own Tom McKenzie coming up at 9:30 a.m. London time.
Staying with the European earnings theme, let's talk about the Swiss chocolatier Lindt & Sprüngli. Shares of this business down by 5%, despite the fact that the company posted strong growth in the first half of 2025, raised its full-year guidance for organic sales growth. So what's happening? For more, let's bring in Bloomberg's Swiss markets reporter, Allegra Catelli. Allegra, very nice to have you on the programme. So what do we note here? What had we missed in focusing on the upgrade to guidance from Lindt & Sprüngli?
So thanks for having me. While the results in Europe were quite good, the company actually reduced its margin guidance, and that's what's weighing on the stock this morning. Higher price elasticity, mostly in the US, is being felt by consumers that are worried about tariffs, and that's after Lindt pushed through really steep price increases around 16%. So the lower volumes posted this time around also show the pressure the whole category of chocolate has been feeling for the past 2 years now. Really, really high cocoa future prices have deeply impacted the whole sector. It's also of note that the stock is at record highs, so analysts are a little bit concerned about further upside from here. And this is kind of the first time that the company is flagging any, consumer spending weakness over in the US.
Right. Is there an expectation, Allegra, that maybe actually tariffs will hit this company? We haven't seen it yet in a meaningful way, you could argue, but it's coming and it could get worse. And it does seem as if sort of higher end European luxury companies could be at the sharp end of this story. So what is the tariff read-through, and what are people expecting the tariff read-through to be?
I think it's more of an indirect tariff impact that impacts consumers and makes them go for more value and cheaper alternatives. In fact, Lindt is very much seen as the premium brand within the chocolate industry. It's also been its strength because they see it as a gift-making opportunity, and so consumers would rather splash on this type of brand, but in this type of environment, that might change.
Okay. Allegra, thank you very much indeed. Allegra Catelli joining us out of Zurich on what we're seeing in terms of the luxury story and the Swiss luxury chocolate story. I have to say, the whole Dubai chocolate thing completely caught me by surprise. Everybody seemed to get very excited about that.
Them and their copycats just everywhere.
Trying to get it was very, very difficult. So chocolate became kind of a must-have commodity. I guess normally a must-have commodity, but very much a must-have commodity.
Well, it was really interesting what she was saying there about that pricing power, because we were talking enthusiastically at the beginning of the programme about here's a company that seems to have pricing power. Look, they're guiding higher. But she was very clear there saying, well, look what happened to the margins in the US, though, and that's where they put up their prices really aggressively, and it seemed that the market couldn't absorb it. There was some pushback, yeah.
And that's what they did with really high cocoa prices. So food prices generally are super high at the moment. Cocoa prices have been very high for quite some time and don't seem to be coming down in any kind of meaningful way.
I have to say, just having spent some time in New York, the food prices were extortionate there.
Yeah, they always are, but more extortionate than normal.
Even after a slightly stronger pound than, say, I don't know, 6 months ago. Let's talk about some of the other earnings stories, shall we? I've been diving into the Givaudan numbers, and those, when I saw the headlines cross earlier on this morning, they did seem as if they were light on the sales line and on a host of other lines against market expectations. But you don't get the sense that the management were maybe focused on that when putting together the release, because they were talking about how pleased they were with the continued strong financial performance in the first half, despite, and here's where we get to all the euphemisms for tariffs and everything else. They're talking about despite the environment of ongoing geopolitical and macroeconomic challenges. I mean, there are many of them, aren't there? But when you look at the conclusion of some of the analysts this morning, there seemed to be a focus on two different areas of the business where things are a little light: the well-being unit and the taste unit, because this is a flavours and fragrances business, but maybe it's the flavours part. So again, this is food.
It is food, yeah. I want to talk a bit about paint. Akzo Nobel, really interesting. So a number of different things kind of around Akzo. As you say, they make Dulux, they make all kinds of things on the coating side. But what they're flagging is the FX story. It's a stronger euro. It's this sort of translation effect that they're talking about. If you sell a lot of stuff in the United States, obviously that is something you have to translate back now.
That is really interesting, because last time we got the earnings conversation with Akzo Nobel, we spoke to the management, and there was a sense that tariffs don't really hurt them because they make heavy stuff. And so you make heavy stuff in the location you're going to sell it. So you make paint for the US in the US. But that ignores then the FX
translation effects.
impact.
The indirect effects.
Yeah,
you've
got to bring the money back. You've got to bring the dollars back, but you're not getting as many dollars for your euro as you once were. The stronger euro obviously affects that. And it does work in the reverse for United States companies as well. So these big tech companies which make a lot of money outside the States, that translation back into dollars actually works in favour.
Goldman Sachs was talking about that being a slight positive, actually, for US stocks.
Exactly. The likes of Invesco, JP Morgan Asset Management are saying that this is precisely one of those reasons why you should get in on that stock market rally stateside.
Coming up on the programme, we'll stick with the earnings themes. Earnings season kicks into gear on both sides of the Atlantic. Companies weighing trade uncertainty against broader market concerns, of course. We will talk about some of that tariff impact. This is Bloomberg.
Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing. Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
This is the opening trade. We are 30 minutes into today's session, and the Stoxx 600 is down 0.25%. Weakness really across the European continent as we wait for clarity on the trade situation, the no-deal scenario being battered around among EU officials, but also we've got this mixed batch of earnings coming through. So passing that, but a little bit of outperformance for the FTSE, and that perhaps correlates with what you're seeing in the sectoral picture. Best performing sector is basic resources, up 0.8%, Guy.
Yeah, started yesterday, it's kind of continued through into today, but the earnings story I think is really fascinating. I think that as the week develops, like we've already had a lot of earnings already, and we're going to get more as this week develops. You're going to get some really big names. You've got SAP tonight. You've got plenty of other big names coming out throughout the rest of the week. But there's some tension within the European earnings story, which I think is really fascinating. These are companies that are struggling with a stronger euro. We could go higher on that. They're struggling with what's happening on the tariff front. They're definitely struggling on the inflation front. How do they manage all of this? The earnings maybe aren't quite as strong as also we're seeing over in the United States. So let's talk more about this. Michael Basica joins us, strategy for EMEA equity markets here at Bloomberg. Is that the picture? I guess the earnings season already starting to almost reinforce the outperformance we've seen of US stocks recently and the underperformance we're seeing over the last kind of few months of European stocks because the earnings picture is not there at the moment, you could argue, to support the European stock picture.
Yes, Guy, that's right. It's the earning picture is not here. We're very early stage, though. I would give that as a caveat because things can change. But from what we have seen so far, it's been pretty mixed. Some sectors are really, really doing poorly, like the chemical sector, especially. Which
is usually a kind of leading indicator.
Yes, yeah, like a canary in the coal mine
exactly.
kind of thing. Yes. The thing is, like, it's very hard to give a guidance at the moment, and that's all because of the tariff deadline, all because of we don't know what's going to happen. It seems there's a lot of tension going on. We're getting closer to the 1st of August. There's nothing there. It seems the US wants to play hardball there, Europe as well. So we might get more and more tension until we get there. Funny comment this morning from Goldman Sachs trading desk about how the clients have started to actually getting more worried that we don't get a deal by that time.
Oh, right, okay.
Yes, and there's like a hedging demand like growing from
How are they doing
clients.
that? What are they hedging?
They're buying puts on the Euro stocks.
Right.
And so they literally, and on the DAX as well, they're literally hedging their bets on European stocks because they're kind of worried now we're not going to get something. And like Europe could be really vulnerable to a no deal, especially Germany. So that's what we're seeing.
The more I think about the date, August the 1st, the more that just worries me. Just the fact that it's August, Michael. And was it just last year we had all that drama around Japanese rates, and that's where it started, but it quickly morphed into something much bigger, because these are periods of time where you don't have everybody at their desks and there's sort of, maybe too many machines in charge. But is that something that worries investors increasingly? Maybe that's also why they're seeing a lot of that activity, that hedging activity at Goldman's.
That's right. Like August is a month with like lower liquidity. It's trickier to trade. It's always more volatile. It's like it's not a month where you want to. You want to come in like without hedge. And obviously there's these tariff deadlines. There's the rates that are still high in the US. There's inflation creeping up. It's it's getting a bit tricky, and we have seen over the past few weeks there was a lot of complacency from investors, like everything is fine, we're going to get a deal, it's okay. But the more we get closer to it, and the more we think, well, maybe it's not that easy, and it's not going to happen, or there'll be an extension or something like that. But worries are creeping up.
But what if everything is fine on August the 1st and there is an extension? We're still range bound for the S&P. How do you break out of that? What, to ask Guy's question, excites the market to move the S&P more than 1% up in a day?
So on the S&P, it's a slightly different picture. The thing is, positioning on US stocks was so depressed earlier this year. It's been going back up, and you have a very big cohort of systematic strategies that are still not overweight on US stocks. And those systematic strategies, whether it's vol control fund, whether it's CTAs, they're ready to buy a lot more. So as long as you have volatility staying low, like we have now, those funds keep buying the US stock market. And that's why we're seeing, that's why the market is so supported. On the other hand, you have so much support for tech. It's like crazy. Crowding indicators for big tech are like the highest they've been this year. Nvidia is literally the most crowded stock in the world right now, but it's not the only one. A lot of US tech is the appetite for US tech is just there. It's still there. The AI frenzy is back. So there's a lot of demand there.
What changes the mentality? It feels to me we're still in this kind of mentality that we've been in for years. That a dip is an opportunity, that weakness is to be bought, not sold, that investors are still in that older mentality. April didn't change anything in terms of people's perception, and that's why they continue to see risk is almost a good thing. If some of these risks materialise, why is that a bad thing? It creates an opportunity to buy. So yeah, people are hedging the downside risk at the moment, but is there still that mentality of any weakness is an opportunity, any weakness is to be bought?
At the moment, that's what we're seeing. The thing is, earnings growth is still okay, especially in the US. Yep. We're expecting 8% this year, 11 or 12% next year. AI is supposed to feed into productivity numbers. So, growth is there. There's no other place where investors want to be than in equities. And so buying the dip is kind of the mentality still.
Michael, you mentioned chemicals as being one area of concern, and you said it's very clear early in the earnings story, so we don't have all of the details. But are there any other sort of nuggets? We've been throwing around a few things that stood out to us, companies upgrading guidance. Some of them, that sticks and they do well. Others, they upgrade guidance and still the stock falls. Are there things in the earnings picture that have really stood out to you anecdotally?
The auto sector is interesting. We've seen Renault and Stellantis pretty bad guidance, pretty bad earnings. At the same time, it's kind of people were expecting it. It's priced in. We see a lot of rotation into the former laggards of the European market, especially whether it's mining stock or autos. So there's investors are not too fussed about that. They kind of expected all those.
That auto weakness.
Yes,
it's certainly a well-trodden story. A story we picked up on many times.
And it's really interesting to listen to what's happening in China about the fact that the Chinese are talking about the fact there's so much overcapacity and they want to pull it back in, but they're also talking about it from an AI point of view as well, over-investment in that space. That mentality definitely not being represented over in the United States. Michael, great stuff. Thank you very much indeed. Senior strategist for EMEA Equity Markets, Michael Masika. definitely worth a read on a daily basis of the stuff that comes out of that team. European leaders, Lizzie, what are they up to?
Well, they're travelling to Asia, Guy, this week to meet their Japanese and Chinese counterparts, it should be said, for trade and defence talks. Now, there are high expectations here that the meetings in Tokyo are going to yield defence and trade cooperation, which really is in contrast with the hopes for discussions with Beijing, which the hopes for are limited. For more, let's speak to Bloomberg's Oliver Crook. He's back in Berlin for us. Ollie, just talk us through the differing relations that the EU has with Japan on the one hand and China on the other.
Yeah, ahead of this trip from Ursula von der Leyen and the President of the European Council, Antonio Costa, who are going first to Tokyo and then to Beijing. As you mentioned there, Lizzie, it's really going to be very sort of contrasting in terms of tonally and in terms of what they hope to achieve with one another. The trip to Japan is really about sort of reassuring and shoring up kind of reliable partners that Europe has in the world. There are fewer of them today than there were a year ago, right? And that is largely because the United States has withdrawn in many ways from the international multilateral order and has really distanced itself from Europe. And really there's an opportunity here in Japan for the Europeans to sort of build on this relationship on defense, on commerce. One of the other things that they want to talk about is the support for multilateralism and international rules-based system, a system that the United States is moving away from. And you also had earlier in the year, early in June, the first ever Japan-EU security defense dialogue. That is, again, a new innovation in order to try to build up that relationship going forward. That will contrast to the next day in Beijing on Thursday, where you'll have the meetings, again, of Ursula von der Leyen, Antonio Costa, with a number of officials over in China. And really, when you look at what they've laid out on the agenda, even publicly, it's a lot more muted, right? They want to underline the importance the EU attaches to fair and balanced relationship with China. You know, overall, there's been very universal complaints about China's trade practices all across Europe. There are some European states that want to see people see the bloc getting closer to China. That is not really a predominant theme, though, from most of the leaders within Europe. And of course, the other sort of issue is the sort of geopolitical challenges. Of course, China kind of on the other side of the Ukraine-Russia conflict. One place where they may have a little bit of overlap is on this idea of sort of climate change. But there again, the Europeans are going to be very threatened by the Chinese, who have really taken a massive lead in all things sort of climate practices, whether it's solar panels or EVs. And that is something that is going to be really top of the agenda in terms of their concern in dealing with China.
Okay, so Ollie, that's a sort of look ahead to later this week, where we'll be very focused on that Europe-Asia relationship. In the run-up to August 1st, and who knows when we get news, we're also focused on the possibility of a US-EU trade deal. Talks seem to be ongoing. How vulnerable, you're in Germany, I mean, how vulnerable are Germany's plans to Trump's trade war? Post the invasion of Ukraine, actually, we saw that parts of the German manufacturing base so damaged by those higher operating costs that they suddenly had to endure. And then we see this on top, this threat to the export engine. What are you hearing?
Yeah, and we had this really great conversation yesterday with the CEO of Deutsche Bank and Siemens, who gave kind of their appraisal of the trade relationship and the trade talks that are going on for the next 2 weeks. I think really my takeaway, and this was a point that was made by the CEO of Siemens, Roland Busch, was that basically, as you guys were just discussing in the earlier segment, that actually 6 to 12 months of will they, won't they, is actually going to be worse for the private sector than a deal that's maybe not that great. And that they really just need to get this behind them in order for them to make these large investment pledges that they would like to make. In certainly in the era of Merz, where you've seen all this public investment from the German government, you also need to have that private investment, and that private investment is predicated on certainty in the global trade order. There was also another side of this conversation, and this came from the CEO of Deutsche Bank, the silver lining that exists for European banking. Have a listen to what Christian Sewing had to say.
There is one trend which is the same across the world, that our clients want to have a European alternative to the US banks. We have very strong US banks, very capable US banks, but in this world of geopolitical uncertainties, they want to have a capable global European player.
And Deutsche Bank would like to be that global European player. We've heard from Mario Draghi, we've heard from many others about the need for European champions in banking, and Deutsche Bank really wants to position itself in order to be that major player on the global stage. That being said, the challenge ahead is large. When you go back about 20, 25 years, Deutsche Bank was only about half as big, or maybe a third the size of JP Morgan was back then, the biggest bank in the United States. Today, JP Morgan is an $800 billion company, and Deutsche Bank is, 13 times smaller than JP Morgan. So that is sort of the scale of the challenge ahead for some of these businesses, but that is what they'd like to address in this new European Commission, focus on competitiveness, and with this large stimulus package attached from the German government.
Ollie, great stuff. Thank you very much indeed. Ollie Crook joining us out of Berlin. Some great interviews coming through from that Germany Invest session yesterday. Let's talk more about what is happening in the UK right now and try and figure out exactly kind of where we're going. The data this morning are really tough. And it's going to be really interesting to see exactly kind of what we're doing with this. We need to figure this out a bit more. But the gilt market reaction this morning is quite interesting. And I'm fascinated to see exactly how ultimately the gilts are going to be reacting to this.
Yeah, yield higher at the long end, or across the curve actually, in Britain, off the back of these public borrowing figures, billions more than expected because of higher debt costs. It looks like the Chancellor's going to have to raise taxes when it comes to the autumn. Can they get away with that politically? It seems like the UK really in a doom loop here.
We'll talk about it more in just a moment. We'll come back in just a second and deal with A, the data we've had out this morning, and B, what the implications are for the autumn budget and Chancellor Rachel Reeves. We'll do that in just a second. This is Bloomberg.
For Trung Jobin, you're never too young to learn AI. That's why he's urging the government for school kids as young as 6 to be taught how to use it.
Within this system, from first grade, they all start with the AI education. They play 4 years, just playing. And then from 5th grade, they start to develop AI by themselves. And STEM and robotics, I see very clearly how Vietnam should be in future. Vietnam just about 100 million people, young people, good education, and latest technology. That's the only way to go. Education not contribute much profit for equity, but from the country point of view, that's most useful contribution, what equity should do. And today we're thinking about every kids, not in cities like Hanoi or Ho Chi Minh City, but kids in the countryside should got the good education. That's what we're going to do now.
So you're leapfrogging?
Yes, exactly.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
I'd generally point out that the fiscal headroom we put in the budget was considerably more than the last government put in their last budget by some measure. But then there was a lot of fluctuation in the early part of this year, particularly with conflicts in different parts of the world, but also with the immediate after effects of the tariff decisions that were being taken, for example, in America.
UK Prime Minister Keir Starmer speaking to the liaison committee of the House of Commons yesterday, and some of that volatility he was talking about leading to the government having to borrow more then. So the UK government borrowing by the government came in worse than forecast in June. That is higher than expected, with a surge in debt interest payments sending the budget deficit to £20.7 billion. It's a setback for Chancellor of the Exchequer Rachel Reeves that will fan speculation over potential tax hikes to shore up the public finances. For more, let's bring in Bloomberg's Sam Unstead. And Sam, sometimes we talk about, gilt yields going higher or lower and what this might do to the headroom, and it sort of doesn't matter too much until maybe we have another event where the OBR is going to make another estimate of headroom. But it starts to really matter when it influences the amount of money that it costs the government to service its debt. So what do you make of this announcement this morning, then, that the borrowing came in more than forecast, that the budget deficit, 20.7 billion, well above what was expected?
Yeah, well above what was expected. And also, so not only interest payments driving it up, but although tax revenue went higher, it was lower than forecast. So that combination is not good for the government. That's not what they would want to see. As far as it goes for gilt markets, we've had, over the course of this year already, a couple of quite idiosyncratic, quite strange blow-ups in the gilt market, where we've had a lot of volatility come through for what appear to be kind of quite vague reasons. This is quite a solid reason for people to get a bit more worried. And as you come round to the budget, I think what you're now facing is a kind of summer. We've got quite low liquidity anyway, and now quite a lot of uncertainty about what may or may not happen when we come round to the autumn statement.
Well, the Prime Minister in that clip was kind of blaming international factors, external factors when it comes to these gilt market sell-offs. But, the last time it came down to, unfortunately, the Chancellor's tears.
Yeah.
Is it possible to see what could, on the horizon, trigger the next gilt market sell-off that's a domestic thing?
Well, I think, so you've got, with the gilt market, both a kind of idiosyncratic UK-related issue with the fiscal outlook here, with the rules, with this kind of constant uncertainty about how much headroom there is. They are right that there has been also international factor, kind of general repricing of bond markets over the course of the last year. But that's not a good thing. Like, that's not something to take as any kind of win or to offer up as an excuse, because the fact is that still sends borrowing costs higher, and the headroom here is weak. The headroom here is nowhere near where they want it to be. So if you've got international factors driving it up, things that are outside of the UK government's control, that's not a good thing.
And I suppose that's the point of the headroom conversation. I don't remember years ago we didn't used to talk so much about headroom, but the point is, with small headroom, it leaves you more vulnerable to those international dynamics.
That's why it's not a good thing.
And he's saying there that he's left more than the Conservatives did, but it's no more than the Labour Party left the last time. And so is that responsible when you know that you're in an environment where there could be these international headwinds?
So which taxes are going up?
That's the question. No, but that is the question over the course of the next couple of months. So they are going to have to either increase taxes, and probably they will have to do both increase taxes and find more spending cuts. So the likelihood is the next 2 months you're going to get a lot of speculation about where that may or may not be. If they do tax rises, I think the most likely areas you're going to see is things like duty, if you like sin taxes, kind of cigarettes, alcohol, anything like that. But most of it as well would be backloaded. The income tax threshold probably gets frozen again. Yeah, the drag.
And then we just enter this little weird world where one party says that taxes went up and the other party said that they didn't, and it's just based on entirely different definitions of what a tax rise is.
Yeah. And
Save us, Sam.
And then I think the thing that you're also going to continually see, and I've been seeing this more and more from kind of economists and strategists coming across my inbox, is questions about, do they need to change the fiscal rules, right? But with the gilt market where it is, and given the kind of general nervousness and uncertainty, if they were to do that and in any way fumble it, which, let's be honest, could well happen.
They could do that.
They're more than capable of achieving. Then you could see a really significant move.
Maybe the time to do that is when you're in a position of strength.
Exactly. So you'd be trying to take these rules, which even yesterday they said are ironclad. We're not going to change these rules. You'd be trying to change them at a time when the market really doesn't want you to do it.
Is there a belief that the government is now incapable of driving efficiency and spending? You look at two sides of the ledger. Every time they've tried to create some sort of a saving, it's not happened. They just have an inability to be able to do that. There are so many savings you could make in the UK. There is so much efficiency that could be created.
Yeah.
But this government doesn't seem, or any government doesn't seem to have the capability to deliver upon that.
Yeah, if we're talking specifically about this government, the welfare thing showed you exactly how difficult it will be to come after almost any spending cuts at all that in any way will offend one side of the party, right? So they are stuck in this in this sort of position, the government, where they want to make these cuts, but a big side of the party is going to go against them. Again, they don't want that because that creates more instability, and any instability at the moment for gilt markets is bad. So yeah, I mean, they are very much between a rock and a hard place.
Yeah, the language that was used in that session by the Labour Work and Pensions Committee Chair Debbie Abrams about those reform cuts yesterday, saying she was ashamed about it. The politics of the Labour Party is just not going to allow that many more
But could you
spending
have,
cuts.
efficiency seems to be, the way you maybe solve that problem is not by making cuts, but making efficiencies. Cuts and efficiencies are two different things.
But it requires
not
investment.
if you're a certain Labour, if you're many Labour MPs.
No, if you can deliver the same service with less resources, that is efficiency. And that ultimately, that is where the UK is going to have to go. How do you achieve that? You are hearing certain NHS trusts talking about, I can't remember exactly how the structure is now, but they're talking about the idea that maybe actually AI can help in terms of the way you run a hospital. That is the area in which maybe we do need to see help. But again, government's struggling with this.
I grant you, maybe it's a different story if you bring in the word AI, but for many, efficiency and austerity are the same thing. Bloomberg Salmon said, we thank you so much for bringing us all of that latest. Not cheering us up too much, but we'll let you get back to your porridge. Let's tell you what else is coming up on the day book for the rest of the day. At 10 a.m. London time, we get the Bank of England's Andrew Bailey testifying on financial stability. We've got lots of US earnings coming through. GM and Coca-Cola have been reporting before the market opened. 3 p.m. London time, we get US new home sales, a rare bit of eco data this week from the US. And then European earnings coming out as well. ASM International and SAP after the bell as well. But let's bring in Bloomberg's Valerie Teitel for more. Val, what are you watching as a potential catalyst? Because we really need one. We need some excitement at this point.
I think I'm going to be watching the GM earnings, especially just to maybe some beginning color on how the auto industry is dealing with these tariffs. I thought it was very interesting that even though we got this update from Stellantis of a first half loss, shares still ended up in the green. So it's going to be really hard to parse through just what the market is going to be taking away from these warnings on tariffs, from the numbers on tariffs that some of these automakers are speaking about. But GM, out of the U.S. automakers, is one that is more exposed than others to the auto tariffs. So I think what they announced today in their earnings results could be a good guide on what we could perhaps hear from other automakers later this week.
And expectations are quite low. The Stellantis story I thought was quite interesting, especially as a new CEO. What do you do when you're a new CEO? You come in, you kitchen sink the numbers. Nice lower base.
It wasn't my fault.
Yeah, we're going to start from down there. We're not going to start from up here. This is where we want to be ultimately in a year, 2 years' time. But yeah, but the market is looking at these numbers that are still coming through, and we're waiting tech. So tech's about to arrive as well. So that's going to be a really big feature of the landscape because it's been such a solid driver of this market as well. I just kind of I wonder if maybe that's where the wobble comes through. Expectations are quite high again.
Well, we do have Alphabet beginning the Mag 7 on Wednesday, as well as Tesla, but you can maybe count that into the more tariff-exposed sectors. But the one thing about this AI trade is it's not really exposed to tariffs. No. So maybe that can be the thing that can drag the U.S. equity market again to more highs. We know that the AI trade has been a big part of the equity rally this year, and it does seem like a lot of these tech-focused, AI-focused companies aren't afraid to be spending money, to be investing in CapEx. We know that the data center spend, even the energy behind the data centers, there's not a lot of fear in terms of investing for that kind of outcome, for that kind of future.
I'm definitely more nervous about August 1st than I was 2 hours ago when I sat down at this desk, Valerie. So I don't know what achieved that.
It was Hugh reminding you that payrolls are on the same day.
August 1st, same day. But it's not, just like we saw in early July, we have this date, August 1st, but in early July that got moved and fudged, and there were various announcements beforehand that meant that actually July 9th, was not such a big deal.
The market can just basically ignore it up until 24 hours before a deadline, and then we start worrying. Okay. So maybe it'll be that
that makes me feel better. Thank you.
We'll be worrying. We'll be paying attention to it. Valerie, great stuff. Thank you very much indeed. We've got the CEO of Norsk Hydro coming up. It's a really interesting day of corporate earnings. That interview is at 9:30 a.m. Tom's going to be taking you through that interview, plus also the rest of the Pulse. That is up next. Hope you enjoy the show. This is Bloomberg.
It's the world's second-largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacqua in Sintra, Portugal, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Stocks waver ahead of mega-cap tech earnings this week after yet another Wall Street record as trade uncertainty weighs on markets. The U.S. Treasury Secretary urges a review of the Fed's building renovation and policy mission creep as Washington ramps up the pressure on Jerome Powell. Plus, the UK borrows billions more than expected in June in another setback for the government's efforts to shore up the public finances. Let's check in on the markets then after a 14th record high for the S&P 500 at the close yesterday, year to date, the 9th, by the way, in just the last month. Looking a little bit more cautious, a little bit more on the back heels to some extent, maybe a bit of profit taking, just pointing lower by 0.1%. Looking for the next catalyst. Will it come from those mega tech earnings then? We'll be breaking those for you, of course, throughout the week. The Japanese yen in focus as the Prime Minister clings on to power. Will there be more fiscal spending? That continues to be a topic of discussion and a focus for investors with exposure to Japan. 147 right now. Bit of softness for the Japanese currency, down 0.2 versus the US dollar. And I pulled up the 10-year UK yield for you on the back of the story around the debt load and the deficit just expanding more than expected. Tax increases from this Chancellor expected now amongst many a commentator when it comes to the UK. 463 right now on the benchmark 10-year. Yields currently up 3 basis points. Bit of selling pressure across the curve in the UK. Let's take a look at the European markets map, though. The FTSE 100, despite the concerns about the UK deficit, notching up a fresh record yesterday. The FTSE 100 up about 10% year to date. Today, a little softer here in the UK, just down 0.1%. Some selling pressure coming through over in France with the CAC 40 off 0.5%. And the DAX in Germany down 0.8%. Basic resources amongst the key gainers across the sectors. On the downside, you're seeing a bit of pressure on tech. We start the show right now. This is The Pulse.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to the Pulse. I'm Tom McKenzie in London, in for Francine Loacker. And US stocks have extended their record high, as we mentioned yesterday, ahead of a key week, of course, for earnings. Today, futures a little softer, as I mentioned. Let's bring in Bloomberg's Valerie Teitel right now for a gauge on these markets. Valerie, what is the next catalyst? It is all about the earnings story. What are you watching?
Yeah, it might all be about the earnings story, and especially how the tariff-related earnings story goes from here. But the S&P 500 closing above the 6,300 level for the first time in its history. We're now up 26% since those lows in mid-April. Now, note the breadth of this rally, Tom, still has not been that great. Only around 8% of S&P 500 stocks are trading around their 52-week high, their 1-week high. But the one thing I found really interesting is what seems to be driving this latest leg up in the equity market is a dampening of volatility. We've gone nearly a month, Tom, without a plus or minus 1% swing in the S&P 500. It just seems like the equity market is getting used to this kind of policy uncertainty. We're not seeing these kind of wild swings that we did see earlier in the year. So this dampening of volatility is allowing us to reach these new record highs. I also thought it was interesting in yesterday's price action that, yes, we did end in the green on the equity market, but we were seeing these kind of frothy stocks really take a hit. In yesterday's session, things like non-profitable tech were down quite a bit. We also had things like the SPAC index, the retail favorites, the most shorted stocks did end their rally yesterday, maybe pointing to the fact that it might be a bit harder to notch these record highs moving forward. But the focus does shift to earnings. Now, we do have one of the big auto names reporting earnings today. That's GM reporting before the bell. With this focus now being on the tariff-related sectors, I think we could have a shift in narrative, either of one of corporate resiliency against these tariffs or ones of companies struggle to adjust. Tom.
Okay, the tariff pass-through may be in focus, particularly with the automakers, as you say. Subdued volatility, at least for now, when it comes to these markets, and a lack of breadth, bad breadth in these markets. Bloomberg's Valerie Teitel, thank you very much indeed. Maybe the volatility will pick up if there's additional pressure on the Fed. We continue to see that. The US Treasury Secretary calling now for a review of the decision to renovate parts of the Federal Reserve's headquarters in Washington. In a post on X, Scott Bessent said all of the Fed's, quote, non-monetary operations should be looked at, adding that significant mission creep could jeopardize the Fed's core monetary policy mission. Bloomberg's EMEA news director, Ros Madsen, is here with the details in terms of what we've been hearing from Scott Bessent. It seems like Scott Bessent is now joining other members of the administration in putting pressure on Jay Powell, and someone that clearly the markets have seen as something of a protector when it comes to the question of Fed independence and particularly Jay Powell's role.
Well, that's right. He's been very vocal in the need to preserve the Fed independence, but also he's very attuned to the need to be in lockstep with his boss, Donald Trump, on things. I mean, Donald Trump has made it clear that he sees Bessent as staying in his role, but it wouldn't be out of bounds for Bessent to be somewhat auditioning to replace Jay Powell even. But what we've seen, the experience of Elon Musk is quite telling. You don't get ahead of your boss, and you don't certainly be driving the public agenda. And these were reports that Bessent had privately briefed Donald Trump against attempting to fire Jay Powell. Donald Trump came out publicly and said, hang on, no one briefs me and tells me how things are. So a sense that, Bessent is reading the room there and very much wanting to be, at least publicly, in lockstep with Donald Trump, being critical of the Fed, questioning this renovation, but also interestingly saying, has the Fed got over its skis in general and in how it's interacting on non-monetary policy areas? Is it extended its remit? He was very vague about that, but a sense that perhaps it's stretching itself too far. And the question of, should we assess whether the Fed's been successful at all? I mean, I don't know how you measure the Fed and how successful it's been, but certainly the language is very much in lockstep with Donald Trump.
All of this happening at a time, of course, where the Treasury Secretary is also dealing with trade negotiations, and we're about 10 days away, of course, from that August the 1st deadline on those additional tariffs. Where do things stand on that front, Ros?
Well, we know that negotiations are happening at quite a frantic pace. Japan was there yesterday. We know talks are coming with South Korea and other nations. It's interesting to see in Asia, particularly Japan, South Korea, Malaysia, still those fundamental questions of these bespoke, important industries that are really part of the national psyche in these countries. So you've got beef and agriculture. For example, rice in South Korea. You've got agriculture again in Japan, rice. We just had a very tricky upper house election there for the government. In Malaysia, it's about not wanting to cut subsidies for fishermen because fishing is so much part, not of the economy necessarily, but of the national psyche and therefore of politics. And if you've got one eye on your voting blocks, you're going to be very attuned to that. So the trick is, how do you, in a way, give concessions to the US that don't give away the protectiveness of those sectors? So perhaps you talk about joint investment in energy instead. Let's do gas projects together. Let's build ships together, but let's not really come at stuff that's fundamental like beef, rice, and fishermen.
Okay, Ros Manson, thank you very much indeed. Our EMEA News Director on some of the sticking blocks and still the stumbling blocks, I should say, and sticking points around these trade negotiations as we count down, of course, to August the 1st. Ros, thank you. Joining me now for a deeper dive in terms of the economic impact of tariffs, but also AI as well, is Morgan Stanley's Chief European Equity Strategist, Marina Zavalok. Marina, thank you for joining us around the desk. And we will get to this really fascinating piece of research that you and the team have been doing in terms of AI adoption in Europe and how to position, how to invest around that theme. But I want to start more broadly before we get there in terms of what we're seeing across these equity markets. Today, a little bit subdued, maybe looking for the next driver, the next catalyst. Are these equity markets, the US, Europe, given the gains that we've seen year to date, are they driven by fundamentals at this point, or is this a momentum trade?
Under the surface, there's a lot of momentum. So we're seeing, I mean, we prefer also those kind of AI-exposed sectors, the sectors that have really worked already this year. And the sectors that haven't worked this year are underperforming. So the momentum is continuing. The biggest feedback I've had on some of our sector picks has been, well, it's obvious, but that's what's happening. The obvious is continuing to work. And
like defense, for example?
Defense is a little bit more choppy, but like AI in particular has been a huge theme this earnings season in the US, in Europe as well.
Do you think, on the question of momentum, does the momentum swing back? European stocks had this outperformance. There's been a bit of a catch-up now. Both the S&P 500 and the Stocks 60, I should say the Stock 600 is currently up about, though both indexes up about 6 or 7% year to date. So it's been a bit of catch-up for the US stocks. Does the momentum swing back, with that focus on tech, does the momentum swing back to the US in the second half of this year?
Yeah, it's already begun.
Right.
So the momentum has swung back to the US. We think that continues for now. The US just has much more AI exposure than Europe does. So that will continue to drive things. And then that's coming through in earnings as well. So at this point, Europe has almost 0% earnings growth. In local currency terms, the US is 9%. So that divergence.
How much is priced in on tariffs when it comes to the 0%, almost 0% earnings growth for European stocks?
I think 10% is priced, 10% tariffs. If we get higher than that, then we're going to get some downgrades. But the tariffs exposure in Europe, something we've been saying a lot, is quite idiosyncratic. You have about 6% of revenues in Europe that are directly exposed to tariffs, and then much more broadly in terms of the kind of lingering uncertainty and direct effects of tariffs.
Does stimulus coming through from Germany predominantly and some others, does that offset the tariff impact?
Not yet. That's the problem.
Is it a 2026 story?
You'll start to see the trickle through into earnings in 2026, but more kind of in the back end of the year.
Yeah.
And then really it's actually a 2028 story because a lot of the projects have 3-year lead times. So you'll see more of the earnings impact in 2027, and then the big blowout in earnings will only come in 2028 for Europe.
Okay, really interesting. So a bit of a pushback in terms of the time frame.
This is part of the problem of the relative performance.
The relative performance. Okay, 2028 maybe is what you want to be thinking about. On that return on investment, it's been a key question, hasn't it, around the investment into AI. But you say that the adoption in Europe is happening now in terms of AI across different sectors and different companies, and you are starting to see a material impact in terms of ROI.
Yes. Yeah, so far, obviously you can quantify the benefits to enablers really easily. So that's what the market's been focused on. Adoption, like for myself, for a strategist, it is very hard to quantify what kind of benefits you're getting from adoption. Even at the company level, it's hard for analysts to quantify that. What we've done recently is we've taken this mapping Morgan Stanley has done 4 times, just published the latest version, and we've looked at adopters in Europe and how their earnings and their returns are trending over time. and comparing that to the overall market, to their respective sectors. And basically, you are starting to get evidence from a returns perspective, from an earnings perspective of outperformance of AI adopters. So I can, for the first time, say that there's very credible evidence that ROI for adopters is finally coming through.
Which sectors are standing out? How sector agnostic is this? Or is it in specific sectors where the adoption is happening more rapidly and they're starting to see that ROI?
Yeah, there are some sectors with more breadth of adoption in Europe. So financials is a sector with a lot of adoption, banks, software obviously has a lot of adopters, business services, more services sectors. But it's quite broad, and what was interesting when we were doing this analysis is that we actually put together a list of 20 stocks that are leading the way on adoption. And when I went to our different sector analysts, they all said we have 1, maybe 3 stocks in our sector that are really ahead of the game. So within sectors, you have some dispersion as well.
Okay, so how do you play that AI adoption story in Europe then?
It's idiosyncratic. So our group of adopters that we analyzed in the note, there are 120 stocks in Europe that we cover that have at least moderate exposure, according to our analysts, to either adoption or adoption enabling. And we also we screen for neutral to high pricing power because we want them to be able to hold on to the margin gains. So 120 stocks, you can look at a group of those, or we have a list of 20 stocks that we published in our note, which are, as I said, within the sectors, the leaders. But you can't do it really through the index.
Okay. What about those European companies that are being disrupted themselves by AI and are vulnerable to AI?
Yeah, that's a really good question. So now that question is coming up more and more. We've also looked at disrupted stocks. So far, in our coverage of over 500 stocks in Europe, there are only 4 stocks that our analysts have categorized as disrupted. Now, that might be a little bit optimistic. So there are also 30 stocks that are categorized as wildcard. So the analysts are not sure, but they could be disrupted. It's not completely clear. And if you combine wildcard and disrupted stocks, and you look at their earnings trends and their performance, basically their earnings are underperforming definitely the AI adopters and even the European index in the last year. And they also are derating.
Okay, so there are a basket of stocks.
You have a significant divergence between those adopters and the disrupted and wildcard.
What is the adoption in Europe looking like versus the adoption in the US? Because sometimes I speak to people, CEOs of tech startups here, and they say if they've got revenue stream in the US, they're seeing much more rapid adoption in the US, shorter time frames. The CFOs of their client customers, customer companies, much more willing to spend and take a gamble and take a risk, essentially, on their products. Is that playing out? What is the adoption story, Europe versus the US right now?
It depends if you look at as a percentage of companies in Europe or as a percentage of the index weight. So if you're looking as a percentage of the index weight, our large cap multinational companies are adopting as quickly as your standard large cap US companies. The point we've made in our research and we've been making is that the US has obviously a lot more enablers than Europe does. So over 40% of the index in the US on a weighted basis is exposed to enablers. And those have been the stocks that have seen the fruits of AI first and have really benefited. Europe has much fewer enablers, but that also leaves us a lot more room for adoption exposure in our index. So our adopter exposure in our index is 70% weight of the index. So if you're starting to broaden out, you get AI diffusion, starting to see ROI come through for adopters, then Europe really stands to benefit. And then our adopters, they trade at almost a 30% discount to the equivalent adopters in the US, despite having very similar earnings trends.
Okay, from the enablers in the US to the adopters in Europe and that valuation play as well. Marina, thank you very much indeed. Really interesting piece of research and work that's been done at the Morgan Stanley team, of course. Chief European Equity Strategist Marina Zavala with a look at how AI is being adopted and that impact, material impact now in terms of ROI. Coming up, as German companies pledge to invest billions of euros in new projects, will it be enough to revive Europe's biggest economy? We're going to talk to Allianz's senior economist about that. That's coming up. This is Bloomberg.
up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Earnings season is here.
The focus is on the European earnings space.
A busy week of corporate earnings.
We're going to be deeply into a lot of these earnings stories.
Bloomberg is first to break the numbers.
Santander, Caixa, Soc Gen,
Deutsche Bank, HSBC, BBVA.
A slew of bank earnings already out.
With the smartest insights.
There's an earnings revolution going on.
Markets are going to be driven more by earnings.
It looks like the worst is behind us.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back now. More than 60 of Germany's leading companies have pledged to invest at least 100 billion euros in new projects to help lift Europe's biggest economy out of stagnation. The corporate vote of confidence comes as Chancellor Friedrich Merz's government has seen its lead narrow in recent polls. Let's bring in right now Yasmin Groschel, senior economist at Allianz, for a view on the German economy, the stimulus focus, of course, the fiscal spend, and that investment impulse. Yasmin, thank you for joining us this morning. When does that spend on the private level and the public level, the state level, start to have a material impact on the growth trajectory of Germany?
Yeah, so it will start to have an impact this year, but only marginally. But really, it will have an impact for next year. Also, on the government side, with the higher depreciation rates, with the tax cuts on R&D. So we're bringing up government investments, but we also will bring up private investments with that. The depreciation rate itself could actually add 1.1% of more investments, and with that, about 0.2 percentage points of GDP to next year's growth rate.
What would tariffs do to that projection, Yasmin? Tariffs of 30%, of course, have been threatened by President Trump. We're counting down to the deadline on August the 1st. What assumptions are you making about ultimately where those tariffs settle as you try and project forward on this German economy?
Yeah, so I think we have to see what happens on August 1st. Currently, we count on the 30% tariffs that have been announced. This will hit the German economy hard, obviously, especially in key sectors, machinery, pharma, auto, and chemicals. But we believe that the EU will actually strike a deal with the US and finally then settle down on a rate around 12%, which is still much higher than what we had before. Even before Liberation Day, they already went up from about 1.2% to 4%, but 12% is really hard, and it will hit the European economy, especially the German economy, which is one of the most exposed ones to the US besides Ireland.
Yeah, indeed. What would 12% tariffs then mean for the labour market, for jobs? How many jobs would be hit in that scenario?
Yeah, there's a lot of value add in these exports and a lot of job exposure in that. So what we count is that there could be around 500,000 jobs basically at risk within the EU, not only in Germany, but overall in the EU. And that could actually drive up the unemployment rate across the EU between 0.1 and 0.4 percentage points if this actually hits the EU on a longer term basis.
Okay, so up to 500,000 jobs at risk, potentially across the EU. Yasmin, when we think about the tariff impact and to what extent that 12%, and that's the forecast from you and the team at Allianz, to what extent that 12% could be offset by the spending that's coming through from Germany, how do you think about that offset that we may see?
Yeah, so for Germany, we see that this year, basically, if the tariffs hit, it will be basically half a year. And then we have the aluminium and steel tariffs, the auto tariffs, and potentially also the pharma tariffs now. So this year, basically, the spend from the government, so the higher defense spending, the stimulus they bring from the higher depreciation rate of 30%, this will basically more or less offset the changes in the tariffs, so in the higher trade costs. So basically, a little bit more of growth, but just 0.1 percentage point more is offset basically to the trade war effects. And then for next year, we see basically a trade effect on growth of about minus 0.5% for Germany, and the growth stimulus is larger. So only from the infrastructure package, for example, we see about 0.7 percentage points on growth added. So overall, we land around 1.3%. So the government spending, the fiscal stimulus will basically drive up the German economy, but the trade war will drag it down, but not fully.
Okay, really interesting that the fiscal stimulus will do more in terms of reviving the growth picture for Germany and will more than offset the tariff impact. What do we, in terms of how we're thinking about how the changes and how the reform agenda is pushed through in Germany? I speak to German CEOs and they'll say, yes, the fiscal spending, the spend on infrastructure, the spend on defense is welcome, but we want to see changes implemented. It's about implementation and it's about structural reform. Are they going to be matching the spend with structural reform?
So absolutely, that is one of the key topics. So the fiscal stimulus can actually drive up the economy in the short term, but it doesn't help in the long term, especially with the green transformation, with demographic changes. So currently, we don't see too much of structural reforms, meaning the labor market, the health system, and the pension system. And this is really something that we feel is missing at the moment, and where more has to come from Berlin, from the new government, to actually also pick up potential growth in the future, because basically the wave of the demographic change will only come towards 2029. And until then, these short-term fiscal stimulus can help, but they can't offset all these structural changes, and this is still missing.
Okay, so the need for structural reforms to power longer-term growth for Germany. As we think about a stronger German economy, even in the face of those additional potential tariffs, Yasmin, what are the ripple effects? Which other European nations are likely to benefit the most from that uptick in spend and growth in Germany?
Yeah, so we definitely have other nations that are intertwined in the supply chain. So Northern Italy is one of the regions that will benefit from a stronger Germany, Austria, obviously, but also Eastern European countries like Poland, Hungary, and Slovakia, which are strongly connected to the German market overall, but especially also in the auto supply chain. So they can benefit from a stronger Germany in general. But from the fiscal stimulus, for example, from the infrastructure package, we also see the Eastern European countries potentially to benefit, because there's capacity constraints on the construction sector in Germany, especially also on civil engineering, but also in services related to construction. And these could basically come from Eastern European countries, which could then see stronger growth because of a stronger Germany. But overall, I have to say all of Europe would basically benefit from a stronger Germany because of the trade connections we have in the single market.
Okay, Yasmin Groschel, senior economist at Allianz, mapping out the future growth picture for Germany amidst, of course, the tariff uncertainty and what it could mean for the broader Eurozone. Thank you. Coming up, Norsk Hydro has adjusted second quarter earnings, beating estimates. We're going to talk to the company's CEO. That is next. This is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Where is do we have a camera, or do we don't want to lose you, Emily, and all of this.
Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. Welcome to the Pulse. I'm Tom McKenzie in London. These are your top stories. Stocks waver ahead of mega cap tech earnings this week after yet another Wall Street record as trade uncertainty weighs on markets. US Treasury Secretary urges a review of the Fed's building renovation and policy mission creep as Washington ramps up the pressure on Jerome Powell. Plus, the UK borrows billions more than expected in June in another setback for the government's efforts to shore up the public finances. To earnings now, Norsk Hydro shares, one of the biggest gainers on the Stoxx 600 this morning. This as the aluminium supplier reported adjusted second quarter earnings ahead of analyst estimates. We can speak now to the CEO of Norsk Hydro, Eivind Skallevik. Eivind, thank you very much indeed, sir, for your time in the back of these earnings. Obviously, there's going to be a focus in terms of the tariff impacts. You are exposed at least to the headwinds around trade. You've come through with this beat. What are you seeing in terms of the tariff impact right now across the business?
Well, I think first and foremost, very happy to deliver another very strong financial quarter, given all the market uncertainties, as you point to. Our company is very little directly impacted by the tariffs as such. We're mostly European, and then what we do in the US is mostly, let's say, based on sourcing locally produced raw materials and then selling to local markets in the US. So not much of a direct impact, more concerned than about maybe indirect impacts in terms of general economic growth in the world.
And on that point, are you seeing your industrial clients, are you seeing any evidence your industrial clients are starting to pull back and be a little bit more conservative as a result of some of those challenges, some of that volatility?
We're actually quite happy with the downstream markets as we see them now in Q2 and the pace that we have into Q3. Seems like markets have been bottoming out, and we actually expect a little bit of uplift in Q3 compared to Q3 last year. So slightly optimistic, at least in terms that we've seen the bottom so far.
You're a key supplier, of course, to the auto market. We know that it's challenged on a multiple factors and multiple different levels, and particularly around tariffs. What is the auto sector looking to you like right now?
So we are exposed to many markets. So for us, the building and construction market now seems to be picking up somewhat. On the automotive side, the headwinds seems to be slowing down at least. So again, not in positive territory, but at least the negative trend that we saw for the first half seems to be slowing down somewhat going into the second half.
And what steps are you and the team putting into place specifically across the business in this time of heightened uncertainty on the trade front?
So we're really addressing this in two ways, because for us as a company, it's always been important to influence what we can influence ourselves. What we've been looking at now hard for in the second half is really the capital expenditure, so the investments that we plan to do. So we plan to take that down by 1.5 billion Norwegian kroner, down from 15 to 13.5 billion for the year, which is important in terms of cash flow. The second part that we're doing is also that we are reviewing what you can call white-collar workforce that we have in the company to ensure that we have a workforce that is aligned with the activity levels that we have also going forward.
What does that give us? Give us some details then in terms of what that means. When you focus on the white-collar workforce, the office workers across the business, how many jobs do you expect to reduce? What does it mean for headcount in the next 12 months, for example?
Sure. So that is, of course, the big question that we haven't announced yet. What we have done so far is really to establish a hiring freeze, which we did about a month ago. And then we will spend the summer reviewing at what level the future workforce should be. And then we will announce that when we come back at some point after the summer break.
Okay, so we watch for that detail after the summer break. In terms of the stimulus, we've been talking about the stimulus story in Germany this morning with our guests. Are you starting to see the impact? Do you expect that additional spending on infrastructure, on defence in Germany to have a material impact in terms of, as a growth demand driver in the next 6 to 12 months, or maybe further out into 2026? Are you starting to position for that?
I think this is a really important initiative for Europe and obviously for Germany in particular. And Germany should be the growth engine, so to speak, in Europe, given its size. So it's a very important initiative, but I think we need to see this come into fruition. It needs to come into activities. We really haven't seen it yet. Probably, and we expect to see something at the tail end of 2025, but more likely well into 2026 before we see the impacts of the planned spending.
Okay, more of a 2026 story for you and the team at Norsk Hydro. Do you expect it to be a significant demand driver, though, by that period of time?
I do. Aluminium goes into a lot of different products, whether you talk about energy transition in terms of cables, solar parks, wind parks, whether you talk about infrastructure investments, you will find aluminium in all of these applications.
When it comes to the US market, you say that you've seen a tick up in terms of order bookings among some of your clients, or in that part of the market at least. How big of an increase are you seeing in terms of bookings in the US market?
So we see an uptick, so we are careful in guiding sort of specific numbers, but we see an uptick coming into Q3, driven from two things, we believe. One is that the economic activity in isolation in the US is holding up quite well. And second part of this, we are the biggest extrusion company in the US. And as US are cutting imports of extrusions from overseas, we will be a natural company to go to replace those orders with domestically produced goods.
Okay, so that's the US market. In terms of the breakdown, the particular units of the business, there was a lot of focus from the analysts out there on the extrusions division. So poles, tubing, building systems. You're restructuring that unit. You're making some changes. Where are you in that journey?
So that's something we will continue to evaluate. We have curtailed and mothballed some activities in Europe, and we will continue to monitor that as we see how demand is evolving. Today we have more capacity than what we produce, so there's still good room in the production portfolio that we have to pick up any new orders coming in as we see it.
Alumina prices obviously have fallen. Do you have a steer in terms of a trajectory? What are you factoring in? What estimates are you making about alumina prices through the end of the year and into 2026?
Yeah, I think it's important to remember why alumina prices spiked in fourth quarter of last year. That, of course, was driven primarily by disruptions on the production side. Those disruptions have been remedied. There are some curtailed plants or closed plants, so they will be out. But then you have new plants coming on stream during 2025 and into 2026, which means today that we have pretty much a balanced market. So the spot price that we have today probably is also what we would look for in the third quarter, unless there are unexpected events, again, as we saw last year.
Okay. Ivan Kalavik, CEO of Norsk Hydro, on the back of those earnings. Coming through with a beat, sir. Thank you very much indeed for your time. Now to Japan, where Prime Minister Shigeru Ishiba has vowed to stay in office following a second election setback in less than a year. Ishiba says he will now put all his efforts into negotiating a trade deal with the US. For more, let's bring in Bloomberg opinion columnist Gaurav Reddy for a take on this. Can Ishiba then remain in his job given the challenge that his party faced, the LDP, in these elections? No longer has a majority in that part of the parliament. How does he stay as prime minister given his eroded authority?
It's a very good question. I think the short answer is that there aren't a huge list of successors or people who want the job, particularly given the challenges that the party is facing and that the country is facing when you consider the issue of tariffs that are about to come into play in the coming days. Long term, it does seem unlikely that Ishiba is going to be able to hang on. As you said, he has said that he's going to stick with the job, but we've seen in the past, just as recently as a year ago, that can change very quickly if he loses internal support or if enough dissenters within the party start to draw out their knives and look for a target. At the end of the day, this election has been an absolute disaster for the LDP, and at some point he is going to have to take responsibility for that.
Okay, well, we'll see when that point is and what that looks like. Meanwhile, he's saying that he needs to be at the helm during these trade talks with the US, of course, as we face up to August the 1st as the deadline. We know conversations are continuing. Has there been any progress? Is this Prime Minister, Mr. Ishiba, likely to get a deal in time?
I think the short answer is that there hasn't been much progress at all. I was one of the people who thought that Japan would get, or would be one of the first countries to get, a good deal from the US. That hasn't transpired at all, and indeed Japan is being treated in a manner that you would not expect such a close ally and security partner of the US to be treated in. Ishiba has not been able to form a relationship with Trump the way that the late Shinzo Abe was during Trump's first term in office. And as the deadline is approaching, maybe that gets pushed down the road again, as has happened in the past. But there doesn't seem to be any, progress between the two parties. I don't think all of that is on Ishiba. I think some of the stuff that the US side is saying, particularly about, auto sales to Japan, just don't really have any grounding in reality. There's not really much that Japan can do about that. But certainly Ishiba's inability to forge a relationship with Trump doesn't appear to have improved prospects for a deal in the near term, and maybe what the country needs in order to get that deal is new leadership at the top.
Okay, Bloomberg opinion columnist Gaurav Reddy, thank you very much indeed on the challenges for the embattled Prime Minister of Japan, particularly as he faces up to those trade conversations and the countdown to that deadline. Gaurav, thank you. To the UK now. Government borrowing here came in worse than forecast in June, with a surge in debt interest payments, sending the budget deficit to £20.7 billion. It is, of course, another setback for Chancellor Rachel Reeves that will fan speculation over potential tax hikes to shore up the public finances. Bloomberg Opinion's Rosa Prince is with us for the details. In terms of the borrowing figures, though, how damaging is this for the Labour government now? It is in increasingly challenging territory when it comes to the fiscal picture of the UK.
Yeah, it just seems like every day brings more bad news for Rachel Reeves, doesn't it? The political summer starts after today, and I think that when our Parliament rises, and I think they'll all be glad for a break, because yet another problem on Rachel Reeves' desk. She's had blows to her chances of cutting public spending. If you remember those big rebellions from the Labour Party over plans to curtail welfare spending, to cut benefits for pensioners, and the sums just don't add up anymore for her. This figure that came in, it's a lot more than the OBR, the Office for Budget Responsibility, had predicted, and it's fueled by spending on debt payments, which is what she's been warning about all along, and trying to get the books to balance. The thing that they've been sort of putting all their eggs into is growth, but as we know, growth has been pretty insipid as well. So I think pretty much everyone was expecting tax rises to come down the track in the October budget, and now that almost seems nailed on.
Okay, and to your point, every day seems to be a new piece of news suggesting the tax rises have to be locked in now for this Chancellor, given that fiscal hole that she and the team faces. Meanwhile, on a longer-term story, arguably, we have Reform UK, of course, coming out, and they are polling in line with or above the governing Labour Party, alongside the Labour Party, not coordinated, of course, but both key parties, of course, now talking about possibly, or at least opening the door to an extended retirement age. We may all be working a little bit longer, partly because of that drag on the finances.
Yeah, well, this would be something that perhaps the government could do to sort of get some money in the door. So Liz Kendall, who is the Work and Pensions Secretary, yesterday announced that she is exploring the option of extending or raising the pension age. Now, this is something that the government does review anyway, every 6 years, but the fact that she did it with a big speech, that she talked about the fact that we cannot afford our retirement savings as they are. Pensioners, so the leading charity on this, have estimated are already going to retire with about £800 a year less than they think they are, and that we all need to work for longer and save more during the time that we're working. So at the moment, the pension age is already due to rise to 67. That's coming down the track in 2026. After that, it's due to go up to 68. That's not coming until 2024. Could they bring that forward? That would actually possibly save them as much as $25 billion a year. Could they even go to 70, which is what we've just seen Denmark announce? Now, I think for that to work, we all need to be healthier longer. And although our age expectancy, life expectancy is rising again, it took a dip during COVID, it's not rising at that much of a rate. So, and I think the other thing that we're playing on politicians' minds, on Rachel Reeves' mind, is, does she really want to be going into an election in 4 years' time saying to everyone, I'm sorry, but your dreams of retiring soon are going to have to be put off for a year or two?
Yeah, well, you talked about the summer holidays, didn't you? We may have a few more summer holidays as we gear up for maybe working to, 70 in Denmark. But don't they do like, what, a 30-hour week in Denmark?
Something like that. Yeah. And also contrast that with the French, who they sort of knock it off at about 50, don't they? Not really, about 62, but yeah.
They're very protective of their retirement age, aren't they? Bloomberg opinion columnist Rosa Prince, thank you very much indeed on maybe all of us seeing our pensions and retirement being pushed back a few years, at least here in the UK. Also making news, the White House says President Donald Trump was caught off guard by Israel's bombing of Syria. It comes amid reports the US president is increasingly concerned by Prime Minister Benjamin Netanyahu's aggressive military efforts. The remarks come after a statement from 28 countries, including Britain, Japan, and several European nations, saying the war in Gaza must end now. The White House says it will remove the Wall Street Journal from the group of reporters travelling with the president on his upcoming trip to Scotland. This after the paper published a story alleging Donald Trump once sent a suggestive birthday letter to the late disgraced financier and sex offender Jeffrey Epstein. The president called the letter fake in a social media post. The Wall Street Journal has previously said they have full confidence in their reporting. The move comes days after Trump sued Dow Jones and Company, News Corp and Rupert Murdoch for libel over their report about the birthday letter. And Elon Musk's social media company X says it will resist what it calls a politically motivated probe by French authorities into alleged bias and manipulation of the platform's algorithm. In a statement, X said investigators have asked for access to its recommendation engine and data on user posts. Earlier this month, Paris prosecutors opened an investigation into suspected interference and fraudulent data extraction. Coming up, the latest tactic on Wall Street to help rich investors minimize capital gains tax liabilities. Our big take is next. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back. Microsoft rushing to roll out fixes for flaws in its SharePoint software after cybersecurity researchers and hackers have been able to steal sensitive information from governments and businesses. SharePoint is used by tens of thousands of organizations around the world to store and collaborate on documents. The US Department of Education is said to be among those targeted. Microsoft released a patch at the weekend, but is still working to fix other vulnerabilities. And BlackRock has told staff traveling to China for business trips to use temporary phones and not to take company laptops. It comes amid growing concern around travel to China after a Wells Fargo banker and a US Commerce Department employee were blocked from leaving the country. Let's bring in Bloomberg finance reporter Denise Wee for the details on this. Denise, what is the advice then that BlackRock is giving its team as they look to set foot in China?
So BlackRock has basically updated its travel policy. They haven't given a reason for this updates to the travel policy, but they've told their staff, not to bring laptops into China when they're going there for business travel, to bring loaner phones, and also not to use the iPhones or iPads, any company-issued iPhones, iPads, when they're visiting China. As I mentioned, they haven't given any reason, but this is happening as global firms are becoming more concerned about traveling to China and doing business in China at the moment.
Well, Denise, just expand on that. What specifically are the concerns? What's been going on that's led to this additional caution?
Well, I think we've seen, like recently, the Wells Fargo banker being subject to an exit ban. We don't have a lot of details on why she's been subject to this exit ban. There was also news of a U.S. Commerce Department employee that couldn't leave the country for several months. So we've seen a resurgence of these cases, and that's causing some concern among people visiting China, just about what's happening. And when these exit bans happen, there's often very little details. There's a lack of clarity. It often feels quite opaque. So I think that doesn't lead to reassurance among foreign fund managers, foreign banks that want to visit China for business.
Okay, Bloomberg's Denise Wee, thank you very much indeed on the reporting, of course, and Denise was bringing that story to us and reported it out in terms of BlackRock and some of the restrictions they're putting on their staff, at least some of the warnings around taking hardware devices, mobile phones and laptops into China. Security concerns, of course, one of the factors, as Denise was saying. Denise, thank you. Now, with Wall Street at record highs in terms of S&P 500, NASDAQ, of course, wealthy investors also looking for ways to lower their capital gains tax bills. In the US, that has led to a rise in a creative solution, including one using ETFs. That's the subject of today's Bloomberg Big Take. Our cross-asset markets reporter, Justina Lee, who's been reporting on this for us and has led the reporting on this story, joins us now for more. Justina, talk us through this particular ETF tax strategy. This is a strategy for reducing your tax liabilities using ETFs. This story is very well read right now amongst our clients. What is behind this tactic?
So the most important thing to remember is that in the U.S., if you trade within an ETF, it often doesn't incur capital gains tax. And the reason for that is even when you're selling, let's say NVIDIA, that's made you so much money, you're not selling it for cash. A lot of the time, the ETF is kind of swapping those shares with a market maker. And so increasingly, people have come up with this creative solution, which is that if you have a lot of appreciated stocks, you can just seed an ETF with those stocks. And once they enter the ETF, you can effectively trade them out kind of without paying your capital gains tax bill.
How popular is this method? How many people are taking advantage of, can we call it a loophole? This mechanism, how popular has this become?
So it's not very clear because these conversions are not labeled in any way, which I'm sure is kind of how the people like it. But, there are some clues here. For instance, I spoke to a lawyer that's really been leading the charge on these conversions. And he said he himself has worked on close to 100. And that's just been in the last few years or so. And kind of in terms of the ones we've been able to confirm, it does seem like there have been more. I know there's one coming this week that's going to be a few $100 million. And so it does feel like these are proliferating.
Are the regulators, are the tax authorities in the US, are they relaxed about this, or is it drawing scrutiny, criticism? How is this landing beyond the world of finance?
So these are all technically legal, and the reason is they're using kind of parts of the U.S. tax law that actually were not originally designed for ETFs, but they kind of have worked for the ETF structure. But for a lot of people, what's kind of been most controversial is that, so they're able to kind of swap out these assets when they're kind of meeting redemptions. But sometimes you don't have enough redemptions to kind of flesh out these appreciated assets. So a lot of the time, the fund will arrange like fake inflows and fake outflows in order to kind of facilitate this mechanism. And I think this part has been pretty controversial.
Justina, as you're sitting around the desk right now, great piece of reporting, really worth our viewers' time as well. You can find out on Bloomberg.com, of course, and on the terminal. I did want to get your view, given your hat that you wear around cross-asset reporting for us, on the broader market themes that we're seeing right now. We've got the earnings story coming up, of course. We've seen that run up, the S&P 500 notching a 14th record high by the end of the close yesterday, year to date. A little bit more subdued in terms of the equity and stock action today. What are you and the team looking for in terms of what could be the next drivers, the next catalysts in the days ahead?
I think what's really interesting is the markets feel pretty complacent right now, right? So that's why in a lot of cases, like Netflix, for instance, even when they've beat expectations, you're not seeing a huge response in the market. And I think that's because, investors have kind of priced in the fact that, Trump will chicken out and maybe also that Powell will chicken out, that ultimately we're going to get those rate cuts. And I think that's really been the focus of markets.
So we're thinking of Taco and Paco then. Okay, Trump will chicken out, maybe Jay Powell will chicken out. He's certainly under pressure, isn't he, the Fed chair? US futures right now putting down by 0.1% on the S&P 500, of course. Bloomberg's Justina Lee, thank you very much indeed in terms of the big take of the day and what else is rippling through these markets. US futures then down 0.1% after the record gains of yesterday. Dow Jones futures currently flat. Nasdaq 100 futures looking to lose about 62 points. Tech as a sector has been a bit under pressure here in the European session as well. We have the big earnings stories really kicking through as well in terms of the tech story with Alphabet, with Tesla. Later this week, we have the auto sector as well reporting out of the US, so that will give you some indication in terms of the tariff pass-through. We're counting down, of course, to that deadline of August the 1st in terms of Trump's threatened tariffs on trade partners. Up next, it is a Bloomberg Brief. Stay with us. This is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now
than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. It is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. More pressure. Treasury Secretary Scott Bessent calls for an exhaustive review of the Fed's building renovations. That as Chair Powell is set to speak at a banking conference later this morning. And the S&P 500 notches another record ahead of a busy day and busy week of earnings. It is 20% of the market cap of the S&P 500 that we'll be reporting. And into that, we've just had this slow summer melt-up. It's been pretty poor breath. I think something like only 8% of the S&P 500 has reached a one-year high alongside this index. We're a little bit weaker this morning. Emphasis on a little bit. S&P futures down 0.1%. NASDAQ 100 futures down 0.2%. We're going to catch up with Valerie Teitel with her movers in just a moment. But she pointed out this is a market that hasn't moved more than 1% in either direction over the past month. Now, for this Treasury market, it was a rally yesterday. Again, there's pressure from Scott Bessent, who said that there needs to be an exhaustive review of the Fed. He puts out later on X, he was talking about non-monetary policy review, not monetary policy. Even so, we are weaker this morning by only 1 basis point for your 10-year yield. 4.38% is where we stand. Let's get some of the stocks moving in the pre-market. As promised, with that is Valerie Teitel. Hey, Val.
Good morning, Danny. With that dampened volatility, we have a return of meme stock mania. Open Door Technologies. This stock is up 312% in the last 6 sessions. It's up again in the pre-market. It jumped 120% intraday, Danny. This is a stock that it's a website actually that buys and sells real estate, but that's not important. What is important is that someone tweeted about it a few days ago, and it's gone viral in the retail space. So keep an eye on Open Door Technologies. The return of meme stock maybe goes out to the broader market. But let's move on to names reporting before the bell today, because there are a lot. One of them is General Motors. This is going to be an interesting one, Danny. They are most exposed to tariffs when it comes to the giants around the auto sector. They report before the bell. We also have Coca-Cola. This is good, guys, for how the consumer is doing as well. Aside from these, we do have a few defense names reporting this morning, one of them being RTX. We also hear from Lockheed Martin and from Northrop Grumman. So keep an eye on this defense trade. We know that European defense, at least, has had quite a year. These U.S. defense names are also rallying this year on the back of that. Danny.
Some stocks to watch out for. Valerie, thank you so much. We'll catch up with you later in the hour. Also this hour, in just moments, we'll speak with Lucy Baldwin of Citi, who joins us to discuss the U.S. exceptionalism she sees in equities. And later this hour, we'll look at the credit market with BlackRock's Amanda Lynham. But the focus on markets this morning, since sinking to lows in early April, the S&P 500 has rallied over 25%, closing in at another record high yesterday. Citi's Lucy Baldwin writes, quote, return of U.S. exceptionalism in equities but not in FX. U.S. exceptionalism is back, with the AI trade making a comeback. Growing capital expenditure should be a tailwind for equities, and weak sentiment suggests that investors are still waiting for a pullback to add risk. I'm pleased to say that Lucy joins us now. She's Global Head of Research at Citi. Lucy, good morning to you. Thank you so much for joining. U.S. exceptionalism is back, but as you note, it's largely tied to an AI trade. Just how crucial is this earnings season with the big tech players starting to report tomorrow?
Good morning, Danny. Thanks for having me. And absolutely, we would take the view that the US exceptionalism thematic is back for the AI trade, and in particular, those big tech names. I think the bar is relatively low coming into this earnings season in terms of expectations. So I think that will be a positive for sure. And as you noted, this AI trade, we feel, has got a significant amount of room to run. But how I would caveat this is that we are already at our 6,300 year-end S&P target now, and our mid-year target for next year is 6,500. So I think it is much more about selection under the hood than necessarily expecting a significant rally from here. I think the broader macro backdrop is clearly still pretty supportive, but the impact from tariffs, Danny, is really still yet to bite. We're starting to see in some of the inflation data, such as the June CPI data, some of those price pressures from tariffs starting to creep in. We're starting to see higher prices being passed on to the consumer. In some places, people are going to be watching and seeing whether corporate margins are starting to come under pressure as we go through this earnings season. And all of those sorts of things are obviously going to impact consumer spending going forward, and crucially, the labour market. So we're really very focused on how that labour market softness might have evolved from here. And of course, we just highlight things like some of the private sector hiring data has definitely softened. So our sort of economic view for the back end of this year is that softer growth thematic, is a bit more inflation. And of course, all of that does make things complicated for the Fed. We're expecting to see 3 cuts this year, but there is a risk that maybe they can't quite do 3 and it ends up being 2. And then we've got a little bit more cutting, another 2 cuts in the early part of next year.
Lucy, in terms of things starting to show up with inflation, we saw in the latest CPI report, it was things like furniture, electronics, appliances, and those categories also declined when it came to retail spending. Is this a consumer that is finally more sensitive to price increases, whereas it had been very resilient consumer spending throughout the past few years?
Well, we all know not to bet against the US consumer, but it would be fair to say that we're expecting to see more softness there. So when we think about things from an equity strategy perspective in the US, we would be more underweight the consumer, we'd be more overweight tech, we'd be more overweight financials. So we're definitely very focused on how that can evolve. I think it's fair to say that for now, the resilience has absolutely been there in the economy. But what we continue to suggest to people is that broad diversification theme, because as you noted earlier, it's not just going to be about exceptionalism with the big tech names in the US, but it's going to be about this sort of unexceptionalism in FX markets. And so you've got to think really carefully when you're thinking about your global equity exposure as to where you would want to have those positions, because of some of the dynamics that we think will continue to unfold in FX markets. And as you say, dollar weakness, although it's a very consensus trade, is one of those themes that we would expect to continue to play out. And that's really important as we think about earnings. But from a consumer perspective, yes, I think the consumer has held up very well, but we would expect to see that weakness starting to materialise as we go through into the second half and as that labour market weakness starts to unfold.
Well, through June, the dollar has fallen for 6 consecutive months, at least judging by the Bloomberg dollar spot. That's something it hasn't done since August of 2017. Lucy, you're expecting that weakness. Is there anything that could break the trend realistically?
Well, I think whenever you've got a very consensus view on something, there's always a lot of risk to that, undoubtedly. And I think, you know, part of where we've been thinking about this theme of the dollar weakness has been linked to, if you like, this sort of the fiscal dominance thematic, the risk that a country's fiscal position and the high levels of debt and government spending are going to really risk constraining your monetary policy. We've just seen it kind of play out in Japan in the elections. Obviously, that's a country with incredibly high inflation relative to the G10, running at about 5%. You've had a lot of yen weakness. It's very complicated for the Bank of Japan there. And, that thematic where you're starting to see, obviously, the back end of the yield curve cause some problems and cause some concerns is a thematic that's playing out in a number of big markets, whether that's here in the UK or, of course, for the Fed in the US. And I think as we think about that is quite an important theme to understand as we try and forecast the dollar into next year, because, of course, things like Fed independence that have been a topic recently, all of that have risk in terms of making the back end of that yield curve less stable and more volatile, and continuing to see that steepening. I think what we would say is that we actually forecast into next year a little bit more dollar strength. So we actually do see some upside risks. So, for example, obviously we've had the big beautiful bill passed in the US. That is going to be stimulative. Now, I think our core view is broadly the negative effect of tariffs are going to be offsetting the positive stimulative effects of that bill. But there are scenarios under which you could expect to see some of that stimulus coming through from the bill, really providing that tailwind to earnings and better than expected growth. And maybe that means that the dollar actually can have a little bit of a rebound into next year, rather than the view that you actually see it just continuing to come under pressure because you start to see the Fed cutting this year and into next year.
I was going to say, can we just throw one more variable into that, Lucy? What happens if we get a very, very dovish central bank chief at the Fed next year?
Yeah, and of course, that is a big debate, big discussion. We've seen, obviously, the two Kevins, Kevin Hassett, Kevin Walsh, two of the potential front runners for that Fed chair role next year when it changes in May, both talking about the need for cuts and the ability to cut from here. I think clearly Fed independence is really, really crucial. There's a lot of great research written about that. And so what I would say is there is obviously a risk if you had somebody that were in that seat that were perceived by markets as more likely to be less independent, then the risk is you get that steepening of the curve, right? And you get to see, the 30-year would almost certainly go back above your 5% levels again, and you'd start to see those concerns come back into the markets around who is going to buy all of this supply as more debt is issued. And then you'll get the debates around what levels of duration are really going to be most attractive. And I think it's that big thematic around the world is really critical as governments politically are under pressure to spend from a fiscal perspective in infrastructure and other things. Who is going to fund that from a debt perspective? And what returns are sufficient for the kinds of risk that you end up having to take in those scenarios where you've got levels of debt sustainability that are very questionable. Clearly the US, if you look at it now and you think about, most people have 6 or 7% deficits extending out over the next few years. And if you think about the interest cost, even with a 4% US 10-year, your interest costs from a total perspective start by the mid-2030s to become greater than what you're spending on your Medicare, your healthcare programs and your social security programs. So that's where investors get very concerned about that fiscal outlook.
Lucy, this has been a masterclass. Thank you so much for joining this morning. Hope to catch up with you again soon. Lucy Baldwin of Citi. Now let's get you some other top stories that are trending on the terminal this morning. And BlackRock has told its staff to use temporary loaner phones and not to bring company laptops when traveling to China for business. That's according to an internal memo seen by Bloomberg. Employees have also been notified that they would not have access to the firm's network during personal travel in the country. Shares of Linden are seeing their steepest drop since early 2022 after the chocolate maker's earnings missed estimates. It also reported a weaker than expected volume growth, facing soaring cocoa prices. The team at Batter noting that Linden's volume growth in the first half was lower than in either the financial crisis or the pandemic. And the Bank of England is said to be mulling whether to set aside its plans to create a digital pound for households. Bloomberg learned that the BOE has instead privately urged banks to come up with payment innovations that could result in similar benefits. Coming up, a renovation review. Treasury Secretary Scott Bessent calls for an inspection into the Fed's billion-dollar building upgrade. We'll discuss that coming up next. You're watching your Bloomberg Brief.
ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger in New York. Treasury Secretary Scott Bessent has called for an analysis of the Federal Reserve. He posted on X, quote, the central bank should conduct an exhaustive internal review of its non-monetary policy operations. Significant mission creep and institutional growth have taken the Fed into areas that potentially jeopardize the independence of its core monetary policy mission. Chair Powell was also set to speak at 8:30 a.m. at a Fed banking conference. Just a reminder, it is a Fed blackout right now, so it won't be on monetary policy. Joining us for more is Bloomberg's Josh Galou. Josh, great to see you this morning. And originally, Bessent was talking earlier yesterday morning on American media, asking for an entire Federal Reserve institutional review. Is this post on X kind of walking that back if he says it's not about monetary policy, the review that he's calling for?
It does feel a little bit like a stalking horse here. You know, the context of the comments, of course, are that Jerome Powell's been under fire. Scott Bessent was even at one point considered to be a potential replacement for him. And the third element is, of course, Republicans' fixation on the budget and spending. So at the Fed, you have this renovation that's been going on for quite some time. It was originally meant to cost $1.9 billion. That has expanded to $2.5 billion. You know, the Fed's explanation is, of course, the building is nearly 100 years old. It's built down by the tidal basin near the Potomac in Washington, and they've run into some problems with the foundation and that it's built on a former swamp. So the costs have blown up. But the administration's focus here is more, or at least Bessent, his focus is more on some of the Republican talking points, right? Saying like, well, we don't want to be building lavish, spending on lavish offices at the Fed. We're trying to save money, and calling it mission creep and undercut at Jerome Powell, of course. So we'll have to see where this goes and whether there's much to it. Congress is probably not going to balk at the opportunity to investigate the Fed, though. That's something that they would probably jump on.
Well, Congress wants to get a lot of stuff done before the summer recess, Josh. And I wonder how much this blow up over Epstein, that's become bipartisan with both Democrats and some Republicans pushing for more investigations, how much that's affecting what can get done in Washington, D.C. right now.
Right now, it's having a pretty significant impact. So this is the second week, really, that Democrats have been able to use that issue to sort of derail some of the legislation that Republicans want to get passed on a fast-track basis. The way they're doing it is essentially by trying to get Republicans to hold a vote on the release of Epstein files in the Rules Committee. The Rules Committee is really important here because it's going to decide whether some of this Republican legislation can go through with a simple majority vote, or if it needs the usual two-thirds vote. If it needs the two-thirds vote, obviously Democrats then are able to vote against against and stop legislation, but with the simple majority, they can't, as we saw with the one big beautiful bill that got through on a simple majority. So what they're putting Republicans in a difficult position because they're forcing them to vote either on releasing the files entirely, or as President Trump wants, to release the indictment files. So, you know, this is putting them in a tough position. It's been building for a couple of weeks, and right now it looks like the Democrats are having a lot of success in delaying Mike Johnson's agenda.
Josh, thank you so much for that update. That is Bloomberg's Josh Galou. Now, keeping things in Washington busy as well as a looming trade deadline, Press Secretary Caroline Leavitt has reiterated that there will be no postponing.
The August 1st deadline is just really the start date for when the United States of America will begin collecting this revenue from all of the countries around the world who the president has sent these letters to. You could see some more letters before August 1st, John. You could have some more trade announcements as well.
The chief trade negotiator of Japan and Commerce Secretary Howard Lutnick met last night, as the two nations try to reach a deal before President Trump's deadline next week. Let's bring in Bloomberg's Brendan Murray for more. So, Brendan, it is a week and a half away. It is a market that is largely now ignoring any of the most recent developments. How should we judge the type of deals and whether deals are getting done as we approach August 1st?
Well, this particular negotiation that's going on between the U.S. and Japan has been pretty much stuck at nowhere, going nowhere for the past couple weeks because Japan was facing its upper house elections. With that in the rearview mirror now, there's some hope that they could kind of reach some sort of framework arrangement, that Japan would give a little bit on agriculture, and the Trump administration would give a little, would ease back on the auto tariffs. But it really boils down to Japan cannot face these 25% tariffs on their auto exports to the U.S. That will just crush their the heart of their manufacturing base. And so it's issues like this that are bogging down other talks, like the U.S. talks with the European Union, with Korea. India is also talks in talks that we understand have been close for weeks, but they still can't get the deal over the goal line. They still have a week and a half left, but it looks like that August 1 deadline may have some flexibility to it. Treasury Secretary Bessent has said it's not. We don't need quick deals. We need good deals. So he's kind of indicated that there might be some delays built into that, or at least some temporary deals announced with more talks to continue in the future.
Brendan, you've also been doing extensive work following the flow of goods amid all these tariff tensions, and we saw in the beginning of the year a significant amount of front running. What do the ports look like now? What do shipments look like? Have they dropped off significantly?
Well, the view from the ports over the past couple of months has been there was a big drop-off in April, a big build-up in April, and then a drop-off in May and June. And now all of that front-loading, it makes the second half of the year look pretty bleak when it comes to import volumes through the biggest U.S. ports. There is some speculation that it could be one of the biggest reversals after an almost 15% increase in volumes last year, year over year, to a decline this year, and that would be something that's been pretty much unprecedented in the past 6 decades.
Brendan, thank you so much. Bloomberg's Brendan Murray there, and you are watching Bloomberg Brief.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment. And it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Let's take a look at the front pages this morning. Leading on the FT, they're reporting that Morgan Stanley is exploring lending against its clients' crypto holdings. It's the latest move and a sign that U.S. banks are endorsing the move of digital assets into the mainstream. Just 8 years ago, recall, J.P. Morgan CEO Jamie Dimon had called Bitcoin a fraud. And on the Washington Post, MAGA focuses on Jeffrey Epstein. Trump looks to focus on anything else. The president has posted in recent days about an Obama-led conspiracy and sports teams reverting to old names, while his once loyal supporters continue to ask about a potential cover-up surrounding Epstein. And our reporting suggests that it really has derailed the House agenda, meaning they might move into an early summer recess. Meanwhile, let me give you a look at the dollar over the past 2 days, because it started to unwind some of the gains that it's seen this month. The dollar seeing its biggest daily decline since mid-June yesterday. Some of that led by a strengthening in the yen. Coming up, we speak with Amanda Lynham.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis, and we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this morning. More pressure. Treasury Secretary Scott Bessent calls for an exhaustive review of the Fed's building renovations. That as Chair Powell is set to speak at a banking regulation conference later this morning. And the S&P 500 notches another record high ahead of a busy day and a busy week of earnings. It is a record high, but it is a melt up into that record high. We've seen very thin advances, and this morning that turns into a decline, down 0.1% for the S&P, down 0.3, just thereabouts for the NASDAQ 100. It has been an advance led by the Mag 7, led by AI. We're going to get Alphabet and Tesla reporting tomorrow. Yesterday was a big global rally for the bond market. Again, that eases somewhat this morning, just barely higher by about a basis point for the 10-year yield. Bessent talking about the need to examine the entire Federal Reserve institution, but on X, he goes on to clarify yesterday he was talking not about monetary policy. That helped to bring yields down throughout the day. Let's look at some individual stocks on the move. With that is Valerie Teitel. Good morning, Val.
Good morning, Danny. We have a return of some meme stock mania. Open Door Technologies rising again in the pre-market, up over 12%. This stock intraday yesterday jumped 120%. It's a website platform for buying and selling real estate. Someone tweeted about a few days ago. It's had a massive six-day winning streak and has attracted a ton of retail volumes. Let's see if this kind of frothy activity does expand into wider markets. But let's move over to Switzerland. There was a key earnings release from Lindt, which I think is quite telling of the macro environment. The stock is down nearly 7%. Its worst slide in about 3 years. In this earnings release, it is going through how it's battling the rise of cocoa prices, maybe bringing front and center that's not just about tariffs. There is some lingering goods inflation that these companies are dealing with. But Lindt Chocolate, the volumes for the first half, Danny, were even lower than they were during the pandemic, even lower than they were during the financial crisis. So that stock is not having a good day in Switzerland. Headed into the opening trade so far this morning, though, we do have a few stocks to keep an eye on that are reporting before the bell. General Motors is going to be reporting in about an hour. That one's going to be interesting on how the auto sector is dealing with these tariffs that are in place. And then Coca-Cola comes around 30 minutes later for maybe a good guide on how the consumer habits, how those consumer spending habits are handing up. Danny.
Will be some really interesting earnings to look at. Valerie, thank you so much. Now, meanwhile, BlackRock's Amanda Lynham is anticipating a more challenging growth and inflation mix in the U.S. for the third quarter. She writes, quote, near-term preemptive rate cuts from the Federal Reserve are unlikely. Against such a backdrop, many market participants are focused on how corporate borrowers have been navigating this environment and whether new signs of stress in credit fundamentals are emerging. She is head of macro credit research, and Amanda joins us now. Amanda, it's not just market participants. I know this is stuff you've been digging through as well. Have you started to see any signs of stress in the credit market?
Good morning, Danny. Thank you for having me. I would say the credit market is showing signs of general resilience, with the exception of some left tail pockets of stress that were generally in place even before we started to see concerns around the potential growth slowdown. I would say, to be clear, our expectation is for slowing growth from an above trend pace, which actually is a backdrop that the credit market can likely easily digest. We were never really expecting a recession, even at the height of the uncertainty on the policy front. And that solid corporate fundamental backdrop has also been coupled with a good enough macro and really supportive technicals. So there's a bit of a confluence that's allowing the credit market to continue to climb this wall of worry, and actually credit spreads have retraced and are sitting at the tight end of the post-financial crisis range, which is really extraordinary given all of the volatility that we had in the second quarter, at least at the beginning. I would say, as for the left tail pockets of the market, you are seeing signs of distress in certain kind of themes. So we're seeing a bit of repeat defaulters. We're seeing smaller companies default at a higher rate. We're seeing loans outpace high yield bonds in terms of default. So there are some pockets of stress. It reinforces the case for being very granular and also the case for dispersion. But in general, I would characterize the credit backdrop as one of a pretty healthy resilience so far, at least.
Does that mean when you look at, for example, Moody's had this report out last week saying that the amount of defaults or likely defaults is at an 11-month high? Amanda, that is really just confined to the pockets you're talking about, that we shouldn't look at those statistics and be worried about the overall corporate credit environment?
It's a great point. It begs the question, when defaults are elevated like they are, at least in the loan universe, as I mentioned, why isn't it derailing performance? I would cite two things. One, it's the smaller capital structures that are defaulting. So in terms of, in general, so in terms of the ability to impact overall index level performance, the bar is a little bit high. And again, those repeat defaulters, currently, then this is using data from JP Morgan, 30% of the defaults so far this year have been repeat defaulters. So companies that defaulted a year ago, they completed a distressed exchange, they're defaulting again. This is the third consecutive year where that number is above 30%, which is quite elevated. So by definition, that stress should be incorporated into market valuations. Oftentimes you see this, that the market gets ahead of these actions, whether it's a default or a downgrade or even a ratings upgrade. The market participants are doing the work. They're listening to the management teams. They incorporate this into valuations. So oftentimes by the time the event, a default, a downgrade, an upgrade, happens, it's oftentimes already incorporated in the valuation. So it makes sense to me that it's not enough to derail the performance of the lowest quality pockets of the market. And in fact, we're still comfortable with our view to selectively move down in credit quality. Again, not chasing all the way down into the lowest rungs, but selectively moving down in credit quality. We're still comfortable, and high yield and leverage loans have outperformed investment grade year to date on a total return basis.
Well, Amanda, you just mentioned earlier that it's been spreads that have been grinding tighter. And one of the outputs of that is you have something like Microsoft that is now more highly rated than U.S. government debt and has really robust cash flows. If you're looking at a lot of IG corporate bonds, be less volatile and have higher total returns than the Treasury index, does that change investor perception about what is a safe asset, about what is a haven right now?
Sure. This question does come up from time to time. I would say it's important to keep in mind that in the corporate credit market, there just aren't a lot of AAA rated companies left. Very different from the pre-financial crisis period. So when you think about market segmentation, oftentimes technicals dominate in those structures because there's just not a lot to go around. There's just about 90 billion of AAA rated corporate debt, which is pretty small in the context of the overall US IG market. More broadly, I think there is a view that actually even moving down in corporate credit quality within the investment grade sphere is a pretty attractive view from our side, from a relative value perspective. Even, for example, for an investor that's confined to the investment grade universe, if they're dropping down into the BBB pocket of the corporate credit market, generally those companies are committed to investment grade. They still really have healthy fundamentals, and really they're navigating this backdrop of policy uncertainty with a fair degree of resilience. So even moving down in quality within investment grade is something that we like, and I think that speaks to the overall positioning of the corporate landscape in this environment.
Well, it's been an extreme lack of volatility. You can see it in credit, you can see in equities where the S&P hasn't swung more than 1% in either direction for over a month. Amanda, it's another earnings season where we're likely to get a lot of companies giving the, I don't know what it's going to look like, maybe scenario analysis, maybe not issuing guidance. Is there any reason to suggest that this earnings season might be the thing that breaks some of the market calm?
I actually think the bar for this earnings season is pretty low, and our expectation is that corporates will compare favorably to what are fairly low expectations. The one thing, Danny, that I found notable is that companies over the past month and a half have been a bit more forthcoming about the operational levers at their disposal to navigate this backdrop. I think that's different from what we heard during the first quarter earnings season, where there was still a lot of ambiguity. I think that's part of the reason why risk assets have been relatively resilient, is that corporates are showing the different operational levers that they have. Some of those could include cost-cutting plans that were supposed to happen over the next few years. It could be negotiations with vendors, using more automation. Really, the list goes on. There are about 10 things that we hear consistently that corporates are citing. I think if I had to pick one signpost to watch for the second quarter earnings season, it's this feedback loop between corporate margins, the layoff rate, which is still low, consumer spending, and overall economic activity. We're in a low hiring, low firing environment right now. So if corporate margins are pressured, the risk is that those firms flex that layoff tool more aggressively. That feeds through to consumer confidence. And then, of course, consumer spending is 2/3 of overall economic activity in the U.S. So that's where we should be watching. Just like during the pandemic, that high-frequency company-level commentary will be really important. But again, right now, what we're hearing from corporates is a bit more forthcoming about the operational levers at their disposal. So our bias is to be, I would say, somewhat cautiously optimistic about corporates' ability to surpass what is a pretty low bar for second quarter earnings.
Yeah, fair enough. And we'll get about 20% of the S&P market cap reporting this week. Amanda, thank you for helping us set up for it. Amanda Lynham, always a pleasure to have you on, of BlackRock. Let's get you now some other top stories that are trending on the terminal this morning. And the White House says it would remove the Wall Street Journal from the group of reporters traveling with President Trump on his upcoming trip to Scotland later this week. That's after the newspaper published a story alleging that the president once sent a suggestive birthday letter to late financier and sex offender Jeffrey Epstein. LA Times owner Patrick Soon-Shiong plans to take the newspaper public over the next year, he told Jon Stewart on Monday night. If an IPO goes ahead, the LA Times would join the New York Times and News Corp among the largest publicly traded news organizations. The billionaire has owned the publication since 2018. And BlackRock has told its staff to use temporary loaner phones and not to bring company laptops when traveling to China for business. That's according to an internal memo seen by Bloomberg. Employees have also been notified that they would not have access to the firm's network during personal travel in the country. Coming up, more pressure on the Fed. Treasury Secretary Scott Bessent calls for an inspection into the Fed's billion-dollar upgrade for their building. We'll discuss that next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
You're watching Bloomberg Brief, and I'm Danny Berger in New York City. Treasury Secretary Scott Bessent has called for an analysis of the decision to upgrade parts of the Federal Reserve headquarters. He posted on X, quote, "While I have no knowledge or opinion on the legal basis of the massive building renovations being undertaken on Constitution Avenue, a review of the decision to undertake such a project by an institution reporting operating losses of more than $100 billion per year should be conducted." Joining us is Bloomberg's Josh Gallo. Josh, this isn't the first time we've heard this criticism of the Fed's Eccles building. It's something that Trump has talked about. Other members of the Republican House and Senate have talked about. Is it different, though, if we have Scott Bessent also making this call?
I think it is. Of course, Bessent's been on the short list as a replacement for Jerome Powell as head of the Fed. So, you have to take that into account when you read that. And then, his comments clearly serve a couple of different Republican talking points that people on the Hill want to hear. One is about spending. So this project began as about a $1.9 billion renovation and construction, and now it's up to about $2.5 billion. The Fed, of course, says when you're dealing with a building that's 100 years old, there are things like asbestos, and it's built on a former swamp that's added to the cost. But they're pointing to sort of a rooftop garden and lavish facilities, which the Fed has sort of said that it's not quite as lavish as you're making it out to be. You have that on one side, right? It's really speaking to the Republican talking points that we've heard all along about budget cutting and cost consciousness. And then on the other hand, of course, any opening for the administration to go after Powell is being seized. So here, they're obviously not going after monetary policy and interest rates, but it's another opportunity to take a dig at Jerome Powell and potentially undermine his credibility as head of the Fed when they really want to make a change there.
Hey, Josh, just quickly, as Congress deals with the last push until the summer recess, you've seen really the Democrats push for more investigation into Epstein and some Republicans following suit as well. How much is that derailing their schedule at this moment?
Right now, it's really having a major effect. So it's all happening in the Rules Committee, where Democrats have put forth this idea. They want Republicans to have to vote on whether to release the Epstein files. And, that's forcing the Republicans to either ally themselves with their base, which is rather in favor of doing this, and President Trump, who is trying to limit the release to the grand jury testimony that was used in the prosecution of Epstein. It puts those lawmakers in a very difficult position, and by doing so, the Democrats are actually keeping the Republicans from moving forward with any kind of legislation that is in any way controversial, because it keeps them from pursuing a process where they can pass things with a simple majority rather than 2/3. That means with the recess coming up at the end of this week, it's very unlikely that they can get anything done other than very non-controversial and routine motions that aren't going to cause any kind of uproar.
Josh, thank you for that update. That is Bloomberg's Josh Gallo. Let's turn to tech now. And Microsoft shares are slightly lower in the pre-market, down less than 0.2, but the tech giant has been rushing to stop hackers who exploited a security flaw in their software to try and breach businesses and governments across the globe. Let's get an update from Bloomberg Tech Europe host Tom McKenzie. Tom, we knew that this breach had happened yesterday, but we're learning more about the details. Just how extensive was this hack?
Very extensive, Danny. And as you say, look, there was a weekend patch by Microsoft, but this hack continues. We know that those malign actors, according to cybersecurity teams monitoring this, are still in many of these systems. You could be talking about 10,000 businesses and organizations globally, by the way. This spans everyone from the US to the UK, Canada, Brazil, and beyond. And in terms of organizations that have been hit, we know the Department of Education is among them, university in Southeast Asia, potentially 10,000 businesses and organizations that use the on-premise servers around SharePoint. And by the way, SharePoint, the hack has been focused on that particular piece of software. That opens up potentially the hackers to a whole ream of different products and services from Microsoft, including Microsoft Outlook and, of course, other parts of the ecosystem, Teams and Microsoft Office as well. So this is extensive, very damaging, of course. Microsoft has been under scrutiny already for some of its mishaps and oversights in terms of cybersecurity, not just from some of its clients, but the US government as well. So they continue to work on this. The one silver lining is that it is focused on those on-premise servers. So if you as an organization or a business have SharePoint that is hosted out of Microsoft's own servers, then you are unlikely to be affected by this. But they've taken, by all accounts, usernames, passwords, and tokens. Again, this is a global hack.
Tom, thank you very much for that. That is Bloomberg's Tom McKenzie. Now, elsewhere in corporate news, it is a busy day of earnings. We have autos, consumer companies, and defense. Among them is Coca-Cola, which is set to report before the bell. Bloomberg's Sabah Meddings joins us now for more. Sabah, we have seen some analysts be pretty optimistic about Coke's quarter. Why?
We are expecting a solid quarter, like you said, and that is despite what is a kind of jittery consumer environment in the US, various down trading, things like that. And Coke does have a really strong comparison from last year, so it is going to be a little bit tricky for them. But we are expecting adjusted organic revenue up 4.55%. I think what perhaps is more interesting for Coke this week is how it responds to Donald Trump's missives about high fructose corn syrup. The company did say last week, after the president said he wanted to have cane sugar in Coke, that it would provide an update today. So analysts are really looking out for what are they going to do? Are they going to launch a new product? Are they going to reformulate existing products? Probably more likely that we'll have a kind of a Mexican Coke-style product using cane sugar launched across the US. Shares did rise last week when they said that there would be an update today. So yeah, all eyes on that and how that would affect the business. It could actually be a positive. It would be a slightly more premium product, and if you look at the kind of price mix, it could be quite helpful. But yeah, we'll be looking out for that today.
Yeah, it will be really interesting to see what they say when they report. Sabah, thank you so much. Sabah Meddings there with an update on Coca-Cola. Coming up, we're going to update you on what the rest of your day looks like. We'll have your trading diary for you next. This is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today. and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
What do you think your mark is going to be as the CEO?
The trend of private capital, as significant as we think it is, if we look back again to 2000 to today, it's early days for private capital. If you think about the big trends, demand for infrastructure, demand for energy, the demand for defense, and really what's happening geopolitically, the demand for private capital will only increase. I'm also generally an optimist. So I think industries will grow, investment will grow, and private capital will just grow to be a provider of capital.
As the Carlyle CEO, Harvey Schwartz, speaking with Bloomberg's Sonali Basak, and you can watch that full interview tonight on Bloomberg TV. It airs at 6 p.m. Eastern Time and streams on Bloomberg Originals at 8 p.m. Let's now get you set up for your trading day today, because we have a flood of earnings. GM, Coca-Cola, Philip Morris, Lockheed Martin, among others, will be reporting. Meanwhile, Fed Chair Powell will be speaking at a banking regulation conference at 8:30 a.m. Eastern. Just a reminder, it is a Fed blackout period, so he won't be speaking on monetary policy. Same goes for Mickey Bowman. Fed Governor Michelle Bowman will also be having a fireside chat with OpenAI CEO Sam Altman, That's at the same event at 1 p.m. Let's look at some of the stocks on the move. Open Door. It is the new meme stock in town. Shares jumped 121% yesterday. It goes higher today, up nearly 15%, making up 10% of all stock market activity on Monday, just because someone tweeted about it. NXP, those shares are down 6%. It posted a second quarter sales decline. It was hurt by a sluggish automotive market. Meanwhile, CSX, those shares are up 4.5%. It's rising on a semaphore report that Berkshire's BNSF is exploring a takeover of either Norfolk Southern or CSX. Now, it is a record high that we saw in equities yesterday. That melts up, takes a breather this morning. It's red across the board. We also saw the worst day for the dollar since June. A tough going there after it made up some of its gains this month. Meanwhile, your 10-year yield is little move this morning. But again, it starts out a busy week of earnings, really kicking off in earnest today and tomorrow, when we will get Alphabet and Tesla. So you're looking at an S&P future session that is down 0.1%. All right, that is it for your Bloomberg Brief. Surveillance takes things from here. This is Bloomberg.
there is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francina in Sintra, Portugal, and this is Bloomberg.
The quality of the S&P is actually improved. The valuation, yes, it's high, but it's justified in our minds.
Businesses are still in a really, really good spot.
Corporate America has a lot more difficult decisions to make this quarter.
It's not all easy. I think this is going to be somewhat messy in this reporting season.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday at all-time highs, the Mag 7 putting together 9 consecutive days of gains ahead of earnings. The Treasury Secretary, Scott Bessent, pushing for a review of the Federal Reserve, and quarterly results from General Motors expected to highlight the impact of trade policy. Those numbers 30 minutes away.
To me, earnings take center stage this week, and it's not just the tech earnings, as you just pointed out. It's also GM. It's also Coca-Cola. Remember MAHA, Make America Healthy Again, and the potential for sugar to be used rather than refined corn syrup. There's also this question about Lockheed Martin and how much orders are coming from overseas. That also is coming this morning, the second biggest week for earnings that we're going to be getting.
For me, it's all about GM, because the 25% levy on the auto sector still exists right now. What we heard from GM back in May was that they were going to try to mitigate the tariff impact, about 30%. But the CEO, Mary Barra, wouldn't say whether or not any of that would be passed on. So how have they been able to do it? They did come out and say that they were going to invest more in the plants in the United States. Was that just to assuage the concerns of this administration, or do they actually do it, and is it helping?
The numbers drop at 6:30 Eastern time. For many of us, we're just reheating an old story. The narrowness of this market, the dependence on a handful of stocks to drive this equity market to fresh all-time highs.
Which is the reason why people are so interested in Alphabet and Tesla tomorrow. I will say, Verizon, the most boring of boring companies, fascinating yesterday. Came out with earnings, and some of the non-tech companies have been so interesting because they highlight the one big beautiful bill and how much that's padded their earnings out with an understanding of just what tax advantage they'll get with capital expenditures. These are the types of things I'm watching to understand exactly how broad-based this could be or whether it stays super narrow.
There's a word that's come up a few times in the past week, clarity. When you spoke to Scott Kirby, clarity. We saw that from Delta Airlines as well. The word clarity. Have they got the clarity they need to invest again for the back half of this year? And do they expect consumers to have that very same clarity to spend?
You're hearing that pretty much across the board. I mean, yes, there are certain places that are highlighting weakness, particularly in the lower income sectors. But otherwise, pretty much across the board, you are feeling a greater sense of certainty. It has come from the legislation passed in Washington, D.C., but it also comes from this perception that there is a ceiling on how high the tariffs could potentially be. And that's the reason why I think it's really interesting to see whether there's perhaps an overcomplacency around where some of these trade talks go.
I'm struggling with clarity right now out of Washington when it comes to trade talks. Howard Lutnick says that the deals will be done by August 1st, and that is a hard deadline. But you have the Treasury Secretary continuously leaning into this idea that a rush deal is not as good as a good deal. They want a good deal rather than a rush deal. And he said this when he left Japan. And then what did we have very late last night? The Japanese trade negotiators sitting down with the Commerce Secretary. This was the Japanese negotiators' 8th trip to Washington, D.C. to try to get a deal over the finish line. Can they get this done by August 1st? And even if August 1st comes, so the Howard Lutnick said it's a hard deadline, the Treasury Secretary seems to think things are a little bit more fluid and flexible.
One official doubling down on deadlines, another official de-emphasizing deadlines, and the press secretary saying that maybe you could have some trade letters going out before the deadline. You up to speed?
This is the reason why people are ignoring it all. What's the point of even trying to keep track of the tally when they're just basically talking against each other? And it's all one big negotiation, and this has been moved many times before. I mean, what did we learn from TikTok? Oh, that deal, that was 90 days.
It's a rolling 90 days.
It's a rolling 90 days, and it seems like trade as well.
Record highs in the equity market. Equity futures this morning down about 1/10%. Coming up this hour, we'll catch up with Matt Miskin of Manulife John Hancock Investments, with stocks coming off all-time highs. Terry Haynes of Pangea Policy as Treasury Secretary Scott Bessent calls for a review of the Federal Reserve, and Bloomberg's Craig Trudell on earnings from GM about 25 minutes away. We begin this hour with stocks stalling after hitting another all-time high as investors await big tech earnings and President Trump's next trade deadline. Joining us now to discuss, Matt Miskin of John Hancock. Matt, welcome to the program, sir. Just how fragile is this record-breaking rally?
We're right back to where we were at the beginning of the year, John. It's an extended market with really multiples hitting on at least the 4 PEs back to about 22.5. You know, the highest in history is 24. So high yield spreads are down to 280. The best, tightest ever is 230. We're looking at the riskier parts of the market. They can't get much better than this. And you can get that carry, you can get the earnings growth. That is something we are looking for here. But it's going to be hard sentiment-wise to crank up the dial anymore on risk taking. And in our view, now's a good time to go around a portfolio, prune some risk, find some places that are extended. And for us, it's some of the momentum factor in the United States and, frankly, some of the European financials that have had an amazing start to this year.
So, Matt, you're not going to get away with just saying that and moving on. Talk to me about the financials. That has been the big winner of 2025. Why prune those gains now?
You know, we've seen a steeper yield curve here as it's been nirvana. You've had basically a central bank, at least in the European Central Bank, they've been cutting rates. And now we're hearing opening the fiscal floodgates is the term we're hearing. And really, this is globally around the world. You're seeing governments say, I'm not going to fight the tariffs one-on-one. What I'm going to do is I'm going to take on more debt and I'm going to stimulate my own economy to basically fight the economic ramifications of this. And really, that is creating this huge rush into more cyclical parts of non-U.S. equities. China equities are on fire this year. European financials are doing exceptionally well. It is a very counterintuitive market. You hear all these tariff headlines, and then you see Chinese equities doing exceptionally well. We're trying to mitigate politics in portfolios because it's not happening like you would think. But in our view, you've had a great run. It's a great time to take some profits.
Which raises the question, what isn't expensive? What isn't overvalued if you're coming back to the United States? Well, we just hit, I believe, our 12th record high on the NASDAQ, our 10th record high of just this year for the S&P 500. What's to say that it's not overvalued in the United States?
It is, Lisa. And really what we're going back to is boring old bonds. And we are getting about a 5% yield on high quality corporates and mortgage-backed securities. 5% to us is a great yield. And lo and behold, if yields even come down a bit, if the Fed does cut at the end of the year, we think that's actually more total return potential. If we even get what we got on the first half and the back half, we could get high single digits out of bonds. We think that's a lower volatility option. We're increasing certainty in portfolios by driving income versus looking for more capital appreciation through multiple expansion. We're not going to the 30-year Treasury in case you're going to ask me that next. But intermediate part of the curve, relatively high quality, income producing assets look attractive to us here.
Matt, you've been conservative over the past few months, and this has been a market that's been anything but conservative. You see the FOMO trade starting to come back. How hard is it to stick to this kind of conviction of going long into bonds at a time where the riskiest parts of the market keep outperforming?
Yeah, having quality has not been a great strategy this year. You really wanted to dip into the most frothy, lowest quality parts of the market. And this does happen, Lisa, over time in market cycles. And what we've seen time and time again over this market cycle is that this is usually a shorter term tactical type trade. And this one is a longer one. You know, the last 6 months, it's really been still this kind of trade. But I mean, in April, it certainly felt better to have higher quality assets. In our view, it's going to come back into favor in the back half. We actually see a decelerating growth environment, decelerating inflation environment. And already you're seeing in earnings. You just talked about this. Who's at the top of the earnings growth? It's tech, it's comm services. These are high quality parts of the market. And then in the bond market, I hear you, credit spreads have been grinding tighter. But how much more tight can they go? And even in investment grade corporates, we're keeping up with high yield. We think that's actually pretty impressive given how risk on this market's been.
Matt, when it comes to some of the uncertainty out of Washington, a lot of investors coming on the program are talking about the concern of Fed independence. Yesterday, we heard from the Treasury Secretary calling for this review. Are you concerned he's calling for a review of the Fed, or maybe relieved that also in this tweet, he's emphasizing the jewel box of monetary policy, which is Fed independence?
Yeah, I never had it on my bingo card that I'd be reading Bloomberg articles on the construction of the Fed building for 2025, but here I am. You guys have some great articles on it. I'm like, okay, is this really what I'm doing though? I don't know if this is going to lead to any changes in monetary policy. I think even if you have someone else that's there, they're going to be using the same data and looking at the same things, and they're going to tell you that basically they're going to have to be on hold for the most part. And what they're missing, in our view, is that housing is slowing. And that, to us, is going to take time to show up in the data. And by then, they're going to be behind the curve almost naturally. And so we do think they should be cutting more so, or more likely to cut here than not. But all this goes back to the currency markets. Currency rules everything around markets in 2025. The bond market's not really caring that much about this, frankly. It's the dollar that is against the ropes, and the dollar coming down is creating this risk-on impulse, and that's actually leading to more risk-on trades around the world. And it's just a very counterintuitive domino effect than what you would think, given this uncertainty around the Fed.
So, Matt, just finish on that. It's an important note. We've seen a recovery in credit. You talked about the tightness of spreads. We've seen a recovery in the equity market. We talked about the leadership there. Why haven't we seen the same recovery in the US dollar?
Yeah, I mean, it's very counterintuitive. We're looking at interest rate differentials. Even yesterday, John, I mean, the European yields were tumbling. The European short end was falling more than the U.S. short end. No one cared. The dollar got crushed. And why was that? Well, that was right around the headlines that hit about more investigation around this building, more investigation around the Fed. And so the currency markets are the ones that are most sensitive to the change in maybe the Fed or basically all the uncertainty around Powell. And really, it's about a capital story flowing to Europe because of this uncertainty. In our view, this is a very tactical thing. This is a sentiment-driven thing, and it could come back, but the dollar technically has just gotten annihilated this year. It's been against the ropes, like I said. I think the sentiment is overdone. The hate is overdone. In B of A manager surveys, it's the most negative on the dollar in 20 years.
Yeah.
To me, that's a good place to look for a contrarian opportunity. But I got to see the technicals turn because it has just been a tough year for the dollar.
A very crowded trade. Matt, appreciate your time. Matt Miskin there of Manulife John Hancock Investments on the Federal Reserve later on this morning, 8:30 Eastern Time. Chairman Powell.
Yeah, and he's not going to be talking about any of this except that everyone's going to be looking for him to talk about this and really rebut the idea that there has been this mission creep. And I'm glad that Anne-Marie brought that up. Everyone's focused on the renovations, but what Scott Besson said yesterday I thought was really interesting about a full investigation into mission creep that compromised its independence, not having to do with monetary policy, kind of raising the specter of exactly what the gripe is that this administration has with this Federal Reserve.
A conference on financial regulation kicking off a little bit later.
Sounds scintillating.
This morning. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Joining us now is Yahara Anand. Hey, Yahara.
Good morning, John. Treasury Secretary Scott Bessent is calling for an exhaustive review of the Fed's non-monetary policy operations, including renovations to its headquarters in Washington. In a post on X, Bessent says that significant mission creep may be jeopardizing the independence of the central bank's core mission to set monetary policy. Meanwhile, trade negotiations are continuing ahead of President Trump's August 1st deadline. Press Secretary Caroline Leavitt told reporters more countries could receive tariff letters before then. Trump is set to meet with Philippine President Ferdinand Marcos Jr. at the White House today. And BlackRock is restricting the use of company devices in China. In an internal memo seen by Bloomberg, the world's largest asset manager told staff to use temporary loaner phones and not to bring company laptops when traveling to China. This coming after a Wells Fargo banker and U.S. government employee were blocked from leaving the country. That's your Bloomberg Brief. John?
Yahara, thank you. More on that story later this hour. Up next on the program, Chair Powell in the hot seat.
The Fed chair needs to lower interest rates. The president is right about that. And finally, people are catching up to the president on that.
Up next, Terry Haynes of Pangea Policy, live from New York City this morning. Good morning.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
It has been snoozy. 18 consecutive sessions without a 1% move in either direction. Alex Semenova here at Bloomberg saying that's the longest such streak so far in 2025. Futures this morning, negative 0.1%. On the NASDAQ 100, we're down about 0.2.
Yeah, but in that boring morass, we've had 10 record highs on the S&P 500 and 12 record highs on the NASDAQ. So the most exhausting and sleepy sort of grind new highs that we've ever seen, maybe. But here we are.
It's a welcome snooze. I wasn't complaining.
Yeah, I know. You keep threatening fate. This is an everyday concurrence.
I'm not doing that at all.
You're totally doing this.
It's a nice summer Tuesday.
People in the newsroom were cursing you yesterday. They were like, John had to say that. He's absolutely foiled us.
And what happened? Absolutely nothing.
Okay, good.
Just a
There you
nice
go.
summer Monday, hopefully followed by a nice summer Tuesday. Under surveillance this morning, Chairman Powell in the hot seat.
He has no plans to fire the Fed chair, but he has been very transparent in expressing his displeasure with Jerome Powell's management of the Fed and also his policies. If you look at our country, by every economic metric right now, it is booming. Look at inflation, like I said, continues to go down. He's basically defeated it in just 6 months. By all accounts, this is a good economy. The Fed chair needs to lower interest rates. The president is right about that. And finally, people are catching up to the president on that.
Here's the latest this morning. The pressure on Fed Chair Jay Powell unrelenting. Secretary Bessent now calling for a review of the central bank, warning of, quote, mission creep and institutional growth. Bloomberg's Akela Garda joins us now for more from Washington, D.C. Akela, welcome back. What is the direction of travel here? Where are we going with this?
Well, you just heard the White House press secretary say yesterday that the president has no plans to fire Jerome Powell. But we already know that. He said it himself. He's left the door open. Still, that keyword plans there to potentially doing that. We know this administration is looking into this Federal Reserve renovation project. But something that happened yesterday is Congresswoman Anna Paulina Luna made a request to the Justice Department accusing Fed Chair Jerome Powell of lying under oath when he testified to Congress in June. Now, it's important to say the Fed Chair says that he has been consistent with his testimony that he gave to Congress last month, and the DOJ isn't compelled to necessarily investigate this, but we still have yet to find out whether they will. But as you mentioned, Treasury Secretary Scott Bessent says he wants to see an examination of the entire Federal Reserve institution and whether or not they have been successful. But there's really two camps of thoughts here in the Republican Party. You have the likes of Senate Majority Leader John Thune, who's really concerned about the independence of the Fed and whether that could have a negative market reaction. And then you have people, even like Speaker Mike Johnson, who have said that he believes interest rates should come down based on the direction of the economy. But at the end of the day, this Fed chair's term is up in May 2026, and President Trump says he's only going to be looking at people who want to lower interest rates. On the list is also Bessent, also Kevin Hassett, the chief economist to the president. And so if he picks someone from this administration, they are more likely probably to side with his viewpoint here.
Will the president wait until May 2026? We'll see. Akela Garda down in Washington, D.C. Akela, thank you. Let's extend the conversation with Terry Haynes of Pangea Policy. Terry, good morning and welcome. A couple of lines from the Treasury Secretary, Scott Bessent. Mission creep, institutional growth. Terry, what's he getting at?
Good morning, John. I'll add one more, which is internal, as in internal review. What Bessent is calling for is the Fed to look at its own non-monetary policy regulatory operations and assess those, assess whether there's been mission creep, assess how best to focus. So this is really, indictment is too strong a word, but it's, I think, but it's a suggestion to the Fed that what they need to be doing is taking a look at their non-monetary policy operations, firstly. Secondly, it's a not so subtle dig at Congress, I think, because what you have is a situation where Congress loads a lot of these non-monetary policy functions onto the Fed generally. And, you know, the Fed hasn't done this in a quarter of a century or more, so it's past time that they do it. And I think Bessent is making a nod in this direction politically, in part because he's trying to be helpful, firstly, but secondly, he's counseled Trump that in a week, particularly where you've got earnings, you've got tariffs coming up, and you've got gold going up, this is definitely not the right time to be shaking the markets with Powell.
Akela mentioned Representative Anna Paulina Luna and her referral of Powell to the DOJ. Does she have anything in common with what the Treasury Secretary is asking for?
You know, it's what I found interesting about Luna's letter to the Justice Department. Firstly, I think it's a stunt and it doesn't go anywhere. But secondly, you know, by looking at the Fed headquarters and the building operations, what she's bringing up, wittingly or unwittingly, is the idea that you know, governors other than Powell are involved in this. And, you know, Powell himself said once before he was chair, he was the administrative governor, meaning looking over the Fed's physical operations. That's done by other governors right now, and I think three of them are Biden appointees that were confirmed by the Democratic Senate. And you know what Bessent's looking at is kind of beyond Powell. What are the governors up to? What's the governors generally up to? Why are they involved in mission creep? And strangely, that's the kind of thing Luna's bringing up in her own complaint too.
So, Terry, are you saying that this criticism we see right now on Jay Powell could potentially expand to other individuals at the Federal Reserve?
I think that's entirely possible. I mean, look at the criticism that Trump launched against then Vice Chair for Supervision Barr, that resulted in Barr being replaced in that post by Governor Bowman. So this is not new for the White House, firstly. Secondly, you had this dovetails a lot into the mission creep comment by Bessent, dovetails a lot into what some candidates, I think particularly former Governor Warsh, have been talking about when they say that we need regime change at the Fed. They're not talking, Kevin's not talking about, only changing out Powell in that regard. And we need a different approach to Fed policy generally. That goes beyond Powell. So I think we're looking at more of the composition of the governors here generally. And again, I think Barr's a precedent in that regard.
What's the goal here? I mean, given the fact that we've heard from the president for quite a while that he doesn't want to fire Jay Powell, he does think he should lower interest rates, but he's probably going to. Right now, the Fed's on path to cut rates by 25 basis points twice for the remainder of this year. Mm-hmm. Why are we hearing about this from every hall of every congressional corner right now in every iteration?
Oh, I think most, by the way, I think most people in Congress are hiding out from this. I don't think they want any part of this. But what Trump's up to here is, first of all, Powell's somebody to blame. Everything's going swimmingly, as you heard Carolyn Levitt say in your intro piece, and everything's going great. There's only one fly in the punch bowl, and that's Powell, who's Mr. Too Late, Mr. Not Getting It, all the rest. Beyond that, I think what they want is they, being not just Trump, but people like Bessent, people like Governor Warsh, for example, are talking about a new and different sort of partnership where policy goals are more aligned. Even though the Fed is independent, policy goals are more aligned in kind of a Fed Treasury alliance than they are with the Fed as some kind of free-floating de facto fourth branch of government. I think that's the longer-term game here.
There is a conspiracy theory that part of this and the Washington Commanders or Redskins and getting renamed, and last night the dump of Martin Luther King Jr. files is all a distraction technique. Do you just shrug that off as being irrelevant, or do you think that there's something to that?
I think the presidents at the apogee of their power exercise as much as they can, however they can. Trump reminds me, in this one regard, reminds me nothing so much as Theodore Roosevelt a century plus ago, running around doing everything from strong-arming the Panamanians into building a canal to rewriting the rules of American football. So, that's very much in Trump's character, and he frankly sees the opportunity to do it. And if somebody tells him, is there a potential hook through which I can exercise some influence, he tends to take it right now. 2 years from now, maybe not so much.
Terry Haynes of Pangea Policy. Terry, appreciate the update. Thank you, sir. On monetary policy and central bank independence, of course, of the utmost importance for a lot of people. I get all that. It doesn't mean the institution should be beyond criticism, both on the monetary policy failures of the last several years and on the regulatory failures as well. I get that Wall Street loves the individual leading the central bank right now. A lot of people on Wall Street love Chairman Powell because they've made a lot of money. But there have been some serious failures over the past few years.
And a lot of academics have talked about it. A lot of economists have pointed to it. And people could argue that the inflation that we did see, the surge post-pandemic, was in part because this Federal Reserve did not raise rates quickly enough and then failed to really respond in any kind of material way. Look, there are real criticisms. The question is, what is the ultimate goal, and does it compromise the perception of independence?
Got some good news for you.
What's that?
We can talk about something else.
Yes.
Up next on the program, we can talk about earnings. Earnings from GM just around the corner. Plus, we'll catch up with Danny Berger with your morning movers as M&A heats up.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
9 straight days of gains for Mag 7 stocks. It's a stellar run. Longest winning streak going back to November 2023. Equity futures this morning negative by about 0.1%, pulling back from all-time highs on both the S&P and on the NASDAQ. With 3 hours into the opening bell, let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. The railroad operator CSX gaining in the pre-market 4.5%. This is off the back of a report from Semaphore that Berkshire Hathaway's BNSF is looking at acquiring one of its rivals. It's hired Goldman Sachs to do so. It's not clear what exact company it would be looking at, but really the only options are CSX or Norfolk Southern, so those shares are gaining this morning. Now, at the same time, we had earnings from NXP. This is the Dutch chip maker, though listed here in the U.S., and it seemed that it was a disappointment when it came to their outlook for the next quarter. Half of the company's exposure is to the automotive industry in terms of where they sell their chips to, so some real stress there in terms of supply chain issues when it comes to tariffs, costs there, also slow down EV demand, shares falling nearly 6% this morning. Finally, Opendoor, it's a relatively small company, but I wanted to bring this one up because it would seem as if the meme stock trade was back. Someone tweeted on X, which made its way to Wall Street Bets, something positive about the company. Maybe it's not important what they actually said, but the important thing is that this thing yesterday surged 121% at one point. In fact, the trading was so heavy that this individual stock made up 10% of all equity trading yesterday. It is gaining again in the pre-market, up 13%, giving some of those 2021 meme stock vibes, John.
A massive move, that's for sure. Big reminder of way back then. Danny, thank you. Danny with the latest movers. One more for you. Numbers from GM just dropped in moments ago. It's a beat on the top and bottom line. The initial number 253 on EPS for the second quarter, the estimate 233. The team's going to run through the details. We'll come back to that story in a few minutes' time. On our radar this morning, Treasury Secretary Scott Bessent is calling for a review of the Federal Reserve, warning on X, quote, mission creep and institutional growth risk jeopardizing the central bank's independence towards monetary policy.
So I keep coming back to what's the goal, because we keep hearing, and Caroline Levitt yesterday said that the president has no intention of firing Fed Chair Jay Powell. Now it's expanding out to other potential appointees, as well as some of the other initiatives that have been pulled back at the Federal Reserve. Is the goal to change the composition? Is the goal to have a scapegoat? Is the goal distraction? Is the goal something else? This, to me, is more important possibly than even some of these missives, because the market's largely shrugging it off at this point as just ongoing noise, unless you get some sort of real pushing out of Fed Chair Jay Powell. Does it really move the dial?
Not shrugging it off right now, though, is the Federal Reserve. They put out yesterday a 6-minute, 23-second video detailing all the refurbishments that are needed and the renovations that are needed, basically saying how office space expansion at the rear of 1951, an atrium of this 1951 building, going through why they had to use specific plaster when it comes to making sure they're up to par with government regulations. They are doing their best to try to get ahead of this because they know this is going to continue and definitely going to continue to May of next year.
Next week, tomorrow, there's a Federal Reserve meeting. And it could break in a rather dovish fashion. In that statement, in the first paragraph, they say labour market conditions remain solid. Well, we know Governor Waller doesn't share that view. Others might not either. So you could see a change in the language there, and much more of a dovish bias start to be built into the Federal Reserve as we work our way through the summer. So I think we always have to take a step back with this conversation. Yes, the White House wants rate cuts. No, the Fed is not delivering them right now and might not next week either. But the gap between where they want to be and what the Fed's about to do is not that large. The Federal Reserve is about to cut interest rates. There's a dovish bias. They're probably going to cut in September. And at the moment, the data is breaking in that direction.
But this is the reason why I say why now? Because ultimately, they're undermining their own argument. If you overlay that potential rate cut with some sort of political motivation, you're undermining the economic case that so many economists are making. So at what point are you're shooting yourself in your face, you know, you're cutting your nose off to spite your face kind of thing. I'm mixing metaphors. It's a Tuesday.
It's a quiet Tuesday.
It's a quiet Tuesday, and we're talking about renovations. I just keep going back to that. What is their ultimate goal?
We're still asking that question. I'm just going to answer with all of the above. All of the above.
I'm sure you're right.
Let's move to this story. Commerce Secretary Howard Lutnick meeting with Japan's chief trade negotiator Monday evening in Washington. According to Japan, the pair had in-depth discussions aiming towards a mutually beneficial agreement.
So this was the 8th trip of the trade negotiator to Washington, D.C. to have these formal discussions. It also comes on the heels of the Treasury Secretary going to Japan for the World Expo, to his words. But come on, he met with the Prime Minister, Shiba, and they're trying to get this deal to the finish line. And when he left, he put out this tweet that I think was really important because it goes against what Howard Lutnick's tone has been, which is August 1st is a hard and fast deadline. People can, of course, call, but that's the deadline. The Treasury Secretary said a good deal is more important than a rush deal. And this gives the sense that they're willing to give trading partners that are in these in-depth discussions a little bit more time if they're not done by the deadline.
If there was a league table for getting a deal done with the United States of America a few months ago, Japan was top of the league. The EU was bottom of the table. We've seen a complete reversal in the past few months.
And what happened? An election. And this is something that we increasingly have to look at. The domestic ramifications from the increasing trade tension and how much that is affecting some of the more populist bent that you're seeing in a number of countries, as well as what the cost will be to pay for some of the requests coming from the White House internationally.
A lot of tension between the US, the White House, and various trade partners. A lot of tension with China. Take a look at this. BlackRock restricting the use of company devices in China. According to an internal memo seen by Bloomberg, employees were told to use loaner phones and leave company laptops behind while traveling to the country for business.
My question was, were they actually still using their real phones and their corporate laptops before? Because pretty much everyone who I've talked to who goes to China on a business trip ends up using burner phones and burner laptops. It just heightens this question of how do you do business in a country that you can't get a concrete sense of what the rules of the land are and whether you could potentially be used as a chip in this sort of tit for tat between the U.S. and China.
I was shocked when I read this story because in 2021, we saw new laws come out of China that tightened data security. And anyone that goes to a country like China, like Iran, like Russia, like myself, you don't bring personal phones or personal laptops into these countries. That is standard operating procedure. So it's just so confusing that they've only decided to do this now. And I wonder who else is out there not actually going in with burners, because they should probably take a look at that when it comes to compliance.
We all had the same reaction to this story, I think, when it broke. That's the latest on BlackRock and China. Here's the latest on GM. Earnings dropping just moments ago. Joining us now is Bloomberg's Craig Trudell. Craig, the stock is lower by 2.65%. Have we just put the price of tariffs coming from the White House?
Yeah, this was a company that I think took a lot of people off guard when they announced earlier this year as much as a $5 billion hit to their bottom line as a result of tariffs. And it sort of, your initial reaction to that is, wait a second, this is an American company that builds a lot of cars in America. That is true, and yet they also build a lot of vehicles in Canada, in Mexico, in South Korea, which a lot of people, don't have a sort of full appreciation for. And the extent to which they're going to have to sort of shake up their production network to account for the fact that these tariffs, may or may not stay in place. I think to this point, we've seen Mary Barr really sort of take the Trump administration at its word that we are not going to go back to the way it was. And so, this is a manufacturer that, as of last year was going to build electric vehicles at one of its plants in Michigan. It's now going to build big combustion pickups and SUVs there, and that will allow for more production of big SUVs down in Texas. So, kind of pulling back a little bit from its transition to electric vehicles and kind of battening down the hatches because of just how impactful these tariffs are going to be.
There's some bad news and some good news this morning. The bad news is that net income declined 35% in the second quarter of this year compared to last year. The good news, Craig, is that a lot of analysts and investors have priced a lot of this in. I just want to understand whether the underlying business is receiving the kind of demand that's reflective of an economy still doing okay.
Yeah, I think it's fair to say that. I do think that there's some real concern about just how much kind of pull forward demand this industry saw ahead of tariffs hitting. We've talked a lot about Taco and Trump chickening out. This is one sector where he has not in any way sort of chickened out or pulled back. There's maybe been some incremental relief for the industry, but these are tough duties that car makers and their suppliers are facing. And it's one where, when Trump talks about ways in which, in his mind, the U.S. is being taken advantage of, it's kind of the sector that he jumps to first. And so I think, executives like Mary Barra and her peers are sort of, rethinking, just how likely it is that they're going to be able to sort of negotiate substantial relief from this White House.
But Craig, I was under the assumption that if you're USMCA compliant, at least with Mexico and Canada, you're not facing that 25%. So where exactly are the tariffs hitting?
Yeah, there are complex mechanisms with how exactly trade is going to change between partners, and I don't think that we can necessarily take for granted that there may be some changes to that. Of course, when we renegotiate USMCA, which Trump has made quite clear that he's not happy with where things stand there. I think the Korea element of this is a substantial portion. But there's also just, real sort of change, again, in the production network. These moves that the company is making sort of on a dime to go from, making EVs in Orion in their assembly plant in Michigan to now making, pickups and SUVs there. That costs substantial money, and that's investment that needs to be made now in order for production to start, 2 years out from now. And so we're going to see some of those hits to companies' bottom lines now, even if we don't necessarily see a substantial change in what's coming off the assembly lines for some time.
Craig, I'm just wondering if we can glean anything from this earnings report for tomorrow and what we hear from Tesla.
Yeah, I think GM, sort of quietly, sort of under the radar, had a heck of a second quarter in terms of EV sales in the U.S. They've roughly doubled their sales. I think, Tesla, of course, is still very dominant in the U.S. EV segment, but that is a segment that really has a lot of dark clouds hanging over it, given what the Trump administration has done and is doing. The Big Beautiful Bill didn't just take away tax credits for EV purchases. Republicans also zeroed out penalties for not meeting fuel economy standards. And we know that one of the big sort of sources of revenue for Tesla over the years has been not from selling cars, but from selling regulatory credits to other manufacturers who haven't made enough EVs, haven't sold enough of them, and need help with meeting these rules that are now going to be watered down and, more or less done away with. And how much is that a drag on Tesla beyond some of the factors that get more attention, which is, the potential damage that Elon Musk is doing to his own company's brand?
One thing that we saw with the financials was we saw them cross pretty high hurdles and their stock sales sold off. We're seeing GM shares lower by 2.3% in the immediate reaction. It's not necessarily the final one. But these numbers, as John was mentioning, were pretty good in a number of ways. And their estimate for the year ahead was pretty much in line with what they had said before, an estimate. So is this just a matter of expectations being really high, or just the fact that people have soured on this name and don't think it's tradable right now?
Yeah, I mean, I think we've actually seen, some relief in this sector. Our very own Esha Day had a great story to begin the week about how car stocks have actually gone from, getting beaten up pretty good to coming back a little bit. So we may we may be seeing that there's a bit of a sort of higher bar in order to kind of keep and maintain those gains. But we also should, keep in mind just yesterday, to your point about the sort of final verdict, remains to be seen. Stellantis, we saw really ugly numbers out of them yesterday, and that was a stock that went from down substantially early in the day to finishing up. And so I think there's a lot of sort of grappling with, the extent to which these impacts are lasting, maybe some willingness to look past the fact that these are adjustments that, these companies have no choice but to make. And GM, I think, is in a much stronger position than a lot of its peers in terms of, still continuing to make substantial money off of its trucks and SUVs in the U.S., and the demand for those is still extremely strong. I think they're also making some progress in turning things around in China. They are not getting back to where they used to be, but they're no longer losing money on a sort of quarter-by-quarter basis, and that's an important development to keep an eye on as well.
Hey, Craig, appreciate the update. Thank you, sir. Craig Trudell, thank you very much. Craig alluded to it. Lisa said it too. As we often say on this program, the first move isn't always the right move, but this is the first move. We're down about 2% on that stock in the pre-market. The headline from the earnings story from General Motors just moments ago, tariffs on foreign-made vehicles and parts chopping $1.1 billion from adjusted earnings.
And probably going to increase over the third quarter when some of the other tariffs come into effect, mitigating it, though, potentially by increasing prices and other measures out there, also pointing to the fact that they do expect electric vehicles to still be a profitable and bright spot in their sales, despite the fact that we have seen a pretty big policy shift on that front.
Equity futures more broadly doing okay. We're down about 1/10% on the S&P with an update on stories worldwide. With your Bloomberg brief, back with us, here's Yahara. Hey, Yahara.
Hi, John. We start with a recap of GM earnings. GM shares are falling nearly 2.6% in the pre-market. The company reported second quarter profit that beat Wall Street estimates, but fell short of a year ago. That's because, as you mentioned, John, President Trump's tariffs on foreign-made vehicles and parts chopped $1.1 billion from adjusted earnings. Though, here's the bright spot. GM maintained its full-year forecast for earnings. Meanwhile, a new report says President Trump's tax and spending law will add $3.4 trillion to U.S. deficits over a decade. The latest estimate from the Congressional Budget Office also warns millions will lose health care coverage. The analysis doesn't factor dynamic effects like its potential impact on growth or interest rates. And shares of Lindt are falling in Swiss trading, dropping by the most since early 2022 after the chocolate maker's earnings missed estimates. Lindt also reported weaker than expected volume growth and earnings as it faces soaring cocoa prices. Shares had been up 35% year to date through Monday. That's your Bloomberg brief. John?
Not a fan. Yahara, thank you. Never have been a fan.
This is my
chocolate. I like that soft-scented chocolate.
You like Laderack.
I like Laderack.
It's a bit more expensive. Yeah, exactly.
Just slightly more expensive.
Are you
but for
kidding?
special occasions.
Slightly?
Special occasions.
Okay, it's also pure
chocolate. Go in
chocolate.
store, they'll give you some samples. Walk away, come back for more later.
You guys are the worst. You go in there, you're like, hey, we're back. They're like, oh, here they come again.
No, they love us going in there.
So
they don't run their eyes. They give us the free samples. What are you talking about?
But we are consistent customers. That's why they give us the free samples.
For free samples.
No, and we're paying.
And we buy on special occasions.
But a large cocoa component is good. Hyper milk content tends to be a little bit sweeter.
Well said. There we go. Up next on the program, struggling to find a floor for the US dollar.
If the dollar cannot pick its head above its, let's call it mid-June levels, that for us suggests that at least in the moments, the dollar is still going to be a tailwind. The bias towards a lower dollar is likely intact.
That conversation up next with Sam Zeef of JP Morgan Private Bank. From New York City, you're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Record highs on the S&P 500 and the Nasdaq 100 coming into Tuesday, pulling back just a little bit this morning. We're down 0.1% on the S&P, down by 0.2 on the Nasdaq. Under surveillance this morning, struggling to find a floor for the US dollar.
The fact that you still have the dollar consolidating, that suggests to us that if the dollar cannot pick its head above its, let's call it mid-June levels, that's a level that we have not seen been able to surpass in about 4 or 5 weeks, of course. That for us suggests that at least in the moments, the dollar is still going to be a tailwind. The bias towards a lower dollar is likely intact.
Here's the latest this morning. The dollar facing a series of tests over the next week or so, including the July Fed meeting and August 1st tariff deadline. Sam Zeef of JP Morgan writing, despite signs of U.S. economic resilience, we expect further declines in the dollar over the medium term. Sam joins us now for more. Sam, good morning.
Good morning. How are you?
What are the pillars of this dollar weakness view?
Yeah, well, there's really two main ones. One, cyclical convergence. The U.S. labor market is still loosening. The Fed, we can argue when it's going to happen, but it's probably over the next couple of meetings going to start resuming interest rate cuts. And most of these other major central banks, the ECB or anywhere else, have kind of finished a lot of their cutting cycle. So we do expect some cyclical convergence there, some convergence between growth and interest rates abroad. And then second is a global asset reallocation story that's continuing. So global investors, we're not seeing any signs of liquidation of U.S. assets. You know, there's hyperbole around, there's none of that, but we're definitely seeing incrementally less inflows into the U.S. And when you set it against a backdrop of a U.S. with a very, very large trade deficit, a very large current account deficit, it needs those inflows just to offset the depreciation pressure on the dollar. So the more that you just see incrementally less inflows into the U.S., we think the bias for the dollar is to leak lower.
Let's address each point individually. 2 points. The first one, rate convergence. The pushback there would be that Europe is facing a disinflationary shock and maybe America is facing an inflationary shock, and the rates profile is going to be different because of that. What's your counterpoint to that?
My counterpoint to that is when you look at real interest rates and inflation-adjusted interest rates, then as the Fed starts to cut, even in the face of a slightly higher inflation environment, which is probably warranted given the labor market loosening, your real interest rates decline. And that's the convergence that we're expecting. Maybe not so much in nominal space, but real, and that's what's going to allow the dollar to weaken.
To the second point, the pushback would be that you aren't seeing necessarily outflows from the United States, and you're still seeing quite a bit of allocation to U.S. dollar-denominated assets. People are just hedging more, which is leading to a weakening in the dollar, but not necessarily any sort of reallocation away from the U.S. What's the counterpoint to that?
Well, you're right. I think for the dollar, it doesn't really matter which one it is, right? If you think about a global institutional investment fund, let's say, the first thing they're going to do is raise those FX hedge ratios, which they've allowed to decline in recent years, and that puts selling pressure on the dollar. And then as the assets that they own mature, they decide to undergo an asset reallocation. That's the next leg. And so, yes, I do think immediately what's been happening is an increase in FX hedge ratios. The next way that it continues is that asset allocation story continues. Either way, it results in a slightly weakening pressure on the dollar.
How does the Fed independence story fit in with the potential weakening of the dollar further?
Yeah, I mean, it's not a pillar of our view, but if you set it against a backdrop where already investors are demanding some more compensation to finance the U.S. fiscal deficit, to finance the current account deficit, then this just adds another risk to forcing investors to demand more compensation to that. So it doesn't really factor into our direct baseline forecast, but pushes downside risk to the dollar outlook.
So at the moment, do you think all this criticism is just noise?
I think our view, honestly, has been it doesn't really matter who the Fed chair is. They're one vote among 12. But the perception of the Fed's independence is crucial to thinking about the right value for the dollar or the value of long-term treasury yields.
So in that respect, who they appoint to be the next Fed chair for May, when Powell's term is up, is important.
In the signal it sends over how political the Fed might be, honestly, what that person's view is on monetary policy probably doesn't actually matter all that much. You need to convince the entire committee to either lower or increase interest rates.
How close do you think the committee is right now to reducing interest rates?
Yeah, I think in the next couple meetings, it's going to make sense. I think what's interesting about the debate over Fed independence, again, I won't come in one way or the other, is that if the call was 50-50, then honestly, it's probably incrementally slightly harder to cut interest rates just because it's been couched in such a political environment. But I do think either way, over the next couple meetings, we think that there's 50 basis points of cuts this year and probably 50 basis points next year.
Does it concern you that your call is very consensus and that there is a lot of bearishness right now priced into the market with positioning against the dollar?
Yeah. On a medium term, no, because fine, maybe fast money players, hedge funds, CTAs had gotten very short dollars, although honestly I would argue over the last week or two that some of that's been cleaned out. But the medium-term story, the asset allocation story, the increase in FX hedge ratios, these are funds, these are players that take a long time to make these decisions. I know from speaking from our clients at the private bank, they are having more of this conversation than we've probably ever had before, and still it's a slow-moving process to move from your current asset allocation to another.
Could play out over years, not just weeks and months.
Yeah.
That point to me was really salient, this idea that we've seen the hedging, but that's the first step. The second step is the allocation shift. And that's what I think a lot of people are very dismissive of by saying, look, the numbers don't show it right now, so it's not going to happen. Doesn't mean to say that that actually won't happen down the line.
Sam, strong defense of your call. Appreciate your time. Thank you. Thank you very much. Sam Seif there of JP Morgan Private Bank on the weak dollar call. The bias is still for this Federal Reserve to cut. What happens if that bias isn't doubled down on in the next few meetings? Then we're going to have a very different situation down in Washington, D.C.
In terms of a more aggressive tone, if possible, from the White House. I mean, I'm not sure exactly how to extrapolate that out, but it's not going to be pretty.
Select a new Fed chair. Maybe someone already on the committee.
Yeah.
Get that shadow Fed chair activated.
Yeah, I mean, at a certain point, how much has become a liability for the Fed if they really don't get more done?
Then you start pricing in their views for 26 anyway, regardless of what Chairman Powell is saying.
Lots of fun for the next couple of months.
We achieve the same thing.
Yeah, it's going to be fun.
Up next on the programme, Victoria Fernandez of Crossmark, Sarah Bianchi of Evercore, Adam Poser of the Peterson Institute, and Russell Brownback of BlackRock.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Was it easy to get the pandas to come back to Washington, D.C.? Did the Chinese say, we have some extra pandas, we don't know what to do with them, we're going to give them to you?
Well, it was a little more difficult than that. It probably took us, it was about over the course of a year where we had conversations with our colleagues in China, and we were able to get pandas here very quickly. I think it's a testament to the relationship we've built over decades, to the conservation success that we've had, here with our pandas and our panda program. And so it was a lot of conversations, but I think we always knew in the end that we did want pandas at the National Zoo.
How many pandas are there in the entire world?
So this is incredible because this is all due to this panda program, and this is so important. So when we started with giant pandas 50 years ago, there were fewer than 1,000 pandas in the world, right? We're talking in the wild and zoos, fewer than 1,000. And decades later, there are close to 2,000 pandas in the wild now. Actually, I think a little over 1,800. There are over 700 pandas in breeding centers. So as part of this program, we have tripled the number of pandas on the planet.
But still a small number of pandas.
Because of this program, there are more pandas on the planet, more quality panda habitat in the wild, and pandas have gone from being endangered to being vulnerable.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
The economy has proven quite resilient.
What we're really waiting for is this pass-through of inflationary impact.
Inflation will be transitory.
I really don't know that we're at the cusp of something dramatic happening to this economy.
This economy is supposed to slow down this quarter. We think it actually won't be as sharp a slowdown.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures on the S&P coming off all-time highs, down 0.1%, off record highs on the Nasdaq 100, down by 0.2%. This week is all about the earnings and a sprinkle of economic data. Tomorrow, numbers from Alphabet and from Tesla. This morning so far, from GM and from Coca-Cola.
Yeah, we just got Coca-Cola earnings that also beat expectations. The operating margin, I thought, was really interesting. Came in at almost 35% versus the estimate of 33%. We can get into all those numbers. To me, this sums it up. James Quincy, CEO, amid a shifting external landscape in the second quarter, the ability of our system to stay both focused and flexible enabled us to stay the course. This is what we keep hearing from corporate America time and time again.
Heard it from the banks, heard it from the airlines, hearing it from Coca-Cola this morning, from GM. The good news is that it's better than estimated. The bad news is it's worse than last year, and it's worse than last year because of the tariffs. The price is here. Tariffs on foreign-made vehicles and parts chopped $1.1 billion from adjusted earnings.
They are eating that on their margins. You are seeing their profits really get cut by this. But going forward, this means that they're going to be cutting costs pretty much across the board. And that, I think, is what everyone's going to be looking at. How much has become the norm going forward where there is increasing corporate cost cutting?
And are they going to have to raise prices, which is why the call is going to be so interesting. What does the CEO say about going forward, especially as clearly they are talking to this administration. The 25% levy on autos still exists, although if you are USMCA compliant, how much of that is being passed through? Are they going to have to pay on some of these products but not others? But Craig Trudell brought up a great point. A lot of these parts as well come from South Korea. They are not USMCA compliant, and that potentially could be one of the more expensive expenditures they have.
Bring production home is the message coming from the White House, and maybe they will. That's a story to track, not for this quarter, not for the next year, but the next several years. Big headline just crossed in. Kinda. From Coca-Cola. Plans to launch an offering made with, guess what? US cane sugar. This is what we expected to see from the company. This is the headline that's just dropped.
Well, we heard this from the president over the past few days. He said last week, President Trump said that Coca-Cola had agreed to sweeten its signature soda with cane sugar in the U.S. And not high fructose corn syrup. The company came out and said, we weren't familiar with that. We haven't done that yet. Now they are coming through with this. This really puts a lot of pressure on the sugar market. I'm very curious to see the potential ramifications there.
I want to know if Trump forced them into doing this today, because he came out with that statement, or already were there talks in the works, potentially a little bit of both. But they plan to do it. They're going to make it with cane sugar. This, we have to note, is actually a win for the MAHA movement, Make America Healthy Again, and RFK Jr. We saw it as well with when it comes to products from the ice cream makers and cereals.
Stock is up in the pre-market by 0.8%. Equity futures this morning lower by not even 0.1%. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark following fresh all-time highs. Sarah Bianchi of Evercore ahead of President Trump's August 1st tariff deadline. And Russell Brownback of BlackRock seeing compelling opportunities in fixed income. We begin this hour with stocks trading near all-time highs. Victoria Fernandez of Crossmark writing, this doesn't mean you should jump in with both feet as valuations appear stretched and sentiment is becoming extended. Victoria joins us now for more. Victoria, welcome to the show. I want to get to some of your calls. Financials, industrials, tech, three groups that you quite like. And we want to understand, what does that look like if the growth inflation mix starts to sour in the second half of this year?
Yeah, well, when we're looking at the market, we obviously want to be in there and taking advantage of movements in the market, but what areas are going to be where we want to put money to work if we do have a more stagflationary environment like you're talking about? And we know that there will probably be a steeper yield curve, and we've seen loan growth actually start to increase, a lot of that because of the ramifications for the reconciliation bill, right? If you have a boost to CapEx, a boost to non-residential construction. So we think financials can play well there. Tech just continues to take leadership, and that trend continues to be higher. And so we think that will probably continue, especially if AI is the area where we're seeing a lot of that CapEx be put to work. And in industrials, especially those industrial metals, kind of ties in to that as well, that non-residential construction, that CapEx component, having that onshoring come in. Those are all themes that we think play out in those areas, but it's not just that there's themes for them. Those three areas are in solid uptrends, and they have solid balance sheets. And so those are things that are important to us when we're looking where to invest.
Victoria, you said it, the earnings might hold up. How does the multiple hold up in the face of a steepening yield curve?
Yeah, it's really tough right now. I mean, we look at this multiple that we're seeing, and it is quite stretched. I mean, we're 23, 24 times next 12-month earnings. That seems really steep to us. Earnings is what have actually held this current environment up. It's what's allowed the consumer to continue spending. So we are concerned about earnings. You know, we're scheduled to do what? Low, middle single digits here this quarter on EPS growth. That's going to be the lowest in about 1.5 to 2 years. If corporations can't hold those margins up, y'all were just talking about the margins from Coca-Cola. We saw margins go down with GM. If they can't hold those margins up, then I think you start to see some of that flow through to the consumer, and you see that weakening in the economy. And I think the cyclicals that are now outperforming defensives, that will start to rotate, and you'll have to shift.
So talking about Coca-Cola, and we're not going to ask you about cane sugar and your preference between cane sugar
I
and
love
high fructose.
Mexican Coke, Lisa.
I know, that's right.
Mexican
a lot of people seek out the Mexican Coke because it has cane sugar. Now they have to do that no more because it's going to be offered here in the United States. Coke actually said that they did beat estimates in part because consumers did absorb higher prices. And I wonder how much you're starting to see this, but instead of a weakening in the economy, actually the strength of people absorbing it and saying, thank you, can I have another?
Yeah, I think a lot of it is just going to depend what we see in the labor market. You guys know that I've thought the labor market has been a little bit weaker than what the numbers have been showing. There's these underlying cracks in the labor market. They're not widening tremendously right now, but those cracks are there. If the labor market weakens more, and I do think we're going to see some of that coming in end of third quarter, beginning of fourth quarter, because a lot of the government layoffs, those severance packages run out in September. We're going to see some more weakening in the labor market. when wages start to really slow down, then I think you're going to see people go, wait a minute, how secure is my job? Maybe I start to pull back. Right now, they're not feeling that pressure. So they're willing to spend more and pay more for the things that are important to them. I think we could see that change in the fourth quarter.
Going forward, what are you looking for to really understand whether there is some sort of weakening in the economy? And if there's not, is this sort of feeling that the Fed is going to cut rates in the near term sort of counterintuitive, given the strength that we're seeing and on the margins, some inflationary pressures coming in a number of consumer-facing companies?
Yeah, the Fed is really kind of interesting right now because you have such this wide variety of views. I mean, you look at Waller saying we need to cut in July, right? You have Daly saying, oh, we're okay for right now. You've got Kugler saying, no, we're good for, where we are for quite an extended period of time. So there's many different views, and I'm not sure we can actually pinpoint what the Fed is going to do, even though it looks like September might be the first rate cut, just I think to get ahead of some of the weakness we could be seeing in the fourth quarter. But it really comes down to those margins and the earnings. If corporations continue to show that and consumers are willing to pay a little bit more, then it's going to hold the economy up. And I think we will be able to have maybe 125 basis point cut just so the Fed can say they're not behind the curve, that they're looking at things and they want to help, juice things up a little bit. But again, it is counterintuitive. If we're doing so well, why do we need to cut it all? Are we really that far above neutral? That's the question.
So you say the Fed's waiting for margin and earnings, but what about the tariff rates? Or have you given up on policy in general? Lori Calvasino was with us earlier in the week, and she talked about that they've just removed their attempt to quantify the policy backdrop for stocks this year because it's so uncertain and it keeps changing and it's very fluid.
Yeah, it is. I don't think you can, take your pen and put something into your outlooks in regards to tariffs. Well, the way that we're kind of looking at is saying, what are some offsets? And, is that going to be one for one? We don't know. But offsets to some of the effects of tariffs are going to be some of the benefits from the reconciliation bill that people think will be coming to fruition. I think that's why the market keeps moving to all-time highs. They're seeing some of these benefits. They're seeing some of the hard data look a little bit better, weekly claims, industrial production, retail sales, and they're thinking, okay, there's enough benefit coming out of the reconciliation bill and better hard data to offset what we're going to see coming out of the tariffs. They're kind of weighing that scale right now, and they have them somewhat equal. If one side starts to outweigh the other in the near future, then I think we can see the market shift.
When you say benefit of the one big beautiful bill to certain parts of the market, what industries are you thinking of, Victoria?
Yeah, I think it's going to come back to kind of what we were talking about in the beginning. You're going to see industrials do better. I think you will see financials do better, again, because you'll see a steepening of the yield curve. You're going to see some of the elements that are in there that will continue to do well for the economy in regards to construction. So I think those are areas that you can continue to see growth.
Victoria, stay there. Just stay close. I just want to bring in these comments from Mohammed Al-Arian, who just posted this out on social media. Reads as follows. This morning, U.S. government criticism of both Federal Reserve Chair Jay Powell and the institution itself has broadened to include mission creep and the effectiveness of other officials. The developments of the last few days reinforce my view. If Chair Powell's objective is to safeguard the Fed's operational autonomy, which I deem vital, then he should resign.
This goes to something that a number of academic groups have really pointed to, which is there have been signals of mission creep along the way. And right now, this administration is highlighting it in a highly political moment. But this is something that a growing number of people really do believe has been a problem and part of the reason why inflation was allowed to pick up as much as it did. So there is legitimacy and sort of pockets of questions in some of what the administration is saying. How it's being perceived by markets, though, is an entirely political patina given some of the other commentary.
Mohammed goes on to say, as to the market reaction, most of the frequently mentioned candidates to replace Chairman Powell would be able to calm any potential market jitters. Victoria, can I just ask you, what would happen in your mind if we did get the outcome that Mohammed is suggesting?
Yeah, I'm not sure that it would actually calm the markets that much. I actually think it might give us some increased volatility and maybe actually see yields move a little bit higher, which I know is counterintuitive. But I have to think that if you have someone come in that's appointed by Trump, people automatically think that they're going to lower rates, but you're going to have a Fed that is probably going to be against them. The other members of the FOMC I don't think are going to react well to having that happen and to have Powell resign. And he's going to have, the new person will have to have the support of all those people to get a rate cut done. So I actually think we might see more volatility in the market in the beginning if Powell was to resign.
Victoria Fernandez of Crossmark. Victoria, thank you. Just to repeat what we just heard from Mohamed Al-Arian, if Chairman Powell's objective is to safeguard the Fed's operational autonomy, which I deem vital, his view, he should resign.
What I find interesting is that last point as well, to the market reaction about these candidates that have been mentioned. They would be able to calm any potential market jitters. Victoria says no, but we have been talking about someone coming into that job if Fed Chair Jay Powell was fired. What Mohamed is saying is if he resigns and then one of these people come in, then you are still keeping that Fed independence because Jay Powell himself is taking himself out of the equation instead of the President of the United States.
He also says, I recognize this isn't the consensus view which favors him staying until the end of his tenure in May, nor is it the first best, which is simply not attainable. Yet it's better than what is playing out now, which I find interesting. Growing and broadening threats to Fed independence and will undoubtedly increase should he remain in office.
The idea of just take yourself out of the equation, let the central bank keep on doing what it does. This actually, according to Deutsche Bank strategists, just to the point of what markets do with any type of ouster or anything that's perceived as an ouster. Strategists Matthew Raskin and Stephen Zhang yesterday said the potential ouster of Fed Chair Jay Powell would lead to a 30-year yield rising by at least half a point. So by more than 50 basis points in response to that. At this point, can you get some sort of graceful exit stage left, even if it is ostensibly on your own volition, given some of the noise that really has come around this?
If you wanted a question to ask in the news conference a week tomorrow, quote that and ask the question. See what Chairman Powell's response would be.
I love it, the cheat sheet from John Farrow, if you want to, know what to ask.
Just throwing that out there.
Yeah.
Dear Michael McKee, if you want a question, I can just send Mike an email later and see if he wants to ask that.
I think that a lot of people would be curious of the answer.
I'm sure Mike's got something better. Equity futures right now in the S&P, just about unchanged on the S&P 500, very close to record highs. With an update on stories worldwide, with your Bloomberg Brief is Yahira. Hey, Yahira.
Hi, John. We start with the latest from Coca-Cola. It reported second quarter sales growth that beat analyst estimates as consumers continue to pay high prices for its soft drinks. The company also raised its full-year growth outlook, and Coke confirmed that what President Trump said last week, which is that it will launch a new product made with cane sugar this fall. Meanwhile, the Trump administration says it's deploying more immigration agents to New York after an undocumented migrant allegedly shot a federal officer. Homeland Security Secretary Kristi Noem blames the city's sanctuary policies for releasing repeat offenders, while New York officials say they follow state law and are targeting dangerous individuals in coordination with federal partners. And Malcolm Jamal Warner, the actor who rose to fame as a child star on The Cosby Show, has died. Warner drowned while on a family vacation in Costa Rica. Authorities said in a statement that Warner had apparently been swept away by a current and that bystanders tried to rescue him. Warner was just 54. That's your Bloomberg Brief. John?
Tragic. Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, 10 days and counting.
The August 1st deadline is just really the start date for when the United States of America will begin collecting this revenue from all of the countries around the world who the president has sent these letters to. You could see some more letters before August 1st. You could have some more trade announcements as well.
We'll get the latest in the nation's capital with Bloomberg's Akeda Gardner. She joins us next, live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Quite a run for equities for the stock market stateside and worldwide. Equity futures this morning just a touch softer, weaker, lower, down by not even 0.1% on the S&P. Earnings season picks up. Tomorrow afternoon, you'll hear from Tesla, you'll hear from Alphabet. As we kick off earnings season for the Mag 7, Mag 7 names, 9 straight days of gains, the longest winning streak of the year so far. This equity market is doing okay, even if it's driven by just a handful of names. In the bond market, let's talk about fixed income. 2-year, 10-year, 30-year. I want to have two different conversations here. What's happening at the long end and then what might happen at the front end. The long end this morning, yields higher by a basis point or two, 439.37. Yields on 10-year bonds falling for 4 consecutive days coming into today. The focus on debt, not just in America, but worldwide. The UK making some news early this morning.
Yeah, this is something that people are watching as potentially you have governments that are trying to plug the gap at the same time that their growth has been slowing down. We've seen the UK face these issues. We've seen Europe on the margins, although they're not as indebted. And then you see Japan. This has been really one of the themes. It's a global bond market, and we've seen that in a massive way.
This debt spiral that you find yourself trapped in. Growth starts to go down, tax revenue falls, and what you end up doing, you start talking about more tax hikes. What happens? Growth starts to go down, tax revenue falls. What happens? You start talking about more tax hikes. That's a spiral you want to try and escape, and it's a spiral that the UK risks falling into.
And one of the things that a lot of people have noted, yourself including, is that this is the spiral of developing nations, not of the developed world. And you start to see that type of dynamic really affect the developed nations world, or is the UK somewhat different? If the US finds itself in a situation where growth is actually slowing substantially, and it does face some sort of reckoning on the fiscal space, which it isn't yet, do you see a similar type of reaction in the bond market? Not yet, but the UK is a cautionary tone.
EM-type dynamics taking a hold of DM. Here's another example of that. The pressure on Chairman Powell on the future of central bank independence. This from Mohammed Al-Arian moments ago and on social media. If Chairman Powell's objective is to safeguard the Fed's operational autonomy, which I deem vital, he should resign.
This is something that is counter-consensus, as he pointed out, and comes as there is a whole bunch of noise around some of the measures that the Federal Reserve has taken. But Mohammed's point here is well taken, which is, at a certain point, the discussion, the noise around taking out the Fed chair is counterproductive to the goal of the central bank, and some of the other potential nominees would do a pretty good job. So why not just usher them in?
It's going to be a busy 2 weeks for the Federal Reserve and for the trade story as well. Under surveillance this morning, 10 days and counting.
The trade team and the president himself continue to be very engaged with countries around the world when it comes to our trade agreements. The August 1st deadline is just really the start date for when the United States of America will begin collecting this revenue from all of the countries around the world who the president has sent these letters to. You could see some more letters before August 1st. You could have some more trade announcements as well.
Here's the latest this morning. Countries lining up to strike trade deals ahead of President Donald Trump's August 1st deadline. Commerce Secretary Howard Lutnick meeting with Japan's chief trade negotiator Monday evening in Washington. Bloomberg's Akela Gardner joins us now for more. Akela, help us work through this issue. Anne-Marie was talking about it earlier on the program. You've got one official in the White House, part of the cabinet, turning around and saying, don't worry too much about these trade deadlines. What matters here is a good deal, not a bad deal done quickly. We hear from another official that says it's a really important deadline, we're going to get lots done. And then another official saying you might see letters sent out before that deadline. Which one is it?
Well, right now, August 1st is the deadline in which they're saying that they're going to begin to collect tariff revenues.
But as they've said many times in the past, they're still open to negotiating beyond August 1st. So even if those tariffs go into effect, they're saying countries can still keep calling the phone and ringing President Trump. But something that you mentioned there was those meetings yesterday with Japan. That was the 8th round of trade negotiations for Japan. And Japan is one of several countries who have been negotiating with the administration for months and yet still saw a letter from President Trump simply setting their tariff rate. It was about 25% that President Trump has set it out. That's up only 1% from April. And a lot of countries are starting to digest that the White House and the president himself has not changed his mind when it comes to the level of tariffs that they're going to see. It's not much different from April, despite the fact that we've seen this pause. But some of the countries that I'm watching still, India is a country that the White House and the administration continues to say that we're expecting to seal a trade deal sometime soon. The EU is also pushing for a deal this week and preparing for a possible no-deal situation where they could potentially retaliate. But as we saw with China, which did retaliate very early on in this trade war, saw their tariffs exceed up to 100%. And so there is huge risk for the EU there. And China is another country that is expected to negotiate beyond that August 1st deadline because they have their own separate trade agreement. Secretary of the Treasury, Scott Bessent, is someone who is expected to meet with Beijing sometime early next month.
Yeah, and he told us, don't worry about that China deadline on August 12th. Kayla, we do have the president of the Philippines sitting down with President Trump today. Caroline Levitt alluded to trade is going to come up in the conversation, but the Philippines thinks potentially they could secure a deal. What are you expecting out of this meeting today?
Well, the president has been saying that he believes the tariff rate that the president has floated at 20% is very severe. He is one of many countries that wants to see that lowered. But really his challenge today is to simply get through this Oval Office meeting. We've seen time after time foreign leaders come to the White House and have these confrontations with President Trump. So a lot of leaders simply come in wanting to leave that meeting unscathed. And I'm sure that's the same goal that President Marcos has today at the White House.
Kayla Garner with the latest down in Washington, D.C. Kayla, thank you. The trade deadline fast approaching. We're still trying to figure out who's paying for the tariffs. Andrew Honhorst of Citi with this to say, tariff costs will be absorbed by either foreign exporters, domestic firms, or consumers. A modest increase in consumer prices suggests that so far the cost is being absorbed by firms and not consumers.
In other words, this isn't going to be inflationary, at least longer term. He said corporate earnings could hold some clues, and on the margins, we're seeing some companies absorb it in their bottom line. We're seeing that with GM. You're seeing others marginally increase his prices. We're seeing that with Coca-Cola. But either way, the sort of broad-based nature of who absorbs them is leading to Andrew Hollenhorst's team, who has been arguing the Fed should cut rates because inflationary pressures are not the preeminent concern.
He's going to join us at 8:30 Eastern Time. And as you said earlier this morning, repeatedly, I think, maybe GM numbers this morning speak to this kind of theme.
Well, the idea that GM did not pass along price increases yet, we'll find out exactly what they do, but they are planning cost cuts. And that raises a question of weakness in the back of this rather than some sort of inflationary push. I'm just struck by how each sector is completely different. Coca-Cola able to raise prices because it's just a can of Coke. But for a whole car, it's kind of a different story. And I think that you're seeing it in these pockets that aren't necessarily a consistent story.
Can of Coke with cane sugar.
I know.
Just around the corner. There we go.
Get excited. Is that Make America Healthy again? Is that healthy? It's healthier than the...
Return of traditional Americana.
Hold on a second. You would not have a can of sugar.
I will have a can of sugar.
No, he said he's going to try that.
On a special occasion.
Or is that the cane sugar?
But not a can.
Do you know what's not healthy? Diet Coke, and that's what the president drinks.
You tell him. Up next, Adam Posen of the Peterson Institute with the pressure building on Fed Chair Jay Powell.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Futures negative, down 0.1% on the S&P, down by close to 0.2% on the Nasdaq 100. Mentioned this stat earlier on in the program, comes from Alex Semenova of Bloomberg News. 18 sessions now without a move of 1% or move in either direction, the longest such streak of the year so far. Things are a lot quieter. You can measure it in various ways, but things are a lot quieter in this market than they were a few months back.
It just shows that the more volatile the headlines sometimes, the more people just get this sort of numbness. Because what you saw in the first Trump term was actually volatility went really low. And you're seeing something similar in effect, yes, maybe because things have quieted out, but also because how do you make bold moves when you don't understand what the parameters are?
Then it blew up in 2018.
Well, that's true.
Fun and games. Fun and games. Equity futures right now in the S&P then, negative by not even 0.1%, very close to all-time highs. Your morning movers are lined up with Danny Berger. Hey, Danny.
Hey, John. Definitely seeing some move when it comes to individual companies off the back of earnings reports. We heard from GM in the last hour. We have the figure for the tariff hit. It is $1.1 billion. Beyond that, though, they saw things like EV sales doubling. They also maintained their full-year outlook. And to be clear from GM, we had already learned from them that they estimated that their full-year tariff impact would be something like $5 billion, but just shows this market's willingness to punish companies that are outlining what the tariff impact will be. We also heard from Coca-Cola a very muted reaction from them. Initially, shares were higher when they reported, but they've just ever so slightly started to sink down. They did beat on multiple fronts. They also were able to maintain and beat on margin, showing that they're able to pass through cost increases to their customers. They also announced a new launch per the president's request, a Coca-Cola that has cane sugar. But again, we talked about the bar being low for earnings season. Even a company that beats still isn't rallying off the back of it. Though I will say one company that is rallying off the back of their earnings is Northrop Grumman. We're getting a lot of the defense companies reporting today. Those shares are higher by 3%, a beat and a raise. Specifically, the president's 2026 budget request appears that it will have a lot beneficial to Northrop Grumman. Their missiles, RBC noting that their B-21 program seems like it will have a double of funding. And just a reminder, this company's B-2 bombers were used in the recent Iranian campaign. So a lot of demand there with geopolitical tensions, John.
Hey, Danny, thank you. Appreciate the update. On our radar this morning, let's get back to GM. Second quarter profit taking a hit due to the president's tariffs, levies on foreign-made vehicles and parts, chopping $1.1 billion from adjusted earnings.
Potentially, that could increase in the third quarter because the ramifications haven't been fully felt or weren't fully felt in the second quarter. Some key questions for the earnings call that I think we have to ask. How much is consumer demand going down, just from the broader economic picture? 2, electric vehicle sales and how much that's going down as a result of policy change. But number 3, are they going to raise prices? Are they going to cut costs? Are they going to cut jobs? How much are they going to bring back to the United States? This is going to be really at the epicenter of so many trade discussions, just simply because the auto manufacturers have been consistently at the center.
And that supply chain, when it comes to the auto sector, is globally so intricate, so integrated when it comes to where they're sourcing parts, whether it's South Korea, Canada, Mexico. And this story is not going to end for them. Over the weekend, the Commerce Secretary, Howard Lutnick, was asked about what's going on with trade between Mexico and Canada. And he said said, of course, we're going to renegotiate USMCA. Remember, USMCA was from Trump 1 when he wanted to renegotiate NAFTA. And he says, of course, we're going to try to get more concessions. So for the auto players, this is going to be a story, not just for the rest of 2025, but definitely well into 2026 and probably 2027.
This is going to hang over the industry for quite a while, to Anne-Marie's point. We had a front loading of purchases going into the tariffs on specific goods, specific items across specific industries. The auto industry was very much one of those industries.
And so at this point, I wonder how long they can hold off before they raise prices. Remember, Ford said that they were going to hold off on raising prices for a while. And then they went ahead, they were the leaders when it came to raising prices. Very curious to see how much that crimped demand and what we hear from them.
GM is down in the pre-market by about 3.4%. On the trade front, White House Press Secretary Caroline Leavitt saying the U.S. remains engaged in talks, adding that the Trump administration could announce more deals or send more tariff letters before the August 1st deadline.
So what's changed? This has been the whole story the entire time. We're going to send the letters when we decide. We saw a drip of them immediately weeks ago. Then they stopped. Then we said we're supposed to get a bunch by or before August 1st. And then the Treasury Secretary coming home from Japan, I can't get over this. A good deal is more important than a rush deal. Basically saying, we will give you more time. And what did he say to all of us? Market, ignore that August 12th deadline when it comes to China. So deadlines almost don't really mean anything anymore. What is important, though, are you going to have the customs computers adjusted by August 1st? So whatever tariff rate is currently on the books right now, the U.S. will start to enforce.
Self-imposed deadlines. We should keep referring to them as self-imposed deadlines. They can be changed at any time.
Letters. I mean, honestly, you're going to get a letter. It sounds like, again, like a threat. If you don't quit it, you're going to get a letter.
That's exactly what it is.
I know, but it sort of feels a little bit like what kind of teeth are there.
Thank you for your attention to this matter.
There we go. That's the latest on trade. Citi asking its first-year analyst to disclose whether they've already accepted a job from another company. Goldman making a similar move earlier this month as banks look to clamp down on recruitment by private equity firms. A long, long list of banks is starting to build.
Yeah, although Goldman Sachs learned the hard way that on one hand, you can't just say, please don't take anything. You've got to pledge your loyalty. On the other hand, how do you offer jobs that they actually want and that can compete with private equity? And the key question is, how much are private equity companies still going to look to poach the best from some of the training programs of the big banks? They have to do the work, and then private equity reaps the benefits because it's a more desirable job versus people who want to stay.
The problem I have with this story is, okay, so they're asking you to disclose if you got a new job. Just don't do it. Be bold. What's the worst they're going to do? Fire you? Because then guess what? You have a new job waiting for you.
Get them to sign a contract and a non-compete and give them favorable terms.
Yeah, but that's exactly
to secure them. I mean, isn't that the way this should work?
Why not do the sweetener rather than the stick?
Precisely.
At the same time, I think that to your point, if somebody did that, it looks pretty bad. I mean, you get blackballed in the industry if you promise to do that. So I imagine that there is a reputational risk to not act that way. That said, there could be a better
Don't take my
way
advice,
hiring.
kids.
I'm just saying.
Citi, the latest bank, pushing in that direction.
If my kids are listening, don't do that.
That's advice for your kids?
Well, I don't want them to do that. That's
Let's turn to tensions between the Federal Reserve and the White House, not just Casa Bramo. Treasury Secretary Bessent pushing for a review of the Federal Reserve, posting on X, quote, significant mission creep and institutional growth have taken the Fed into areas that potentially jeopardize the independence of its core monetary policy mission. Adam Posen of the Peters Institute joins us now. Adam, welcome to the program. I'd love your reaction, not just to that, but also to this. Some comments from our mutual friend Mohammed Al-Arian a little bit earlier this morning, who said this: the developments of the last few days reinforce my view that if Chair Powell's objective is to safeguard the Fed's operational autonomy, which I deem vital, then he should resign. What's your reaction to that, sir?
Those comments are not well taken, John. Basically, what Mohammed would incentivize and what others on the same line would incentivize is anytime the president wanted to get rid of a Fed chair, wanted to affect a Fed chair, they would just throw up an enormous amount of noise and pressure, and then that becomes its own justification. Well, they've lost the president's support. The whole point is that you need to be able to operate as chair of the Fed, and the Fed FOMC needs to operate while not being able to ignore the politics. So if you look, you just saw, I'm sure, the op-ed by Bernanke and Yellen talking about this in more general abstract terms, but think about Paul Volcker doing the necessary disinflation in 1985. Well, imagine you go back and look at what the Congress and the president were saying about him then. And imagine then Mohammed or somebody stood up and said, well, clearly it's imperiling the institutional strength of the Fed if they continue to do this despite everyone's objections. The other point I would make is that everything that's been said about the Fed so far about mistakes and now getting into mission creep, which is a more serious issue, isn't about Fed independence. It is about getting a proper mandate and having proper hearings from Congress, not from the executive branch, about what the Fed should include. And the hierarchy of goals for the Fed is very clear. Stable prices and full employment above all else, financial stability. So this is all just a bunch of game playing. I've heard people saying that Bessent and others in private say they're just working the referee and the referee can't fight back. Well, that's no way to think about the most important economic policy decisions in the country.
So now there's a question, Adam, of how much the central bank should be considering the tariff ramifications and how inflationary this is going to be. On one hand, you see an increasing number of corporate earnings that show them really absorbing a number of the tariff impacts on their bottom line. And then you have Scott Bessent just coming out speaking moments ago to media saying that tariffs are bringing manufacturing back to the United States. And we did hear something akin to that from General Motors. What's your take on what the first read is on how tariffs are being sort of borne through the economy?
Well, as you were just having reported, the fact is, Lisa, that three things are going on. First, companies are burning through inventories. That's notably true in the auto industry, and waiting to put up prices until they burn through the inventories of the inputs and the final goods they front-loaded. Second, we're now seeing a lot of beige book type documented anecdotes of companies getting ready to increase prices. Second, because of the kind of political climate we're in, and this was mentioned by Danny Berger, I think, in your reporting, that you don't want to be the target. You don't want to be the one to visibly raise prices. The market reacts unless everybody else does, but eventually you have to. So what you end up doing is spreading the price increase across non-tariff goods as well. The third point is the manufacturing one. As Robert Lawrence of the Peterson Institute has published repeatedly, you can get a little bit of gain in manufacturing, but it's just completely cost competitive and uncompetitive to bring back all kinds of things here. And so if you start putting up huge amounts of barriers, eventually, yes, you can create more cars for the US market, but this will be at the expense of the consumer and the expense of the taxpayer. So, and in the end, you will not fundamentally change the US economy.
Adam,
sorry.
Well,
so the last, go ahead, sorry.
No, I was going to say, I know that you've been pretty against any kind of tariff, and you're very, very much for free trade. And I just wonder if you've been surprised by how benign some of the ramifications have been so far, or is this always how it is at the beginning because of what you just said, because of the bring forward and some of the other sort of more immediate adjustments that can't happen over the longer term?
It's a good question, Lisa. I don't think I know what always happens, because multiplying your tariffs by 10 or 20-fold in an advanced economy has not happened in 100 years. So I can't tell you that this is the precedent. I can tell you that this is certainly within the range of where I would have expected lagged effects to take place. So it's not surprising we haven't had huge inflation yet. And as Secretary Bessent has rightly said, the issue is going to be, once we get the jump in price level due to tariffs, does that transmit into second round inflation effects? And that's what the Fed has to call. So I think the big surprise more is the amount of deportations, disruption to migrant workers, disruption to immigrant workers, even with documentation, hasn't had as big an effect on the economy as I expected. That's my surprise. But the tariff stuff seems to be about where it should be so far.
Adam, Governor Waller is already saying that he doesn't see a inflationary spiral when it comes to tariffs, and it's going to be only a one price hike adjustment, and potentially he is going to dissent at the Fed meeting. Are you expecting some potential dialogue, debate at this FOMC meeting?
I think Governor Waller sincerely believes what he's saying, and more than that, he has a legitimate argument. If I was in the room, I would be debating the other side. But I think that is a legitimate thing for the FOMC to be debating, independent of political pressure and name-calling, Anne-Marie. And that's where the focus should be. against what Chris is arguing, and I think Chris got a bunch of things right over the last few years that other people got wrong, so people should take his views seriously. But I think he's underestimating how much inflation expectations have been de-anchored by the last few years. I think he's underestimating how much the problems in the labor market and the tightness in the labor market is likely to give rise to second round effects. I think he's underestimating how much the fiscal policy in the end will be stimulative. And I think he's underestimating how much shortages in particular industries will be very visible and salient for people the way eggs were or a few other things were under Biden. And so the de-anchoring effects of the inflation we're about to see, or the price level jump first round, as you rightly put it, about to see are going to be bigger. But this is the debate that an independent Federal Open Market Committee should be having.
This might have been shorter if we just asked you what he got right, Adam. But we'll leave it there. Adam Posen of the Peterson Institute. Adam, appreciate your time, as always. A long list of things that Adam believes Governor Waller is underestimating.
Yeah, and that's one reason why a number of other members disagree. This is an active economic debate. I think it's important to keep reiterating this, which is one reason why a number of people, including Chris Waller, would like to see that active debate on the Federal Reserve when they meet next week.
It's a credible argument, let's put it that way.
Yes, I think
you can debate it, disagree, but it's a credible argument with the right intent. Equity futures right now in the S&P, negative by not even 0.1%. Let's give you an update on stories elsewhere with your news worldwide and your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Trade negotiations are continuing ahead of President Trump's August 1st deadline. Press Secretary Caroline Leavitt told reporters more countries could receive tariff letters before then. Trump is set to meet with the president of the Philippines, Ferdinand Marcos Jr., today at the White House. Meanwhile, the White House said it would remove the Wall Street Journal from a small group of reporters traveling with President Trump on his trip to Scotland. This coming after the paper published a story alleging the president once sent a suggestive birthday letter to the late disgraced financier Jeffrey Epstein. Trump is suing the paper over the report. And Victoria Beckham is set to start in her own Netflix show this fall. This follows the success of her husband David Beckham's documentary, in which she emerged as an accidental star. Her show will follow the former Spice Girls day-to-day as the creative director of her own fashion and beauty brands. And she told Bloomberg nothing will be sugar-coated. That's your Bloomberg brief. John?
The news you need. Yahira, thank you. Appreciate it. More from Yahira in the next hour. Here's some news you might need. The Treasury Secretary, Scott Bessent, with a new date to meet the Chinese.
Says he's going to meet his Chinese counterpart in Stockholm Monday and Tuesday. So this obviously comes before that August 12th deadline. He told us just last week it'd be happening in a few weeks and finally have a date. What are they going to discuss? Because they seem to be able to get over the hump of rare earths and what's going on with export controls. What is next in this relationship?
Another round of talks between the US and China scheduled for next week. Up next on the program, the big bid for bonds.
There's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market, how to get into the bond market.
That conversation up next with Russell Brownback of BlackRock from New York. You're watching Bloomberg Surveillance.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
This headline just dropped in moments ago from the Treasury Secretary, Scott Bessent. Another round of talks between the United States and China, meeting Chinese counterparts in Stockholm across Monday and Tuesday. That headline crossing just a moment ago. The price action looks like this morning. If you are just joining us, welcome. Equity futures totally unchanged on the S&P 500. On the Nasdaq, down by not even 0.1%. That's the equity market under surveillance this morning. The big bid for bonds.
I don't see 10-year yields at 5%. I think they belong at 5%. And that's the great puzzle, that they're not there. That's telling us that there's constant demand for government bonds. There's constant demand for the bond market out there. Every time I meet with investors, they're trying to figure out where to get into the bond market, how to get into the bond market.
It's the latest this morning. US 10-year Treasury yields rising, or rather falling for a 4th day through yesterday as President Trump's tariff deadline adds to demand for haven assets. Russell Brandback of BlackRock calling this, quote, one of the most compelling fixed income opportunity sets in decades. Russell joins us now for more. Russell, good morning, sir.
Morning.
We've seen a bit of a rally in Treasuries over the previous few days. What's behind that big wall of demand?
So, you know, that we're calling it one of several transcendent influences today that really sort of drive market outcomes, and that is this wall of money that exists today. So you look in the United States, $218 trillion of private sector net worth. When you put that in comparison to the size of the asset markets today, it really is a world where there's too much money and not enough yielding assets. And so that's a transcendent influence in the face of lots of policy uncertainty, that along with a resilient economy.
Everything seems to have settled down over the past few months. There's something you and the team have said, that genuine economic risk is muted. What do you mean by that?
It's this series of structural, foundational influences that have transcended uncertainties that the economy has faced in 2023 with the regional banking crisis, an acrimonious election last year, and the uncertainty about the sequencing of policies and implementation this year. And yet you get these momentary pullbacks of consumption or investment just as velocity slows, as uncertainty sort of cycles through the system. But then it rebounds, and you've seen the economy accelerate into the 4th quarter each of the last 2 years. It's my expectation you'll see the exact same thing unfold this year.
Which is a reason why you've been reducing your position in cash and deploying, still seeing spread compression through the remainder of the year. I just wonder if the book's really been written on the policies that have been implemented and the policy uncertainty and the ramification on the economy. Why do you think that we have enough information to say we will still see that reacceleration, even if some of those tariff ramifications haven't been fully felt yet?
So again, because these underlying influences are so powerful, these policy evolutions are only marginally, incrementally determinant to outcomes. And, listen, I think markets have correctly assessed the tariff situation as benign at the end of the day. At the end of the day, tariffs are a tax And so the debate about whether they're inflationary, you think about if we were sitting here talking about an income tax, we wouldn't be discussing whether it's inflationary or not. We'd be discussing its impacts on growth. And so when you think about, and many guests have been on your program over recent days talking about how that tariff impact is spread out over so many different nodes of that value chain between the point at which the good arrives at port and when it ends up on the store shelf. So these are marginal sort of shifts in underlying economic actors and the influences there. But overall, these foundational supports are what's driving markets.
And that's driving credit, that's driving equities. How should this really play through in the treasury space, given the fact that we have potential rate cuts coming down the pike, even with strength in the economy, and a real question around how much it's going to be an inflationary push over the next 6 months?
Yep, so I think the bond market has found an equilibrium all throughout this year. It's steepened in deference to slowing growth and inflation that's still above target, and a Fed that will likely deliver a couple of rate cuts by the end of the year. The front end of the curve is anchored to Fed policy. The back end is anchored to nominal growth. And if you think about a 4.5%, 5% nominal growth outcome this year, that's exactly where the bond market is today. We see this fixed income regime as one where there isn't a big interest rate bet to make. It's about clipping that coupon. It's about the income associated with the fixed income opportunity.
Is that another way of saying this Fed conversation is not that relevant?
So, listen, I actually think the debate that is taking place today is a healthy one where there's credible arguments on both sides. Don't cut or cut. I happen to be in the camp that says the setting of policy today is suboptimal. You think about the K-shaped evolution of the economy today. I don't call it a K-shaped recovery because I don't think the U.S. economy is actually cyclical. But the current policy setting today, think about the savers, which is really the purview of the wealthy and higher income cohorts today, $150 billion a month of interest income accruing to those economic actors. Low income, low wealth cohort households, that's where all the floating rate debt is today, your credit card debt, your auto debt. And so the policy stance today is simultaneously helping the savers and hurting those lower income cohorts. So an adjustment downward, I would argue, might be a bit more optimal.
On aggregate, a net benefit or net negative? It sounds like a net negative.
To keep
rates where they are?
Listen, the economy, again, these transcendent influences, the policy setting today is not going to dent the trajectory of the economy. It's being influenced at the margin by velocity, which slowed earlier in the year and is set to become unleashed in the back half. I think it would be more optimal if the rate came down a little bit and met where the market's pricing cuts today.
Russell, appreciate your time. Thank you, sir. Russell Brown back there of BlackRock on the credible arguments on either side over the FOMC.
What he just said there about the structure of wealth in this country, I thought was fascinating. The idea that savers are benefiting from rates staying high, and that's at the detriment of people who have to borrow these floating rate instruments to do things like buy cars and cover their credit card bills. That's a really important argument.
Story of the last 3 years.
Yeah, exactly.
It's a problem. It's a big problem. Up next on the program, Alex Altman of Barclays, Nishit Maldani of S&P Global, Andrew Onhorst of Citi and Space Foundation CEO, Heather Pringle from New York. This is Bloomberg.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case, of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The quality of the S&P has actually improved.
The valuation, yes, it's high, but it's justified in our minds.
Businesses are still in a really, really good spot.
Corporate America has a lot more difficult decisions to make this quarter.
It's not all easy. I think this is going to be somewhat messy in this reporting season.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
That all sounds dreadful. Stocks are at all-time highs. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now with equity futures just about positive on the S&P 500. On the Nasdaq, the focus on tomorrow afternoon, looking ahead to numbers from Alphabet and from Tesla. In the bond market, yields have been falling coming into Tuesday. This morning, totally unchanged. The 10-year at 4.38. If Mohamed Al-Erian gets what he wants, this market won't be unchanged. He's looking for the chairman of the Federal Reserve to resign.
If it can quiet some of the noise around the independence of the Federal Reserve, he came out and posted on X. He's not in the consensus, let's just put it that way. Adam Posen said that he just was a hard pass to that argument. There is this question, though, about what it will do if you do get some sort of changing of the guard, if the person who is put in that seat is credible, if they have some sort of legitimacy in economic circles.
It's a polarizing take from Dr. Al-Erian this morning, that's for sure. But if one party's happy, it's the White House, isn't it? That's what they're pushing for.
Absolutely, because this is out of consensus with what a lot of individuals are saying. And basically, Mohamed Al-Erian is lining up behind their argument. But he is saying that if Jay Powell himself cares so much about the autonomy and the independence of the Fed, then take yourself out of this equation. Of course, the next question comes, who then do you put into that chair? And I think what Mohamed is saying in this tweet is actually he thinks markets will be fine. But markets will be fine because the move before will be Jay Powell resigning, not being fired.
So this is about institutional credibility. On the institution itself, they meet next week, and they conclude that meeting a week tomorrow. Andrew Honhorst of Citi joins us a little bit later on this program. He's pushing the idea that don't worry about tariffs. Rather like what Governor Wallace said to us on this program just last week, the pass-through to the consumer isn't as strong or as powerful as many people feared.
And that's what we saw in GM. That's what we saw in a number of different companies who have absorbed some of the margin compression that the president has called for. We see Coca-Cola raising prices, but some of the smaller, lower price goods, you're seeing some bigger price increases just because they can do that. If you kick it up 2 cents, it's not going to make a big difference. I will just say, this is a common argument. Even Mary Daly on the Federal Reserve Board talking about the idea, or San Francisco Fed president talking about how she is coming around to the idea that this is going to be a one-time price shock. I keep thinking about what Russell Brownback said, though. I do want to come back to that argument of just sort of who it affects if they lower interest rates.
Also, if the Fed is concerned about where the tariff levels are going to be, the Treasury Secretary saying this morning, August 1st is, quote, pretty hard deadline for all countries. I think what he's saying there is he doesn't mean you can't negotiate after tariffs go up, but they are trying to deliver on all these fronts by August 1st. And in that case, will the Fed have enough information when they meet in September?
This is what the Treasury Secretary's got to say on the future of the Fed chairman. No reason for Powell to step down right now.
Because ultimately they're going to go through this process. What benefit does it do for them? Honestly, they don't want to roil the market. They want a scapegoat. They want to have this discussion. At a certain point, what are they going for? And why are they increasing the pressure if they're not going to have him step down and they're not going to fire him? Again, we keep asking that question. I'm not sure the answer.
Looking forward to the live blog from the White House next Wednesday. During the news conference with Chairman Powell. All of that's a week away. Right now, equity futures doing okay. Just about positive on the S&P 500. Coming up this hour, we'll catch up with Alex Altman of Barclays following another all-time high. Nishat Madlani of S&P Global reacting to GM earnings, and Andrew Honhorst of Citi on his call for a September rate cut. We begin this hour with stocks hovering near record highs. Alex Altman of Barclays writing, ultimately, it remains all eyes on that confluence of the FOMC, PCE, NFP, mega cap earnings window with a sprinkle of tariff threats or relief. Alex joins us now for more. Good morning, Alex.
Good morning.
How are we priced for all of that?
Well, the S&P is pricing in about a 1% move every day over that 3-day window. But what's really interesting is that we've obviously had a long streak of really very little volatility. The market's pricing in a 3-day window of volatility, and then it's pricing in no volatility again. So I would say there's still a relatively high amount of complacency, even over those that 3-day window of 3-letter acronyms.
Tariff threats or tariff relief, the difference between the two. What is the difference between the two? Is this a market, do you feel, that's betting against the administration following through or betting on corporate resilience in the face of tariffs?
I would say the latter. It's quite clear. I mean, the S&P is trading on basically at its cap of what it's been trading from a valuation perspective in a post-COVID era, which is about 22 and a half times. And so if we break out of that, we're starting to question if we're getting into a new regime of valuation and of, dare I say, bubble, which is clearly going to be moving towards tariff relief than tariff fear.
Well, but Chris Harvey had an interesting argument about this. You used the word bubble, but he made the argument that we should be getting to higher valuation levels, given the fact that this is a much more tech-dominant index than it has been traditionally. And we have had this huge industrial revolution underpinning some of the efficiency gains that have allowed companies to absorb some of the tariff costs, et cetera, with relative grace. What do you make of that, that there needs to be just generally a higher valuation, a higher multiple put on U.S. equities as a result?
I think that's generally been the path over time. If you look at the path of the equity market, multiple post-GFC, as profit margins have increased, you've generally seen an improvement in valuations. I would like to pivot slightly and just talk about small caps a little bit, because we're going to talk about a technological revolution. And we need to start thinking outside the box a bit, beyond just the hyperscalers and the immediate picks and shovels beneficiaries of AI. Let's talk about the fact that consumers get a huge benefit from AI at basically a subsidized cost as a result of these hyperscalers investing, quite frankly, trillions of dollars into this investment at what is currently a low ROI. Think about the consumer benefit. Think about the small business benefit. Businesses that now you're democratizing the process of that AI revolution into, let's call it, small caps. And that's why I actually think the valuation anomaly might actually be in the smaller cap space, which basically has been overlooked for years now.
So this is the argument that people were making last year that didn't really come to pass, that we'd see a broadening out away from the hyperscalers and the big tech names to the rest of the index, because you are seeing that diffusion of some of the tech prowess. Is that sort of what you're expecting now? Is that kind of where you're leaning in?
It is. And also, let's not forget, breadth this year has been pretty good. So we've already seen a broadening out. Best performing sectors in 2025 have actually been things like industrials. It hasn't necessarily been just the mega caps. But then we've also got to start thinking about a regime shift, which has already been discussed in this forum here, which is, what are the Fed going to do? If we're going to move away from a higher for longer narrative to a lower interest rate environment, consider the fact that small caps, 45% of small caps are variable interest rate debt. They're going to get the direct benefit of interest rate cuts. So we can pontificate about whether Mr. Powell is going to resign or the rest of it, and we will. However, the fact of the matter is that we will end up with a replaced Fed chair at this time next year, and we are pretty convinced that the path of interest rates is therefore lower. So we need to think about less about the near term and more about if interest rates are lower, who's going to be the direct beneficiary. So it's not just the AI angle. You've got lower interest rates, and you've also got the positioning, which has been our guiding light since the beginning of June. From a positioning perspective, look at CFTC data on small caps. It's currently the most short since last summer, right before we had that big squeeze as well.
Even before we get a new Fed chair, we could see the Fed cutting interest rates. When do you have this all timed out?
Well, so Barclays economists have still two cuts for the year. So, September, December. I think that at the end of the day, whether this is one cut, two cuts in 2025, I wouldn't say it's irrelevant, but I would say it's marginal because we're trying to sort of forecast. Remember, equities are supposed to be a forward discounting mechanism. They're supposed to be thinking 6, 12, 2 years out, especially for long-dated securities that don't have many profits today. So in that case, I don't think it matters enormously.
So for small caps, you want to be exposed ahead of September?
Correct, yes. I think the small cap story is really not just about positioning, but it's about that Fed pivot, or dare I say, is the equity market moving into a new regime, away from just thinking about the narrowness of leadership and into something a little bit more broad.
Strange things happen in August. Are you hopeful we'll have one of those nice quiet summers?
I mean, I'm going on vacation on Friday,
You're taking some time off.
I would very much hope so. But as you say,
Nice
August is notoriously volatile. August can be notoriously volatile. If we all recall last year what happened with the BOJ and so on and so forth. I would say that the fact is we still, to your first question, we still have that confluence of events straddling month end, and any of those could potentially derail this low vol environment.
What's volume like at the moment? Just volume?
Volume, well, volume is okay, but it's massively skewed by the retail cohort. So we're seeing this enormous turnover within a small number of securities as a function of the small investor, which is again a part of a larger discussion.
Can I just follow up on that? What securities? Are they concentrated in the ones we talk about every day, or different kind of companies?
I mean, just for the purpose, I won't name specific names, but I'll give you an example that 4 securities, I think it was middle of last week, 4 securities accounted for 11% of total NYSE volume. The collective market cap of those 4 was 2.6 basis points of US capitalization. So these aren't stocks that you talk about on a daily basis.
11% of volume, 2.6 basis points of market cap.
Yes. Of US market cap.
That's amazing.
Yes.
Have you ever seen it like that before?
We have not, no.
What do you think's behind that?
So that is, I would say, retail euphoria. So you've had this prevalence on shift of obviously a multi-year structural phenomenon post-COVID, where small investors have become a larger and larger portion of the tape. They now account for about 25%. Systematic flows, so quantitative flows, account for another 50%. And those numbers have just been growing over time. So the only time we came close to this was in 2021, obviously a very different real rate environment.
But different backdrop completely. So I'm trying to figure out, just in real time, what's unleashed this recent bout? Because it feels like a very different backdrop to where we were all those years ago.
This goes back to my point of whether are we in a bubble or not, because we're talking about animal spirits, we're talking about euphoria, we're talking about the fact that there's a lot of small investors still haven't lost their jobs, still getting income growth, still basically seeing the stock market at the highs. And if you remember at the beginning of the year when we spoke on this show, there's a reflexivity in stocks. Because the economy is so financialized, 70% of financial household net worth is tied to the stock market. So on the way down, it feels terrible. On the way up, it feels fantastic.
Is this stupid money or is this smart money? Because they've been the winners. And a lot of people used to dismiss this and say it's a bubble and this means that the market's going to tank. Are people looking at this and saying, this means there are more gains ahead?
Well, I don't want to call them stupid money because the fact of the matter is they've made more money than most professional investors have recently. I would just simply say that these guys are doing what they've been doing or conditioned to do, which is buy the dip. I think what's important to consider, though, is back to this regime shift. Is the market telling us that we're moving to a lower interest rate environment where actually it's a lot of the less profitable stocks that end up being the market leaders? And if you look at things like certain factor behaviors, the only time we've seen this before, these could be engineered as a short squeeze, but it's not a short squeeze, 2009, 2020, and 2021, neither of which were just short squeezes. They were regime changes. And so I think that's what we're pointing towards. That's why we're thinking about small caps more, because it may not just be the stupid small investor. It may actually be something a little bit more paradigmy.
Those numbers are amazing. 11% of volume across 4 names, which account for 2.6 basis points of US market cap.
Yeah.
Unreal. Alex, good to see you.
Nice to
A lot
see
to
you.
think about. Thank you. Thank you, sir. Alex Altman there of Barclays. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent is calling for an exhaustive review of the Fed's non-monetary policy operations, including the $2.5 billion renovation of its headquarters. In a post on X, Bessent says that significant mission creep may be jeopardizing the independence of the central bank's core mission to set monetary policy. Meanwhile, the Trump administration released more than 6,000 documents related to the 1968 assassination of Martin Luther King Jr. yesterday, despite opposition from his family. The digital data dump includes more than 240,000 pages that had been under a court-imposed seal since 1977. In a statement, King's 2 living children urged the files be viewed within their full historical context. And In-N-Out's billionaire heiress Lindsay Snyder is leaving California for Tennessee. She said both raising a family and doing business in the state is not easy. Snyder said the burger joint still wants to keep a small footprint, and despite growing calls, she says In-N-Out won't be expanding to the East Coast. A bummer for us. That's your Bloomberg brief. John?
She's out. There we go. Yahara, appreciate it. Thank you. That was terrible, wasn't it?
That was so bad.
Up next, the Morning Calls Plus. Nishit Matlani of S&P Global reacting to GM earnings. That conversation up next.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
We're concerned about earnings. You know, we're scheduled to do what? Low, middle, single digits here this quarter on EPS growth. That's going to be the lowest in about 1.5 to 2 years. If corporations can't hold those margins up, y'all were just talking about the margins from Coca-Cola. We saw margins go down with GM. I think you start to see some of that flow through to the consumer, and you see that weakening in the economy.
That was Victoria Fernandez across Mark. The latest on the earnings. More earnings coming up a little bit later. We'll hear from Alphabet and Tesla tomorrow. Equity futures so far just about unchanged on the S&P 500, negative by 0.1% on the Nasdaq. Alex Altman of Barclays just moments ago talking about volume. 11% of volume driven by 4 names. Those 4 names, make up 2.6 basis points of US market cap. They are not the names you're thinking of.
They are tiny, they are specific, they are the Reddit posts, etc. But his takeaway from that was really interesting. It highlights the animal spirits and it highlights the conditioning of retail investors to keep buying the dip. And does this indicate a sea change, a paradigm shift, not necessarily dumb money, but sort of a smart take on where things are going and a potential harbinger of more gains ahead?
Record highs coming into Tuesday. Let's get you some morning calls. First up, JP Morgan cutting Lulu to neutral, citing a more cautious and discerning consumer. That stock is down by 1.2%. Your second call from Stifel, raising its price target on Alphabet to 218, seeing upside to the company's estimates. And finally, Citi, raising its price target on Amazon to 265, expecting revenue and operating income to top Wall Street estimates. That stock is higher by about 1/3%. Let's turn back to earnings. GM, seeing a blow from President Trump's tariffs. A big number from that company earlier on this morning. GM is down by 3%. With the details, let's cross over to Bloomberg's Ed Ludlow. Ed, not a great number from that company.
No, but it's the immediate and quantifiable impact of tariffs. So it's a $1.1 billion hit to adjusted earnings, bearing in mind the short period of time that they've had this exposure in time to do the math, and actually over the range of an annual basis, they see it in the range of $4 to $5 billion. And so GM, like every other industrial American company with exposure to a supply chain that ranges from Mexico to parts of Europe and Southeast Asia, is doing what it calls mitigation. But as you see the stock down 3%, John, this is a story where it actually beat expectations in large part of what was baked in, but profit is taking a real beating from policy, and you can't shy away from that.
Ed, of the big three in Detroit plus Tesla, who's in a more vulnerable position here in the face of these tariffs?
The big three more so than Tesla. I mean, the way that Tesla's always put it is that it's the least exposed to tariffs because of the concentration of supply chain in North America, particularly the USA. However, Mexico is still an issue for Tesla, right? 20 to 25% of components come from that nation. And the way that Elon Musk put it on the last earnings call is tariffs are hard when margins are already low. Tesla, of course, has historically had industry-leading margins. If you call it an automaker, you know, of course, we can debate whether it's valued as a tech company and its future in AI and robotics. But at the end of the day, they're still going to feel a bite, just less so than the Detroit 3.
Ed, appreciate the update. Looking forward to the program a little bit later. Ed Ludlow alongside Caroline Hyde at 11 a.m. for Bloomberg Technology, about 3 hours away. Joining us now to extend the conversation, Nishit Madlani of S&P Global Ratings. Nishit, welcome to the program, sir. Let's just talk about the kind of mitigation strategies these companies have introduced over the past few months. What are they doing to navigate the storm?
Yeah, first of all, thanks for having me. Look, like you said, I mean, there's been lots of uncertainty, especially around March and April around tariffs. Shifts in trade policy, it just weakens consumer sentiment, and it's created volume volatility. So what they can do, you know, just is specific to companies like GM, where tariff cost mitigation is very important to offset the $4 to $5 billion impact that they're expected to have. So things they can do is try and leverage the duplicative capacity they have. So for example, they've decided to relocate some of their pickups to Fort Wayne, localize production of their battery modules, and just ensure that they have better supply management, because there are suppliers and internal facilities here that can be utilized better within the U.S.
How much can they automate some of this to offset some of the higher costs of labor in the United States? So bring more manufacturing back to the United States and have more robots essentially in the factories.
Yeah, so that's something they haven't quantified, but it's certainly part of the playbook, right? If you look at what's happened in terms of manufacturing efficiency across companies, there has been increasing use of automation. Not to the same scale as Tesla, but it is certainly catching up. And of course, with the moves announced by them in terms of improving the utilization, that's the first step, because by adding about 300,000 units of additional pickup truck capacity within the US, that just helps overall utilization as well.
This raises a question of how they invest in some of the production and moving production to the United States to get around tariffs, while also cutting costs to offset some of the hit that they're seeing from those extra levies. How do you expect them to do this?
Yeah, look, this is one thing where we have a lot of credibility that we've assigned to the company's management team. They have a solid team, great track record, and despite external shocks, they've maintained a lot of discipline in achieving their targets, whether it's pricing or just making sure that inventories are not overbuilt. On a cost standpoint, look, they've mitigated all kinds of cost headwinds through their internal efficiencies. They've made sure that they're not over-engineered. They also ensure that from a supply chain perspective, they're less exposed to bottlenecks that seem to be more of a common issue for their peers versus them. So I think overall, just a better handle of overall execution from the management team.
Are they at some point going to need to raise prices, though, of their auto vehicles?
Yes, I'd say, look, that's inevitable, right? I mean, if you look at the way they've quantified the impact of prices, 0.5 to 1% type increase, we think that going forward over the next couple of quarters with the pressure that the consumer is facing, it's going to be hard to maintain something more than that. But at the same time, GM, Stellantis, Volvo Car, those are the ones that have the largest cost exposure. So our expectation is that we probably won't be surprised to see low single-digit type price increases stepping into next year. And a lot of that will have to be borne by the consumer.
So that's a 2026 story. When you look at all of these automakers, who do you think is weathering the tariff headlines and the 25% levy on the auto sector the best?
Yeah, look, it's early days, right? I mean, we've heard about mitigation strategies. Like I said, GM's positioned itself well to make sure that even though it has a very large impact compared to its peers, they are positioned to offset at least 30% of it. In terms of exposure, obviously some companies have a lower footprint, outside the US. Those tend to benefit. They have less headwinds to combat. But overall, I would say, compared to Stellantis and Volvo, I've seen more progress being made at GM.
Nisha, going forward, do you see a scenario where many of these automakers based in America don't have a presence in Europe anymore?
Look, it is a possibility. A lot of automakers like GM have obviously done a lot of restructuring in that market and focused on just very specific marquee products that they export from here. So I wouldn't be surprised if a lot of other automakers take that stance where they minimize it to their absolute profitable brands, because obviously that's a very expensive area to operate in. So I would think that that's probably the playbook they'll apply, and it obviously depends on political cycles, right? Because product cycles outlast political cycles.
True. It's a good final point. Thank you, sir. Nishit Madlani there of S&P Global on the latest earnings from GM and a whole lot more. We know that the most competitive, one of, if not the most competitive market on the planet is the Chinese auto market, and the future there is clearly going to be dominated by Chinese players. For Europe, I wonder if the same thing's going to happen over in Europe with the Chinese dominating that market too going forward.
Which would be a disinflationary force, which is something that you've talked about, right? Is that what you're going to end up seeing that causes the ECB to cut rates more aggressively going forward? And we're going to hear from the ECB later this week. Let's hear if they say anything about Chinese products coming to the market.
And maybe causes these US auto players to back out of the market entirely.
Well, that's what I'm actually wondering. If you have the 1-2 punch of trade tensions between the U.S. and Europe, and you have cheaper vehicles coming from China, how much does that start to really dominate a European market and transform it in ways that a lot of people aren't really thinking about right now?
Important final point. Products outlast politics, which is why many people on the other side of some of these trade negotiations are saying, this is an individual who is done after this term, and potentially we can ride this out because maybe there'll be better trade deals on the table if Washington was to have a changing of the guard.
Once that money starts coming into Washington, that tariff revenue, we'll see if anyone wants to give that up.
They never end up coming out. That's what happens. Happened in 1939.
Saw that over the last few years with China as well.
True.
Up next on the programme, we'll catch up with Andrew Holdenhorst of Citi on his call for a rate cut in September.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The opening bounce 60 minutes away. Equity futures just turning positive. We're positive here by 0.06%. With an update on your morning movers, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Just wanted to give you another look at GM. We were just talking about the shares falling 2.5%, booking a $1.1 billion hit when it comes to costs related to tariffs. There's a lot of questions yet to be answered from GM as to whether this is the worst, what things look like from here, but we are selling first and asking questions later. 2.5% decline in the pre-market. Northern Trust, though, those shares are to the upside this morning by 2.7%. Semaphore reporting this morning that the Goldman Sachs CEO, David Solomon, had a conversation with Northern Trust not that long ago about possibly buying the bank, that they're looking to beef up their exposure to some low-cost ETFs. Those conversations could heat up, according to that reporting. Finally, some other earnings to go through. Philip Morris also reporting earnings this morning, shares falling 4.3%. That's despite the fact that they raised guidance really around their smokeless tobacco products, like those weird little Zyn pouches you put in your lip that are quite disgusting. But anyway, they fell because expectations were really high. They rallied 50% into these earnings reports, but missed on organic revenue. So investors really catching on to anything they can, and those shares falling. John.
Danny, thank you. Thank you very much for the latest on the stock market. Let's turn to the bond market. US 10-year yields falling. 4 straight days coming into Tuesday. Ira Jersey of Bloomberg Intelligence joins us now for more. Ira, welcome to the program. It's not a major rally, but it's a rally. We'll take it. Yields are lower. What's behind the move?
Yeah, I think there's some comfort here a little bit that that demand from foreigners isn't completely drying up, and you know we did we did hit 5% on the long end, and you know once we hit that, we did see some liability-driven investors you know take notice and start to buy a little bit in the long end. You know, like you said, it's not a massive rally, but at the same time, I think it shows that there's some stability in both the demand and the supply side, at least for now. And you know we're going into this week where next week we have the quarterly refunding announcement where, you know, Secretary Bessent is going to, for the first time, say, hey, here's how we're going to issue bonds. And right now it seems like maybe there's not going to be any new 10-year bonds being created above and beyond what's already expected.
So, Ira, with that question in mind, thinking out going forward from here, what's the incentive to push out more issuance along the curve?
Yeah, well, you know, historically speaking, when you go back the last 40 years, interest rates are still relatively low. Not as low as they were, you know, a decade ago, but compared to where they were in 2005 and 1995 and 1985, interest rates are still relatively low. I think that when it comes to how Treasury has to issue debt, it's really where do they think demand is going to be, and you know, you want to issue bonds where you know and other debt where it's easily absorbable, number one. And number two, you have to think about how is the refinancing of that. So if you only issued T-bills, then you're refinancing that every three to 4 months. And you don't want to be beholden on, you know, what's the market appetite in 3 or 4 months when you have the opportunity to buy, you know, to issue 2s, 5s, 10s, and 30s. So I think that they will keep coupons stable this quarter. We had always expected them to be. volatility. But we actually just put out a note this morning that's available on the Bloomberg terminal suggesting that maybe now, because of this policy by the Trump administration, they won't increase the size of 5s and 10s and everything else until next May, when they kind of have to. Otherwise, T-bills outstanding is just going to grow to a very massive amount.
Ira, just taking a step back, how global is the bond market right now, and how much are the yield moves that we're seeing in the U.S. affected by what's going on around the world, as much as the domestic landscape?
Well, foreign investors are still a very important incremental buyer of treasuries all throughout the curve, particularly in the 2 to 5 year sector is usually where central banks and foreign reserve managers play, and then the long end is where pensions and other liability-driven investors tend to see strong demand. So we always talk about things like Taiwanese insurers, for example, wind up being large buyers of long end treasuries. They're very important, but not as important as they were, say, 12 years ago. 10 or 12 years ago, about 50% of U.S. treasuries were being purchased by foreigners. That's way less than a quarter today, right? So you wind up with things shifting more domestic in the U.S. as savings rates have gone up a little bit, as interest rates are a little bit more attractive. You have seen more domestic buying, and of course, the Federal Reserve, even though they're continuing to shed treasuries very slowly, they still own a lot of treasuries themselves. So they're a much larger, they're not an incremental buyer of the market and a price setter anymore like they were when they did QE, but they still own a fair share of the market.
Ira Jersey of Bloomberg Intelligence. Ira, thank you. If the Federal Reserve wanted us to stop talking about the Federal Reserve, this is how you do it. You host a conference on the integrated review of the capital framework for large banks. What a name they came up with over there, eh?
Sounds scintillating. I'm excited to hear about what they come up with on regulation.
Expecting Chairman Powell to take the stage any moment from now to address the integrated review of the capital framework for large banks.
What does that even mean? I mean, it's sort of vaguely, we're going to look at bank stuff and balance sheets and anything other than what everyone keeps talking about.
If there is some Q&A, and I don't know if there will be any, but if there is, this is still an opportunity to ask about the obvious.
Yeah. Will you step down? Do you plan to resign? He'll say no. They'll say, do you feel like this is compromising anything that you do at the Fed, the fact that every single day you get an ex post or a truth? And he's going to say no. And then people are going to struggle to ask the same question 15 more ways.
And they would do it all again? Next week at the news conference with Chairman Powell after the monetary policy decision. Here's the view on Wall Street this morning. Andrew Hornhorst of Citi writing the Fed remains on course to resume rate cuts in September. Andrew joins us now for more. Andrew, good morning.
Good morning.
Why September, and what's leaning in that direction already?
Well, I think there's kind of a fundamental argument around September, which is the slowing that we've seen in core inflation. We still have tariff effects upcoming, but services especially look like they've slowed down. Labor market looks strong, but beneath the surface, there are some details that look a little bit concerning. You'd want to be moving towards neutral. That's a fundamental explanation. But then there's also just the Fed rhetoric explanation. They've set this up now. They've said we're going to watch the data over the summer. We're going to make a decision in September. In their dot plot, they've got 2 rate cuts this year, 50 basis points of rate cuts this year. That would also make sense with a September cut. So they've kind of set it up for September. You could argue it's going to be premature in September to know how big an effect from tariffs we're going to get or not in inflation. It's not clear that that's really the month when you're going to have all questions answered, but it looks like that's where they're headed.
On the labour market, in their last statement, the labour market conditions remain solid. Can they repeat that line this month?
I think they can still say that. There is a debate about how solid is solid. Some Fed officials have used the word solid. Other Fed officials have used the word fragile. So you kind of wonder, how can the labor market be solid and fragile at the same time? You look at the headline, we're getting 140,000 jobs per month. That's a strong reading. 4.1% unemployment rate. That also looks solid. But then you look beneath the surface and you see those 145,000 jobs. Well, really half of them were in the government sector, and there's probably some seasonal adjustment issue there. You look at that unemployment rate. Part of the reason it's low is because the participation rate has gone down, and that's because some workers are actually leaving the workforce because they're not finding jobs. That doesn't look as strong. So I think there is this kind of coexistence of a top-line number, a headline number that looks resilient, and the labor market overall has been resilient, but then these details that do cause you some concern.
We often say the stock market is not the economy. The stock market's not the economy. We see the stock market doing really well on the heels of earnings by companies that are doing really well. How do you counter companies doing very well with an overall backdrop that you see as weakening, as less favorable, just overall?
Yeah, so if we look at the economic data, you look at services spending. I think goods spending has been very volatile, so it's hard to read too much into that. Services spending, we've been slowing, and that's really been the engine of growth for the U.S. economy. You see that in Q1. I think we're going to see that again in Q2, and that's telling us that consumer demand is slowing down. We have a real mystery now if you kind of look at the data, because we know someone is bearing the costs of tariffs. It could be foreign exporters, it could be domestic firms, it could be consumers. We don't see consumer prices going up a lot yet. We don't see foreign exporters reducing their prices a lot, at least in the data. So then that would say that some domestic firms are absorbing some of these costs. That should be negative, maybe not reflected in what we're hearing so far.
So why do you think that we're not going to see any kind of inflationary pressure that would pressure the Fed maybe to remain on hold, despite some of the noise that we're hearing from Washington, D.C.?
So I think we will see some inflation. I don't think that that's going to end up constraining the Fed in a big way. And that's because the inflation that we're going to see is going to be in goods inflation. Now, if you looked at the June inflation report, you could kind of see it two ways. On the one hand, we didn't have a big inflationary effect. On the other hand, you had a few categories of goods, home furnishings in particular, where you're seeing some of those early tariff effects, and we'll probably see that in some other categories of goods. But the big question, and this is what Governor Waller has really emphasized, the big question is this going to be just restricted to goods inflation, or is this something that broadens? Are we getting broad-based pressure in services inflation, in wages that are going up, and just a general inflationary trend in the economy? There's no evidence that that's what's happening here.
Do we need to have the final rates to understand that story?
I don't think we can wait until we have the final rates. You would like to, right? And that kind of goes back to, is September the right month to be moving? If the objective was to wait until you had all questions answered, they're not all going to be answered in September. Maybe you'll have some clarity on the August 1st, but maybe not, right? Some of these negotiations may continue. And then even if new tariffs go into effect August 1st, we know where those rates are. How much do they pass through to consumers? What is the timeline on that? What's the extent of that tariff increase? We're not going to have all those questions answered.
Say it is just a 10% baseline overall, then maybe some different intricate deals for bigger partners. Do you think companies will be forced at all to pass on to consumers, or they're going to hold what they're doing right now, which is to eat a lot of it?
I mean, I think you'll see some of that passed on to consumers. Like I was saying, we're seeing some price increases already, but 10% tariff, that's pretty manageable. I think that's something that firms largely could internalize, and you probably don't see that much passing through into consumer prices.
How anchored are inflation expectations, both consumer-based and market-based?
Yeah, I mean, it depends a little bit on which measure you look at, and then you can really get into the issue of, are you just cherry picking the one that you like?
What do you think is more credible?
Well, University of Michigan is the one that's been all over the place, right? That one's much higher. Now it's come lower again. If you look at the New York Fed expectations, those have been more stable. I tend to look at the market expectations. There are issues with the market expectations too. I'm not saying that there aren't, but at the end of the day, people are putting money on the line on those expectations. Those are expectations that in some sense are a stronger read on what people really think, what investors think about inflation, and those have not moved to levels that are concerning.
Right now, I'm looking right now at a market that has just defied all expectations when it comes to looking through all of these ramifications. What are you looking to hear from the Fed next week?
Well, I'm not sure that we're going to get a lot of new information from this Fed meeting. We know that we have a pretty big division across Fed officials. We have some that don't want to cut it all this year. We have others that think you should be cutting in July. That's one interesting element of this meeting. We could get a dissent from up to 2 governors. Governor Waller really sounded like he is planning to dissent at that meeting. We'll see if he goes through with that. That's really notable. We had a dissent from Bowman in 2024. Before that, you have to go back to 2005 before you had a governor dissenting on rate policy. So that would be kind of a signal that there's a pretty big division across Fed officials. I think what we'll hear from Powell is wait and see. We're waiting to look at the data over the summer. We're going to tell you in September.
He's got to acknowledge the split on the committee, Andrew. I don't think he can get away with going into the news conference to attempt to reflect a consensus that doesn't exist. There's clearly a division. You see that in the SEP. You see that in the speeches from all the Fed officials. How tricky is that going to be in the news conference?
Yeah, I think this is very difficult, right? This is very, very difficult time for the chair when you have even your governors, right, that are maybe at odds over what the Fed should be doing. So I think what he does is he goes back to the data. That's what Fed officials typically do and say, that's why we're waiting, and that's why we're watching in July and August. And honestly, probably hoping to some extent from Chair Powell's perspective that they will get a clearer signal. It kind of goes back to what we were discussing with the labor market, with the inflation data. You can read this data a little bit 2 ways, and that's part of why there's a division. Maybe we'll have some more clarity in the data by September.
Andrew, appreciate it. Good to see you. Andrew Honhorst there of Citi. Deutsche Bank's Matt Lazzetti said it a few times, came on the show and said it. This is not uncertainty, it's division. at the Fed that the chairman needs to address?
And honestly, it's something that you would expect at a turning point in an economic cycle. You would expect people to interpret it differently. People on Wall Street interpret it differently. How does he do this while still remaining the position of chair who's setting the tone on a Federal Reserve that is increasingly fractured?
That news conference a week tomorrow. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Coca-Cola reported second quarter sales growth that beat analyst estimates as consumers continue to pay higher prices for its soft drinks. And because of that, the company raised its full-year growth outlook. Coca-Cola also confirms what President Trump posted last week, that it will launch a new product made with cane sugar this fall. Meanwhile, the owner of the Los Angeles Times says he will take the paper public over the next year. In an interview on The Daily Show with Jon Stewart, billionaire Patrick Soon-Shiong said the move will allow the public to have ownership of the paper. If he goes ahead with an IPO, the LA Times would join the New York Times and News Corp among the largest publicly traded news organizations. And Citi is asking its first-year analysts to disclose whether they've already accepted a job offer from another company. According to a memo seen by Bloomberg, the change is intended to, quote, foster a fair and transparent environment. Goldman has made a similar move as banks look to clamp down on recruitment by private equity firms. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Look ahead through the rest of this week, plus the Space Foundation CEO, Heather Pringle, with a look at the booming space economy. That conversation just around the corner.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
the hierarchy of goals for the Fed is very clear. Stable prices and full employment above all else, financial stability. So this is all just a bunch of game playing. Once we get the jump in price level due to tariffs, does that transmit into second round inflation effects? And that's what the Fed has to call.
That was Adam Posen of the Peterson Institute. That is the Fed's call. Some people on the committee are ready to make the call. Governor Waller's one of them. Will he stick his hand up in just the next week and say, you know what, I'm ready to go. Let's cut rates.
Probably he will. That was sort of the indication. Will he have company, though? Mickey Bowman, as well as maybe some others as well.
And what will Chairman Powell's argument be? Not to do that. Find out next week. Big tease, huge promo. Federal Reserve decides a week tomorrow. Equity futures on the S&P 500 positive by not even 1/10%. The opening bell just around the corner, 30, 40, 41 minutes away. As we count you down to the opening bell, here's the trading diary. The week ahead looks like this. At 11:15, President Trump meeting with the President of the Philippines. On Wednesday, results from Tesla and Alphabet. Plus, President Trump delivering an address on AI. Thursday, a rate decision from the ECB and earnings from Intel and American Airlines, plus another round of jobless claims. And one small data point into the weekend, durable goods. Elsewhere, let's talk about this. The Space Foundation out with its latest quarterly report showing global commercial revenue jumping 8% from a year ago to $613 billion. The leading driver, the private sector, which accounts for 78% of the space economy. Government budgets making up the smallest portion of just over $130 billion. Potential catalysts for growth include President Trump's Golden Dome, Elon Musk's Starlink, and commercial spaceflight. Joining us now to discuss is Heather Pringle, the CEO of the Space Foundation. Heather, welcome to the program. Lots to work through here, but the numbers that jump out to me are the 78% coming from private enterprise. Do you see the private sector doing much of the heavy lifting of the space economy for the years forward and the foreseeable future?
Absolutely. The commercial sector is right now valued at $480 billion for 2024, and that is an 8% growth over the prior year. And when we look at the 12 sectors that constitute the commercial market, we look at position, navigation, and timing, which comprises $231 billion. The number 2 service just behind that is ground infrastructure and equipment, coming in at $123 billion. Both of these subsectors showed a 10% growth over the prior year. So with something like position, navigation, and timing, this is coming into every swipe, tap, and left turn that you make using those global navigation satellite services.
Heather, I'm struck by the fact that, yes, the private sector is the one that's leading the charge into space exploration and space use and the space economy, and yet there's a huge national security component to this with the likes of China and Russia trying to exploit this whole network, possibly disrupting the United States. Based on your research with the Air Force, your service with the military, I'm just wondering how prepared the United States is for that in terms of government coordination with the private sector.
Well, absolutely, the United States is the #1 investor in the global space economy, and this includes all sectors, commercial, civil government, as well as national security. Now, you were pointing out what the United States is doing on the national security side. $49 billion of investment into our national security enterprise. Over 90% of that is going to the newest service, that is the United States Space Force. This is well ahead of what we see. China is investing, for example, on the civil government side. The United States is investing $27 billion in the civil government space economy. China's investing 17%, so we're well ahead on that. You can also look at the launch record. For example, the first 6 months of 2025, the United States is launching at a record 97 already launches these first 6 months. China is only a fraction of that, well under 20. So the United States is leading, it's leaning forward, and it's doing a lot to prepare for this. You mentioned Golden Dome as well. This is a huge initiative valued at $175 billion for the entire development effort. It's going to have a large Everything from sensing to tracking to intercepting, and the commercial space market is really ready to deliver.
Well, the Golden Dome just locked in $13 billion. They named someone to be a project leader. But this morning, Reuters is reporting that Trump is looking for alternatives to Musk's SpaceX to lead that project. What companies in the private sector could lead that project in your view?
Well, Golden Dome is going to be a national security project led by the recently confirmed four-star General Mike Gutlein. He'll be here with us today at our program. But to your point about who are the commercial entities who can step up to the plate, there are a number of companies that are leaning forward, delivering capability. This is a multi-layered capability when you look at the totality of what Golden Dome is. It's launch, it's sensing, it's tracking, it's intercepting. And so even if you did take a deeper look at the launch enterprise, there are over 14 companies around the world who can deliver that, 10 different nations. So it's a whole of nation effort, and there are a lot of companies who are able and willing to step up to the plate.
I guess what you're saying is if it's not going to be SpaceX, there will be a company that can fill that role. Do you have a timeline of how long this project can take?
Well, I would say there have to be a number of companies, whether it's SpaceX or others, who need to contribute to this project. The scope of it is so large that it really is going to take a number of companies delivering these different capabilities. As far as the timeline, we are looking at, the president has announced that it should be on a 3-year timeline. So that's looking for capabilities that are out there, that are fairly mature, that are tried and true and existing. So that's what it'll depend on.
These numbers are getting bigger and bigger. Looking forward to tracking this story with you once again. The Space Foundation CEO, Heather Pringle there on the size of the space economy.
I love the space economy discussions. I've got to say, I love the idea of what can happen there, whether we're all entering sort of an Obi-Wan Kenobi, Yoda world. I mean, honestly, all of the science fiction coming to reality and how that is a serious threat when it comes to international warfare.
I prefer it when you talk about the bond market.
Yeah, this is too existential.
Right?
Maybe that's her next broadcast.
I grew up with a family that watched science fiction. I know that's going to be a shocker to a lot of people.
I'm surprised at that.
Really?
I'm surprised.
I didn't actually watch it, but my father
You didn't watch TV?
Well, yeah. He had a black and white one that he pulled out from underneath the piano.
And you were allowed to watch some science fiction?
Saturday nights it was Doctor Who.
There we go. Get the camera back to me. Brahma does not want it on her. Okay, tomorrow, Julian Emmanuel of Evercore. We'll also catch up with Ella Hodger of Newton Investment, Ben Keller of Baird, Republican Senator Bill Hagerty of Tennessee. From New York, this was Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. we are allowed to do. We bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equity futures taking a breather after hitting a fresh record 30 minutes ago until the official start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, earnings season picks up with reports from Tesla and Alphabet on the horizon. Meanwhile, you have Treasury Secretary Scott Bessent offering support for Jerome Powell, saying that he sees no reason for the Fed chair to step down now, and railroads could be taking another crack at M&A. Details on those deal talks ahead. Sonali, what do we have under the surface here?
Earnings season. We're looking at some of the defense companies. Lockheed Martin down almost 7% pre-market. And of course, you're looking at them missing expectations as well as reporting a pretty significant loss here tied to results. Katie, I think you're also looking at General Motors.
Yeah, let's talk about General Motors. This was a really interesting one. Of course, you had GM come out and say that they expect an even bigger hit than was expected from tariffs to the tune of about $1.1 billion. They actually beat on several measures when it came to this earnings report, but you can see shares down 1.7%.
We're going to now bring in Bloomberg stocks reporter Nora Melinda. More on defense earnings this morning because unlike Lockheed Martin, you're seeing Northrop Grumman rising. And perhaps explain here, Nora, the tale of two cities we're looking at.
We're definitely seeing a tale of two cities, as you're mentioning today. We're seeing shares of RTX. Now, this is one of the biggest U.S. defense contractors that we track, Lockheed Martin being the second biggest here. And we have Northrop Grumman. We are seeing that in the green. And this is, of course, is after we got results today that it boosted its full-year adjusted EPS forecast. But we are seeing shares of RTX and LMT both lagging this morning. And that's after they had earnings that missed expectations. But coming into this earnings season, we were seeing a lot of the street a little bit pessimistic, if I will say. They were expecting that this would be the reaction, that either we would see shares trade flat or we would actually see them trade off, because of course a lot of people are thinking about the defense space and as we're thinking about the budget in regards to the Department of Defense and a lot of these other headwinds that we've been seeing the sector dealing with when it comes to supply chains and all these other aspects here. So not a surprise with what we're seeing in terms of the share move in this pre-market trading, but definitely interesting when you're seeing Northrop Grumman breaking out here.
It's also unintuitive to the casual follower of defense names. You would think that these are the sort of companies that would be in the spotlight that might be benefiting from the currently fraught geopolitical environment we're in. You think about what's happening with European defense companies. They've been absolutely skyrocketing. It's a more nuanced story when it comes to American defense.
Absolutely. I mean, we did see, of course, all these geopolitical tensions that you would anticipate being a tailwind for defense, but we do have the street. I mean, we can't say that these companies are really doing poorly this year. We are talking about stocks that are still remain in the green. But if you look at the broader defense and aerospace industry more broadly, we are seeing a bifurcation here. You're seeing aerospace stocks really driving the rally in that sector, and you're seeing these U.S. defense contractors lagging behind here.
All right, Nora Melinda, great reporting as always. Keeping an eye on Lockheed Martin and the like. And staying on earnings, Dutch semiconductor designer NXP Give a weak forecast over concern that auto sector disruptions will hurt revenue. We're also looking ahead to Google earnings tomorrow as Google notches up a really impressive win streak. Let's bring in Bloomberg Tech co-host Caroline Hyde with all the details right now. And I guess we start with the bad news. NXP Semiconductors really taking a hit this morning.
It is, and it's because they didn't quite live up to the highest of expectations. And I'm afraid in this current environment, if you're not going to be meeting the street expectations, even the whisper numbers that are at the top end, you're going to see your stock fall back down. This is a company that has been in the eye of the storm when it comes to tariffs. We've seen what Renault's numbers were like, what Stellantis' numbers were like just yesterday. And when you've got that sort of tariff exposure, then the chips that are going into the future of EVs, for example, is going to be curtailed. Therefore, future demand is not living up to the hopes. NXP already was seeing revenue on the decline, but it was sharper than expected in the fiscal second quarter. And the forecast really is where the expectation is being a little bit underwhelming. So we're seeing revenue deplete quarter on quarter. And all of this at the moment is as we start to see also not just the auto sector be under the pressure, but also just automation of manufacturing. The thing that we keep talking about bringing to the United States, well, globally, it's been impacted by tariffs too.
Really mixed bag when we look at how tech earnings have been coming out so far in tech-impacted sectors. But I want to talk about Google, Alphabet.
Yeah.
You are looking at them on a 9-day winning streak, on track for their longest winning streak since December of 2010.
Yeah.
So a lot of excitement heading into those results tomorrow. How are investors kind of stacking up how they'll do?
I think they're looking at the valuation, Shanali, because actually compared to the S&P 500 or compared to the NASDAQ 100, the valuation of where Google trades